Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj, and I'm very excited to meet you all in our CA Inter Paper 4 Costing Marathon. Of course, this is just part 1 of our marathon series because YouTube has this restriction of 12 hours per video. So this is just part 1. The subsequent parts will be released in the upcoming next few days, right? Or maybe in the next week or so. Right, guys? Fine. So before we get started in this particular marathon, so I want to give you guys a brief introduction and I want to set the ground rules right for you. So for those who do not know about me, so I'm CA Ganesh Bharadwaj. I'm a practicing chartered accountant based out in Chennai, and I am a very passionate teacher. I handle the subjects costing and financial management, and of course, so I'm starting your CA final advanced financial management very soon. Right, in the next few months we are starting that as well. So that's a brief introduction about myself. Of course, I also handle 2 papers at the CMA intermediate level, so paper 8 cost accounting and paper 12 management accounting. So that's a brief introduction about myself. Now with respect to this marathon, this is applicable for your Jan 2026, May 2026, September 2026 attempt and onwards. Even if you have attempt later on, yes, absolutely, this marathon is applicable for you. This is a latest marathon where we will be using the latest color books which I have come up with. Now for your costing subject, now I have come up with 2 books. One is called as your concept decoder book. Trust me guys, a lot of efforts have gone into this. This book has all the concepts, right, and the core theory topics beautifully bifurcated chapter wise. So every chapter, if you notice, every single chapter, if you notice, right here we have all the chapters mentioned. For example, if I take this chapter cost sheet, right, so properly you will be having every single thing neatly bifurcated, right, and whatever color coding that I use here, it's not some random coloring. There is a logic behind every single thing. So all these things are neatly done. And of course, there is also something which I have introduced here called doubt busters. Means what? Right, for example, I have given here cash discount is treated as a non-operating expense and hence should not be considered for calculations. What it is, we will see in the respective chapter. But right, basically what I've done under the respective concept, I have actually introduced this concept of doubt buster. Basically, these are all the areas where students generally commit a mistake. So I have created the doubt and I have clarified under the respective concept so that if you are revising this the day before your exam, you will definitely not commit this mistake in your exam hall. That is the objective for this. And this is the book using which I take my regular and exam oriented batch, and using the same book only, I'm also taking this marathon. Clear with this, guys? Every chapter, literally, all these things are done in a very organized manner. And of course, for example, if you take overheads, so all the concepts are properly listed out. All the formats for solving the numerical problems are also mentioned in our concept decoder book. And finally, after this, after all the core concepts, look at this, I have also mentioned core theory topics, which means, right, these are all the topics not required to solve numerical problems in this chapter, but these are purely meant from a theoretical perspective. That's about it. That has been properly bifurcated. Clear with this, guys? Now going on to the second book. The second book is called as your solved question bank. Right, now in this solved question bank, you have all your entire 100% of your institute study material questions are there, be it illustrations, the book back questions, the exercise test your knowledge questions, that is also been included with solutions, and the past exams RTP MTP questions are also included with solution. Clear with this, guys? All these things are included, and the latest 2-3 attempts exam questions and your RTP MTP questions, I'm separately coming up with a supplementary material. There is no amendment. Recently institute came up with the revised edition applicable for your May 26 attempt and onwards. Even for that, whatever is there is absolutely no change at all. This book is very much applicable for you, but I am compiling more sums, the latest exam questions also. Those latest few exam questions alone, I'm coming up with an extra supplementary material. This is not an amendment material. These are some additional question bank material. That's about it. But this is the base book which I'm going to use for all our marathon purposes as well as for all our classroom discussion, even a regular and exam oriented batch purposes. This is what I'm going to use. In fact, in the next few days, basically in the next couple of weeks, I'm starting a new batch for May 26 attempt and onwards in Chennai, right? So here as well, even I use the same book, the very same book which you guys are seeing here is what I'm going to use to take this batch as well. Now, if you look at this in this particular book, basically the most important thing, and one more thing I want to tell you guys, I have divided this into volume 1 and volume 2. Why? Because it's becoming a big book, because we are giving a comprehensive coverage, right? Hence, I divided this solved question bank into volume 1 and volume 2. We have 11 chapters in volume 1 and 5 chapters in volume 2. So this is how I have bifurcated this, right? So this is how I planned for this book. So you also have a volume 2 of the same book. So what I'm talking about is volume 1. So everything is actually the same. Now what I've done in this particular solved question bank, the innovative feature that you can find is that, now if you look at it, for example, let me tell you, basically I have improvised all the presentation. The solutions are not a direct copy paste from your institute study material. Wherever required, I have actually I have made some fine tunement, or I have made some changes in the presentation, right, in a chart format and all that. This can be used as such in your exam, accepted by ICA. This will enhance your presentation and understanding of the subject. Now one more thing, if you notice, now for example I'm saying this is question number 3, right, in your cost sheet chapter. This was question number 3. Now once this question is over, now the next question, if you notice, is question number 3A, right? The background of this question is slightly beige color, whereas for this question number 3, the main question, the background was slightly pinkish color. Sir, why, sir? If you see, this question number 3 is a superior question in terms of concept. If you are able to crack this question number 3, now generally you will be able to crack this question number 3A or 3B or 3C or so on. Or in other words, similar questions coming from a same concept have been grouped together. Now don't think 3A is a copy paste of 3. If that is the case, I will omit it. I will not even take it. Why should we take repetition? But 3A is very similar to question number 3, but maybe similar adjustments are there, or maybe 1 or 2 easy adjustments will be there, which can be managed if you finish question number 3. So what we have done is, all the similar questions have been grouped together so that when you are learning the subject, right, and at the same time when you are revising the subject, what happens properly, this will save a lot of time, and your revision as well as your preparation will be super effective. That is the objective of coming up with this book. And wherever possible, look at this, even MTP questions we have included, right? So wherever possible, we have also given the reference from where this question comes in. Clear with this, guys? All these things are neatly presented in such a way that you can properly get 100% coverage of the entire subject. I have not left even a single source. Every single thing is covered with the solutions. Clear with this, guys? Is there in this book? And of course, along with this, we also do along with all the solutions. Nevertheless, once again, I do all these questions in the classroom because it is more of a learning experience. That's when you get to learn. In the institute study material also, question and solution is there. Then why do you still feel there is some lacuna, or why do you still feel there is somewhere we are lacking? It's mainly because of the process. So the conceptual understanding with the numerical problem solving is what we focus during our lectures as well. But this being a marathon, we are going to revise all the major topics, all the concepts with one representative sum from every single concept is what I'm going to do in this particular marathon. Sir, are you going to cover this entire book? Entire book is covered in our regular batch, right? So in our marathon, I will be covering almost all the most important concepts, and every concept wherever possible I will take one representative numerical problem and also be doing it so that you can effectively revise this entire subject. Clear with this, guys? So that's going to be the agenda for this particular marathon. Now basically these two books which I was talking about, your concept decoder book as well as your solved question bank, now these two can be downloaded free of cost from our website, right? You can download it, and under the free resources section you can download the free PDF of this. If you want to place an order for the hard copy, under the book section you can go ahead and place an hard copy also. It is also available, right? That is something that I want to tell you all, mainly because this is the book which I use during our our regular batch as well as the exam oriented batch, and the same book is what I'm going to use even for this marathon purposes. Clear with this, guys? So this was something I want to tell you at the beginning level before getting started with this marathon. Now, in this part 1, I am going to cover the 3 most important chapters from an examination perspective: marginal costing, standard costing, and budgeting and budgetary control. These 3 chapters we are going to cover in this marathon. Marginal costing alone comes close to about 4 to 4.5 hours, because almost all the concepts, in fact every single concept I can say, is being covered in this particular marathon with one representative sum for every concept. Sir, is this sufficient from an examination perspective? No, the assumption here is you already would have studied the subject once, right? Because in our regular batch we solve about 35 to 40 questions in marginal costing itself, right? Here I am touching about the concepts plus one sum from every concept. That's all. There could be multiple varieties of problems which we actually see in our regular batches and all, but right now in a marathon, due to constraint of time, plus this is for revision purpose, I have condensed it, and here also without much of dilution, clearly we are going to revise all these topics. Now guys, one very important thing, sir, I have not studied these chapters before. Will I still be able to watch it? Yes, you can definitely manage. But my suggestion is, if you've already studied once, then it is going to be effective at the time of revision. This is what I would suggest. Right now, marginal costing alone comes close to about 4.5 hours, and standard costing comes close to about 3 hours. We discuss standard costing itself, all the variances, right? Your material cost variances, labor cost variances, variable overhead cost variance, fixed overhead cost variance, everywhere with the representative numerical problems. In the marathon also we'll be doing some numerical problems to a limited extent. Conceptually there is zero mucking up, 100% conceptual learning, and trust me guys, you will definitely see the power of conceptual learning. Clear with this, guys? And of course, this chapter, budget and budgetary control, also will be revising in a proper manner. This is the agenda for discussion in this part 1. So remaining topics in the subsequent parts will be covered, and this is what I have planned for. Now, one more thing I want you guys to please have in your mind before we get started with this marathon. Now, please don't watch this marathon like a web series, right? Just binge watching for entertainment purpose and all. Absolutely not. It will not work out. Now, I want you all to properly download the materials which I just showed it to you, or maybe have a hard copy with you. That's even more preferable, because you can do all the markings. That's even more better, right? And take out a pen, have a calculator, have all the required stationaries, and properly follow what I'm doing. And I want you guys to do this along with me, and that is the only way in which you get a proper learning experience. Clear with this, guys? Now, when I'm completing a particular question, I will ask you to write down something called as library of adjustments, right? So those who have already attended my lectures, be it exam oriented batch or my regular lectures, you guys will know what this is. I would have dictated this during our lectures. If you have that, please have the book with you, the library of adjustments with you, and follow the lectures. Trust me, this will be super effective, right? For those who have not watched my lectures, who have done self-study, or you have learned it from another faculty, absolutely fine. Even you can watch this marathon. Now, what you need to do is, now I will just, as and when we complete a particular question in this marathon also, I will be dictating a library of adjustment. Now, what is this library of adjustment? Now, it is something that you need to note down in this template. Chapter name, question number, page number, adjustment. Now let us say we are doing a chapter marginal costing. You should write down here marginal costing, right? Now in marginal costing, let us say I did question number 25. Example, I'm telling you, you write down question number 25. This question number 25 was present in page number, let us say 450. Example, I'm saying write down the solved question bank's page number. It's a cross referencing, and all these things you should write down. This adjustment I will dictate. What is this adjustment, sir? This adjustment is nothing but what we learnt in this particular question, and what are all the tricky areas which you need to definitely have in your mind while solving this question. Now, in our regular batch, I dictate this for every single question that you can see in your question bank, right? Because we do it fully in the classroom and I dictate it. In marathon also, for the limited sums we are doing, I am going to dictate this library of adjustment. Why? Because if you note it down like this, the day before your exam, if you want to revise, one look at this library of adjustment, you will know, okay sir, question number 25, it talks about this particular concept. For example, break-even point. You want to revise the concept of break-even point, open your library of adjustments. Now, all those question numbers which deal with break-even point, you will now be able to revisit it in a fraction of few minutes, right? This is the power of your note taking. And trust me guys, there have been a lot of students who have called me 5 p.m. after they step out of the exam hall, costing exam, after they come out of it. I'm not exaggerating, between 5 to 5:10, between this time I've got calls directly from the exam hall from students, and they thank me just for this library of adjustment. Now, it's not about thanking me. I only tell them, you thank yourself. You just followed this properly. Because I say this, some students follow, some do not follow. But those who followed have genuinely benefited out of this. So even in this marathon, I'll be dictating the library of adjustments. Please make sure that you note it down properly. Clear with this, guys? So these are some ground rules I want to set before we get started in this particular marathon, right? On that note, let's get started with this beautiful subject, cost and management accounting. So over to the first chapter of discussion. So now let's get started with the revision of one of the most important chapters called marginal costing, right? So now, before I get started with the revision of this particular chapter, there are a few things which I want to clearly mention before we start into this particular chapter. Number one, now this is a common chapter. Exactly the same chapter, marginal costing. The concepts are all exactly the same in your CA Inter cost and management accounting paper number 4. And in your CMA intermediate, there are two papers, paper 8 cost accounting and in paper 12 management accounting. Now, this chapter marginal costing, whatever we are going to learn in this chapter exactly is applicable in your CA Inter costing and in CMA intermediate paper 8 as well as in paper 12, whatever we are going to study. So this is a common marathon, right, or a revision video of this chapter marginal costing for both your CA as well as your CMA intermediate courses. But let me tell you one very, very important thing. Now, when it comes to all the paid courses, be it your exam oriented batch or your regular batch, now I have done separate recordings for CA intermediate, separate recordings for CMA intermediate. Even there, for paper 8, I have done it separately. Paper 12, I have done it separately. I'm talking about the paid courses, be it exam oriented or your regular batch, right? So I have done separately. This entire chapter has been done separately 3 times. Though the learning objectives, the concepts are all exactly the same. Now, this has been done strictly based on the respective institute study materials as well as the past exam questions and all of that. But when it comes to a marathon, for the purpose of marathon alone, I'm combining it so that the same marathon or a revision video will be useful across all the students. For all the students, they can use the same marathon purpose. So for marathon purpose alone, I am doing this particular chapter in a combined manner. Now guys, if you notice, I have listed out all the concepts which are applicable in this particular chapter: your income statement, profit volume ratio, break-even point, margin of safety, profit, cash break-even point, indifference point, volume analysis, sales mix, sensitivity analysis, limiting factor analysis, shutdown point, marginal costing versus absorption costing. These are all applicable for all the 3 subjects, that is one paper in your CA intermediate and both paper 8 and paper 12 in your CMA intermediate. This last concept, number 14, accept or reject of a special order. This alone is applicable for CMA intermediate paper 8 students alone. So I am pushing this to the end so that in case you are a CMA intermediate paper 8 student, you can watch this, else this part alone you can skip it, right? So clearly I have bifurcated in such a way that this is applicable for all the students. Exactly the same concepts are applicable for all the students, right guys? Fine. Now, one more thing I want to clarify. With respect to the books, right? We have a concept decoder book and a solved question bank, as you guys know. Now, for CA intermediate costing, we have a separate concept decoder, solved question bank. For CMA intermediate, paper 8, we have a separate concept decoder, solved question bank. And paper 12, we have a separate concept decoder, solved question bank. Every single thing is separate. Paid courses, your books, everything is separate. Marathon purpose alone, I'm combining for the benefit of all the students, so that because the concept is going to be the same, right? We will be covering, and in this marathon itself, I will be covering a few sums from your CA, few sums from your CMA. Now, do not think that, sir, then you are mixing the two, so CA students need not work out CMA questions, CMA students need not work out CA questions, nothing like that. These are all common questions. We are in a professional course, so if there is a particular concept, any which way they can frame the questions. So I am only doing things which are applicable everywhere. In case something is exclusive, I will clearly tell you it is exclusive. The last concept alone is exclusive for CMA Intermediate Paper 8 students. So this is also one thing which I want to clearly clarify before we get started into this particular chapter. Now, on that note, let's get started with this revision of marginal costing. Now guys, the first thing we will do here is with respect to the basics of this chapter. Quickly we will revise. Now I will be starting from the scratch. Now marathon, so I will be in the marathon itself, I will be constructing the formulas and all these things. It will be a super reviser for you, so that you will be in a position to appreciate all the concepts, and a few sums also we are going to do in the marathon itself. Now let's get started. Now these first 5 concepts, I call it as the basic concepts. Now we will understand this basic concepts, revise this basic concepts with the help of a numerical example. Now let us say that the selling price is 10 rupees, the variable cost is 6 rupees, fixed cost is 10,000 rupees, the volume is 6,000 units. Now with this data, we need to prepare an income statement, marginal costing income statement, calculate the profit volume ratio, calculate the break-even point, calculate the margin of safety, and calculate the profit. Now quickly let's get started here. Now solution. Now guys, first the marginal costing income statement format looks as follows. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now in this case, what is going to be my sales? How many units am I selling? 6,000 units I am going to sell, and every unit is being sold at a selling price of how much? 10 rupees. So which means overall my sales value is going to be rupees 60,000. Now what's going to be my variable cost? 6,000 units each at the rate of rupees 6. It's going to be how much? Rupees 36,000. Right? Now from your sales, if you subtract your variable cost, you get your contribution, or in other words, this contribution is nothing but your variable profit. Every time I sell a unit, I get a revenue of 10 rupees. I need to incur a variable cost. Means what? So only if I produce the next unit, I'll be incurring this cost, 6 rupees. Or in other words, every time you sell every unit, you get a variable profit of how much? 10 minus 6, which is going to be 4 rupees. So 60,000 minus 36,000, so gives you how much? It gives you rupees 24,000. Or I can also say this 24,000 is nothing but 6,000 units at the rate of rupees 4 each. Right? Now this 24,000, is this your final profit? No. Why? Because fixed cost is there, we have not yet adjusted that. So now from this, subtract your fixed cost of 10,000 rupees, you will end up with a profit of how much? 14,000 rupees. Clear with this, guys? Now guys, basically, now every time I sell one unit, I will earn a revenue of 10 rupees. For me to earn this revenue of 10, I need to incur a variable cost of 6, which means the variable profit is going to be 4 rupees, popularly called as contribution per unit, is going to be 4 rupees per unit. We know that, right? Now, why do we use the word contribution, sir? Now, we can rather use the word variable profit. Simple. Now, what happens? Every time I sell one unit, I earn a variable profit of 4 rupees. Like that, I keep on selling multiple units. Overall, now I've sold how many units? 6,000 units into 4. I have built up a total variable profit of how much? 24,000 rupees. Is this 24,000 rupees my profit? No. Now, what do I do with this 24,000 rupees? First, it contributes towards recovery of fixed cost. With this 24,000, I try to recover my fixed cost of 10,000 rupees. After recovering the fixed cost of 10,000, whatever is left over is called as my profit. Or in other words, this variable profit goes on to contribute towards recovery of fixed cost and then towards building my profit. Since it contributes towards two things, recovery of fixed cost and building your profit, we call this as a contribution. Clear with this, guys? So in this case, 10 rupees is my selling price, 6 rupees is my variable cost per unit, and then I can say the contribution per unit, short form is CPU. So contribution per unit is going to be how much? 4 rupees. 10 minus 6, 4 rupees. Clear with this, guys? Right? Now, this is how your marginal costing income statement looks like. So this is your A, marginal costing income statement. That's about it. Fine, guys. Clear with this? Next one. Let's move on to part B of the question. Now, in this part B of the question, what have they asked? Calculate the PV ratio. Now, very simple. Very simple. Now, let us say on a per unit level. Now, what is the format of your marginal costing income statement? Basically, it's sales minus variable cost gives you contribution, right? From that, minus fixed cost gives you profit. We know that. Now, on a per unit level, how much is the sales? Basically, my selling price is 10 rupees. My variable cost is going to be how much? 6 rupees, which means my contribution is going to be how much? 4 rupees, right? Or if you want it in value, for 6,000 units, we know that if I'm going to sell 6,000 units, my total sales is going to be simple. 10 into 6,000, 60,000 rupees, right? And my variable cost is 6 into 6,000, it's going to be 36,000 rupees. And my contribution is going to be 4 into 6,000, that's going to be rupees 24,000. Right, guys? Fine. Now, if I want to express everything as a percentage of my sales, or in other words, if I keep my sales as the base, and if I say, right, keep your sales as a base, that is going to be 100%. Now, if I want to express my variable cost as a percentage of sale, now can I say when my sales is 10 rupees, my variable cost is 6 rupees, or in other words, the variable cost is generally 60% of my sales. Yes, so 6 divided by 10 into 100. So can I say this is nothing but 60% of sales. So variable cost, if expressed as a percentage, I can say that it is 60% of my sales. Clear with this, guys, right? So this is called as variable cost ratio, BC ratio. What do you mean by variable cost ratio? Variable cost divided by sales into 100. Variable cost expressed as a percentage of sales into 100. Next, now I can also express my contribution as a percentage of sales. That is, contribution 4 rupees divided by 10 into 100. I can clearly say, so contribution expressed as a percentage of sales is how much? 40%. Now I can call this as PV ratio. What do you mean by PV ratio? Profit volume ratio. Are you clear with this, guys? Sir, why is this called as profit volume ratio? Basically, your contribution is nothing but variable profit. So your variable profit expressed as a percentage of sales is called as PV ratio. Are you all able to understand this? Yes. Now, guys, now always remember one thing. Your variable cost ratio plus your profit volume ratio will be equal to 100. Why? Obviously, your sales is made up of what? Your variable cost and contribution, right? If variable cost ratio is 60%, then obviously 100 minus 60, 40% will be my PV ratio. Now, this way you can easily approach any kind of question which has everything expressed as a percentage. Are you all able to understand? Or in other words, guys, profit volume ratio is nothing but contribution divided by sales into 100. Now, don't think this can be calculated only on a per unit level. Now, on a per unit level, it is 4 divided by 10 into 100. Suppose if you want to take at 6,000 units level, no problem. You can take 24,000 divided by 60,000 into 100. You calculate and see. So 24,000 divided by 60,000 into 100. Once again, you will get 40%. How, sir? Simple. Contribution 24,000. How did you get? Simple. It's going to be rupees 4 into 6,000 units, right? Divided by what is the sales? 60,000. How did you get? Rupees 10 into 6,000 units. Anyways, both the numerator and the denominator are multiplied with the same units. Effectively, you will get only contribution per unit divided by selling price per unit. Are you all able to understand? So the proportion will not change because both the numerator and the denominator are multiplied by the same number of units. Are you all able to understand? So literally you can say PV ratio is equal to contribution by sales into 100 at any given volume level, or a per unit level, or on a total level. Fine, guys. So this is your story about profit volume ratio. With this, we have also completed the second part of the question. Third part of the question, what is this? Calculate your break-even point. So point C is your break-even point. Now, by the way, guys, as I told you earlier, separately I have mentioned all these things in the concept decoder book of the respective subjects. So your CA Intermediate Costing, CMA Intermediate Paper 8, CMA Intermediate Paper 12. Everywhere, everything is mentioned separately. And in the question banks, all the questions with past examination, your study material questions, past exams, everything is covered here. Now, for instance, I will just open and show it to you. This is your CA Intermediate, your Paper 4. Cost and management accounting. Here everything has been neatly condensed and presented here, right? For marathon purpose, so I'm mentioning it in such a way that quickly you'll be able to recapitulate everything. Now similarly for paper 8, once again the separate chapter we have in a separate book, right? This is a separate book, in fact, exclusively for paper 8. And similarly for paper 12, if you see, so here paper 12 management accounting, once again it is chapter number 3. Separately I have mentioned everything. These are all different books. All these books you can download it from our website, right? So I've made it clearly applicable. I mean, I've bifurcated it separately in the respective books. Nothing to worry about that, right? Only for marathon purpose I'm merging it, just so that in a common recording every student will get a proper learning objective. Right, guys? So now let's move on to the next one, which is called as break-even point. Now what do you mean by a break-even point? It is that point of sale where you will be left with zero profit. That is, there is neither a profit nor a loss. The profit is not positive nor negative. It is exactly zero. Or in other words, how many units should I sell so that my profit is exactly equal to zero? Those number of units is called as break-even point. Now, guys, how will you compute this break-even point? Simple. Now, if I want to earn exactly zero profit, can I say it will happen at a point when my contribution exactly recovers my fixed cost and I am left with zero profit, correct? So I should be left with zero profit. When will you be left with zero profit? Only when your contribution exactly recovers your fixed cost, correct? Yes. So now can I say this break-even point happens at a place when my contribution is equal to my fixed cost. So we need to calculate how many units should you sell so that your profit is exactly zero. So, or in other words, at that point, my contribution will be exactly recovering my fixed cost, right? It will not recover more. If it recovers, I mean, if my contribution is more, then over and above recovering the fixed cost, I will be left with profit. If my contribution is less, I will not be even able to, I will not even be able to recover my fixed cost. Hence, I'll be left with a loss. So exactly it should be equal to your fixed cost. Only then you'll be left with a zero profit or loss, right? Now we need to calculate how many units should we sell. Now, can I say, let us keep the number of units to be sold as X. So now contribution is equal to nothing but the number of units to be sold. Let us keep it as X into every time I sell a unit, I know I will be earning a contribution of how much? 4 rupees. So can I say X into rupees 4 should be exactly recovering my fixed cost. how much is my fixed cost? In this question, they have clearly given the fixed cost is going to be 10,000 rupees. So exactly I should be recovering how much? 10,000 rupees. Or in other words, can I say X should be equal to rupees 10,000 divided by rupees 4. Or in other words, it's going to be how much? 10,000 by 4. We will say it is 2,500 units. So if you exactly sell 2,500 units, so 2,500 into 4, you will generate a contribution of 10,000 rupees. From that contribution, subtract fixed cost, which is 10,000. Exactly, you will be left with zero profit or zero loss. Or in other words, we can clearly say your break-even point is 2,500 units. How did we calculate? 10,000, which is nothing but fixed cost, divided by 4, which is nothing but contribution per unit. Or in other words, we can say the break-even point formula, if you want to compute that in units, is going to be fixed cost divided by contribution per unit. As simple as that. Clear for this, guys? Why do we need to mug it up? So simple and logical. Beyond this, there is nothing that you will need. Clear with this, guys? Yes. Now, suppose break-even point is nothing but point of sale. How many units? What is the volume I should sell so that my contribution exactly recovers my fixed cost? That's my break-even point. Now, this break-even point can also be expressed in values because it is sales. No, sales can be expressed in units or in values. Now, suppose if I want to find out the break-even point in value, how can I do that? Very simple. Similar thing. So break-even point is a point at which what? My contribution should be equal to my fixed cost. Correct? So it is a point where my contribution should be equal to my fixed cost. Now, how much is the fixed cost? 10,000 rupees. Now, can I say contribution is nothing but, one way of arriving at the contribution is number of units, X number of units into rupees 4 contribution per unit. Or can I say contribution is nothing but sales in value into PV ratio? For example, in this case, PV ratio was how much? 40% in this question. So this 24,000 was the contribution when my sales was how much? 60,000. Or in other words, can we say 60,000 into 40%? Can I say will be 60,000 into 40% will exactly be 24,000. So can I say another way of computing contribution is your sales in value multiplied by PV ratio. So now we can say here, we can keep this as sales in value, or in other words, I can say this is your required sales X in value. I'm putting a rupee symbol here into PV ratio should be equal to 10,000 rupees. Correct? Now, or in other words, X, that is sales, required sales in value into how much is my PV ratio in this question? 40% into 40% is equal to rupees 10,000. Or in other words, X in rupees or in value is going to be rupees 10,000 divided by 40%. Or this is nothing but how much is it? 10,000 divided by 0.4. You get how much? Rupees 25,000 is going to be my break-even point in value. Or in other words, guys, very simple. Now I can say if you want to calculate the break-even point in value, the formula is fixed cost divided by PV ratio. Are you all able to understand? Now, sir, logic for this. So 1 second, I will just put it here. Break-even point in value is going to be fixed cost divided by PV ratio. What is the meaning of this? If you generate sales worth 25,000, now what will happen? Sales is 25,000 in this case. So now what will be the contribution? 25,000 into 0.4. You will be exactly generating a contribution of how much? 10,000 rupees. Now from this 10,000 contribution, subtract your fixed cost 10,000, you will be left with zero profit or zero loss. Are you clear with this? Or in other words, another way of doing simple, sales minus variable cost gives you contribution minus fixed cost gives you profit. Now I want to calculate how much sales I should make, right, to exactly earn a zero profit or zero loss. So now your profit is zero. Now fixed cost is given. I need to recover 10,000 rupees, which means my required contribution is how much? 10,000 rupees. Correct? Reverse work. Right? Only if I exactly generate a contribution of 10,000, my fixed cost of 10,000 can be recovered and I'll be left with a zero profit. Right, guys? Fine. Now we know this PV ratio concept. Now if I generate sales of 100, my contribution is generally 40. That's the concept of PV ratio. We know that. Now, simple, if 10,000 should be equal to 40, how much should be 100? It is nothing but simple formula you can use mathematically. 10,000 divided by 40 into 100, or in other words, this is nothing but 10,000 divided by 40%, or this is nothing but this formula, fixed cost by PV ratio. Are you clear with this, guys? Logically you can arrive anything, and you will be able to clearly complete this chapter. Not even a single formula needs to be mugged up. That's the beauty of marginal costing. Right now, guys, mugging up in costing and in FM also, I'm telling you, not even a single formula in the entire subject should be mugged up. Right? Mugging up in our subjects is not even a sin, it's a crime. It's a crime. You should not mug up, because everything is so logical here. Now look at this. This is about the formula. Simple, guys. Break even point, if you want it in units, fixed cost by contribution per unit. Suppose if you want the same in value, denominator, instead of contribution per unit, you put it as PV ratio. Always remember this. If you want the answer in units, it is going to be contribution per unit. If you want the answer in value, put it as PV ratio. You will get it. Are you all able to understand? This is all about the logic, and all these things in detail I have just explained it in a neat manner in the concept decoder of the respective CA and CMA books. Separately, they are all mentioned. Clear with this, guys? That's about this area. So basically, what do you mean by a break-even point? It is that point of sale where your contribution exactly recovers your fixed cost and you're left with a zero profit or zero loss. That is all about this area of break-even point. Formula, if you want the break-even point in units, the formula is fixed cost by contribution per unit. If you want the answer in value, it's going to be fixed cost by PV ratio. As simple as that. Now let's move on to the next one, D. Let's move on to the next one, D. Now what is D? They have asked for something called as margin of safety. Now, how do you compute this margin of safety? Now, guys, very simple. Now, in this question, you guys tell me, overall, how many units have been sold? The example that I gave you. They have sold a total of 6,000 units, correct? Right. So they have sold a total of 6,000 units. So I'm keeping it here. The total sales made was 6,000 units. Right, guys? Fine. And what was the break-even point? The break-even point we just now computed. Let's put it in units. 2,500 units. So the break-even point was 2,500 units. Right, guys? So this is nothing but your break-even point. This is nothing but your total sales. Perfect. Now, what do you mean by margin of safety? Very simple. You've totally made sales of how much? 6,000 units. Now, if you sell 2,500 units, you generate a contribution that exactly recovers what? Your fixed cost, and you're left with zero profit or zero loss. Correct? Now, any sale that you make over and above your break-even point generates a contribution that goes on to contribute towards building your profit. Are you guys clear with this? So overall sales 6,000 units is broken up into two. First 2,500 units, it generates a contribution that is meant for recovering your fixed cost. Once entire fixed cost is recovered, whatever contribution you earn goes on towards building your profit. So the number of units sold over and above my break-even point is called as margin of safety. Now, in this particular scenario, how many units have we sold over and above the break-even point? So we have sold, literally, so 6,000 units minus 2,500 units. Literally, guys, in this case, we have sold 3,500 units over and above my break-even point. This is called as margin of safety. Clear with this, guys? Or in other words, total sales minus break-even point gives you margin of safety. Are you all able to understand this? Now, a very, very important thing that I'm going to tell you, I call this as marginal costing jodies. A very, very important understanding that you need to have. These are all basics of marginal costing. So once you strengthen this up, automatically the remaining part of the chapter will be easy for you to appreciate. Now, guys, first one. Now, let me just write on the format of this marginal costing income statement, sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, in this particular example, what was the total sales we made, right? 6,000 units into 10 rupees. How much was that? Rupees 60,000, right? What was the variable cost? Now, 6,000 units into 6. It was how much? Rupees 36,000. If you subtract the two, now, or in other words, what is the contribution? 6,000 units, each unit generated 4 rupees of contribution. So it's going to be 24,000, right? From this, subtract your fixed cost, 10,000 rupees. Literally, you are left with what? A profit of how much? A profit of rupees 14,000, right? Now, remember this for a lifetime. It's a very, very important understanding. Now, guys, the total contribution generated out of the total sales, that is 6,000 units, generated a contribution of how much? 6,000 units into 4. So the contribution generated by 6,000 units is nothing but the total contribution, 24,000 rupees. Are you all clear with this? So can I say my total sales is linked to my contribution, right? Next. Now, the contribution generated by the break-even point units, first 2,500 units, what was the contribution it generated? 2,500 into 4, 10,000 rupees, right? Or in other words, that is nothing but equal to your fixed cost, right? So, the contribution generated by break-even point is going to be equal to your fixed cost, right? Simple. Why? Because break-even point is nothing but that point where my contribution exactly recovers my fixed cost. Nothing less, nothing more. If it is less, then you will be having a loss. If it generates a more contribution, then you will be left with a profit. Exactly at 2,500 units, what you have is you generate a contribution equal to your fixed cost. Suppose I'm selling only 2,400 units, which means if I'm operating below the break-even point, the contribution that I would have generated would not even be able to recover your fixed cost. Suppose if I'm selling above my break-even point, it means after recovering the fixed cost, I have some extra contribution that goes on to build my profit. This way you can clearly analyze. Now over and above my break-even point, how many units have I sold? 3,500 units. The contribution generated by these 3,500 units now goes on to build my profit. 3,500 into how much? 4 rupees. 3,500 into 4. How much is that? 14,000 rupees. So this is going to be equal to my profit. Are you guys able to understand? Or clearly make a very important note of this. My total sales is linked to my contribution, right? Now my break-even point is linked to my fixed cost, and my margin of safety is linked to my profit. Are you all able to understand? So the contribution generated by total sales is going to be the total contribution. The contribution generated by break-even point is nothing but your fixed cost, and the contribution generated by your margin of safety is going to be called as your profit. Are you all clear with this? Now, one more very important thing. Now, these are all ideally your volume levels. This can be expressed in total values also. For example, 6,000 units. If you want to mention in units, it is 6,000 units. If you want to mention it in value, it's going to be how much? 6,000 into 10, 60,000 rupees. I can call this as 60,000 rupees, correct? Similarly, break-even point, sir, 2,500 units, sir. If you want to express this in value, 2,500 into 10, this is going to be 25,000 rupees, correct? Worth of sales. And margin of safety, 3,500 units. If you want to express this in value, it's going to be 3,500 into 10. It's going to be 35,000 rupees, correct? 35,000 rupees, right? Now, very simple, guys. Now, can I say my total sales, right, 6,000 units into contribution per unit gives me my total contribution, or my total sales into value into PV ratio gives me my contribution, right? Now you can calculate this. 60,000 rupees into 40%. Take your calculator and do. You get how much? 24,000 rupees. Or break even point. In units, break even point units into contribution per unit gives you fixed cost 2500 into 4 gives you 10,000. Or break even point, if it is in value, then use PV ratio into PV ratio 40%, 25,000 into 0.4, how much is it? 10,000 is equal to your fixed cost. Or margin of safety, similarly in units into contribution per unit, that is 4 rupees, you will get a profit. Or margin of safety into in value into PV ratio 40 percentage, you try and do, you will get what? Profit. Are you guys clear with this? Or in other words, total sales is linked to total contribution, break even point is linked to fixed cost, and margin of safety is linked to profit. The linking factor is what? The linking factor is ideally your contribution per unit, the contribution per unit, or you can also say PV ratio. It is contribution per unit or PV ratio. Sir, how? Or sir, if these are in units, if these three, the top figures are in units, then the linking factor is contribution per unit. If these are in values, the linking factor is PV ratio. Are you guys able to understand this? Are you guys able to understand this? Right? Now, coming to the discussion of margin of safety. Coming to the discussion of margin of safety. Now, guys, can I say margin of safety once again can be expressed either in units or in value, correct? Now, if you want to express this in units, now I can say simple, one formula is what? Total sales minus break even point, correct? In this case, how much is it? Sir, totally I've sold 6,000 units. Sir, break even point is how much? 2,500 units. How many units have I sold over and above the break even point? 3,500 units. Clear with this, guys? Next, another formula. Now, use this marginal costing Jodi's. Now, can I say margin of safety into contribution per unit gives me the profit. The profit generated out of these extra units only went on to build my profit, correct? So can I say margin of safety into contribution per unit is equal to profit? Or in other words, margin of safety is equal to profit divided by contribution per unit. Are you all understanding? This 14,000 rupees is a profit that I earned, right? By selling how many units? Sir, every time I sell one unit, I earn a contribution of how much? 4 rupees in our example. So how many extra units have I sold over and above the break-even point to generate this profit of 14,000 is the calculation. So another formula here is going to be what? It is going to be profit divided by contribution per unit. Are you guys able to understand? Every single thing is derived, right? In the marathon itself, I'm deriving so much. In our regular or exam oriented batches, it will be done with much more explanation and other things. Since this is revision, still I want to set the context and I'm doing it for you. Clear with this, guys? Because there might be some students who might not have listened properly, or maybe some freshers who have not at all attended the lecture. Since to set the context, I'm just giving all these explanations once again, so that the remaining part of discussion in this marathon itself will be very, very easy for you to understand. Clear with this, guys? Now, very simple. If you want the figures in value, margin of safety, once again, guys, so the formula, one of the formula is going to be total sales in value minus break even point in value. Look at this, total sales in value, how much was that? 60,000 rupees minus 25,000 rupees. If you subtract, you get 35,000 rupees, right? Or another formula is simple, use this formula, right? Profit divided by, now I want it in value, instead of contribution per unit, use PV ratio. One more jodi, no, right? So simple. So margin of safety 35,000 into PV ratio gives me my 14,000 rupees of profit, or profit divided by PV ratio gives me the margin of safety. Are you guys clear with this? So it is going to be profit divided by PV ratio. This is another formula for your margin of safety. As simple as that, guys. This is the power of conceptual learning. Beyond this, you don't need anything at all. That's all about it. That's all about it. Fine, guys. Now, that's about this particular area of margin of safety. Clear with this, guys? And finally, you can arrive at your profit. I think this profit has been arrived at. In this question, how much is your margin of safety? I think we've arrived 3,500 rupees, 3,500 units. Or if you want it in value, it's going to be 35,000 rupees. We have calculated all of that. And finally, guys, what is the thing they have asked for? So last one is arrive at the profit. Now guys, in your study material, so many formulas are there and students mug it up. No need to mug up formulas. Now, profit, what is the formula? Profit is equal to, one formula I can say, use the marginal costing income statement. Sales minus variable cost is contribution. Contribution minus fixed cost gives you what? Profit, correct? This is one formula. Another formula, use your marginal costing jodis. Can I say profit is equal to margin of safety units? Profit is nothing but the contribution generated by the margin of safety units, or in other words, your margin of safety units into contribution per unit. 3500 into contribution per unit is 4. This is also equal to your profit, right? So another formula we can say is profit is equal to margin of safety units into contribution per unit, or suppose margin of safety is given in value, multiply that with PV ratio. This way also you can arrive at the profit, right? In this question you look at it, what is the margin of safety in value? 35,000 rupees into PV ratio, how much was that? 40%. So 35,000 into 0.4, how much you get? 14,000 rupees. As simple as that. You can literally play around with the figures. This is the power of conceptual learning. Clear with this, guys? Just we spent some time and look at the variety of formulas we ourselves can arrive. That's about it. You need not mug it up. You need not mug it up at all. Clear with this, guys? So these are different variants of arriving at the the profit formula. That's about it. Now itself, if you notice, we have covered so many formulas, and the best part is that all these formulas on the spot you can derive and arrive it. You need not take the pain of mugging up anything. The formula construction, we spent about 35-40 minutes right now. With that itself, we are getting this much level of conceptual clarity so that you can arrive the formula by yourself. With this, any kind of sums in this basic level, you will be in a position to handle. Clear with this, guys, right? So that is about the basic concepts covered in this particular chapter initially. So with this, we have covered the revision of income statement, PV ratio, break-even point, margin of safety, and profit. Clear with this, guys, right? Now let us go on and cover one more small concept called as cash break-even point. Now guys, what do you mean by cash break-even point? Now let us take this particular example itself for discussion. Now all the facts are same. Only one small additional information. Here fixed cost is given. How much? 10,000 rupees. Now let us say out of this fixed cost of 10,000 rupees, right? Example, I'm telling you, depreciation amounts to rupees 2,000, which means what? The other component is your cash fixed cost. What do you mean by cash fixed cost? Basically the fixed cost which is incurred in cash. For example, your factory rent, that is an amount I need to pay, right? In cash, it's going to be balancing figure 8,000 rupees. Now your total fixed cost is bifurcated into two. Cash fixed cost, those components of fixed cost which are actually incurred and which needs to be paid to some third parties. Whereas your depreciation, this is also a fixed cost, but this is something that I set aside for my accounting purposes, right? Literally, I would have spent the entire amount, capitalized the value, and based on my period of consumption, based on the period of the life of the asset, I amortize, I apportion it, right? Now this is an amount I need not pay out by cash. Now, what do you mean by a break-even point? It is that point of sale. How many units should I sell to recover my entire fixed cost? Correct? Now in this question we saw, right, it was 10,000 rupees I want to recover, right? So every time I sell one unit, I earn 4 rupees. Literally, I need to sell 2,500 units so that I will be exactly able to recover this 10,000 rupees of fixed cost. This is what we saw. Now, cash break-even point means how many units should I sell to recover only the cash fixed cost? I need not recover the full fixed cost including depreciation. So how many units should I sell in order to recover this 8,000 rupees in our example of cash fixed cost? Or in other words, can we say cash break-even point is equal to cash fixed cost divided by contribution per unit, right? Now in this case, I want to recover a total of how much? 8,000 rupees, right? Every time I sell a unit, how much contribution do I earn? I earn 4 rupees, which means how many units should I sell? 2000 units. If you sell 2000 units, exactly 2000 units, each unit will generate 4 rupees of contribution. I will be able to pile up a contribution of how much? 8,000 rupees. From this, subtract your cash, this will be equal to your cash fixed cost. I'll be able to recover my cash fixed cost. Are you all able to understand? Now guys, clearly understand, at cash break-even point, you will not be having your profit equal to 0. You will be having a loss. Sir, how sir? Simple. I will give this particular table and you will be able to understand. Now guys, let us say, in our example we saw the break-even point was how much? 2,500 units. And we saw the cash break-even point right now we saw is how much? 2000 units. Now, at the cash break-even point, how much contribution you would have generated? You would have generated 2000 into 4, which is equal to how much? 8,000 rupees. However, from my contribution, subtract your fixed cost, 10,000 rupees. Literally, in this position, you will be left with a loss of how much? So, literally, guys, at 2000 units level, 2000 into 4, 8,000 rupees is going to be my contribution, minus entire 10,000 rupees of fixed cost. Literally, you will be left with a loss of 2,000 rupees. Correct? Whereas at the break-even point, full break-even point means what? It is so many number of units that I need to sell so that my entire fixed cost of 10,000 rupees is recovered. I am left with 0 profit, 0 loss. So here, literally 2000 into 4, 2500 into 4, 10,000 rupees the contribution minus fixed cost 10,000. I'm left with a profit or loss of exactly 0. Or in other words, guys, any point operating below the break-even point we know will give you a loss only. Right now, at the cash break-even point, I am selling so many number of units that is exactly able to recover only my cash fixed cost, which means I have still not yet recovered my depreciation. Or in other words, the profit or loss, in this case the loss at the cash break-even point level will be exactly equal to the depreciation, because that is the only amount which I have not yet recovered. Are you guys clear with this? So one small learning objective here, at the cash break-even point, I generate contribution that is sufficient to recover my cash fixed cost, which means I have not yet recovered my depreciation amount. Or in other words, at the cash break-even point, in this example 2000 units, I am left with a loss which is exactly equal to the unrecovered component of your fixed cost, which is nothing but your depreciation amount. Are you all able to understand? At the cash break-even point, the loss is equal to your depreciation, because that is the only amount which is not yet recovered. Are you guys able to get this? This is the concept of cash break-even point. Now literally guys, with this we have also covered this concept of cash break-even point. These are all the basic concepts which you definitely need to have in your mind, which you need to know before you can enter into the other areas. That's the reason why I'm giving you guys a background here itself. Right now, all these things I have clearly explained in our concept decoder book. If you open it neatly, a lot of efforts have gone into building these books, because these are, as I told you, these are separately available for CA Inter paper 4 cost and management accounting, CMA Inter paper 8 cost accounting, CMA Intermediate paper 12 management accounting. All the books are separate. All the books are separate, neatly done based on the respective study materials. I have done it, and accordingly all these explanations have been given here. Right, this example I gave you with an illustration so that you can understand. Look at this. Selling price per unit is equal to variable cost plus contribution. Correct? Sales minus variable cost is contribution, or contribution plus variable cost is sales. Any which ways you can play around. Contribution per unit is equal to selling price minus variable cost. Everything is explained here. Basic concepts here. So contribution per unit is selling price minus variable cost. Total contribution is sales into PV ratio, or you can say contribution per unit into units sold. You can play around, or sales minus variable cost, or you can say sales minus variable cost is equal to contribution minus fixed cost gives you profit. So contribution is equal to sales minus variable cost, or if you want to reverse work, you can say it is going to be fixed cost plus profit. So contribution minus fixed cost gives you profit. Now if this goes to the other side, contribution is equal to profit plus fixed cost. This way also you can write, literally you can play around everything I have mentioned here. The background logics is what I just taught you right now. Like this, every single thing, PV ratio, right? The formula, contribution by sales into 100, right? Required sales, we'll be doing it. Now all these things, literally, this is also something that we'll be covering in volume analysis. I will just come up right now. So every single thing, cash break even point, what is the meaning of that? Fixed cost divided by contribution per unit is your break even sales, right? If you want it in units, if you want it in value, it's divided by PV ratio, right? Now the break even sales, you can say it's break even units into selling price per unit. So cash break even point is nothing but cash fixed cost divided by contribution per unit or PV ratio, as the case may be, right? And I've also given this doubt buster clearly. Doubt buster basically is those areas which you can have a confusion. At the cash break even point, there will be a loss which is exactly equal to your non-cash expenditure depreciation. Every single thing literally has been mentioned here in the concept decoder book itself. Clear with this, guys? So there is nothing beyond this that you need. This is a very good way to actually, once you cover this conceptual explanation, you just go through it once, you will be able to have a full-fledged understanding the day before your exam. You just need to open your concept decoder and go through it once. You will be able to remember every single thing that I taught you. That is the biggest value addition, because all these things have been carefully designed. All the colorings and other things have been designed in such a way that you will be able to recollect all the important parts, whatever I've taught you during this lecture, when you are revising it. So this is a book which you can use both at the time of preparation, same book at the time of revision also. So I've removed all the unwanted content that runs into multiple paragraphs. We have used some AI tools and all to condense everything in a neat presentation manner. And if you notice, all these formulas are mentioned in a separate font, dark purple, right? So that the day before your exam, you can quickly revisit everything. Clear with this, guys? And the logic for all these things through our lectures is what we cover. Now just imagine in the marathon itself, I'm covering all these things. In our exam oriented or regular batches and all, it will be in a much detailed manner in such a way that we'll be covering so many sums also in the marathon revision. So little bit of sums here also I will cover, but all the sums in detail, all the chapters will be covering in our exam oriented as well as regular batches, right, guys? Fine. So with this, let us move on to the next concept called as indifference point. So indifference point. Now let's get started with this particular concept. Now guys, we will also do one numerical problem in this particular area, one high level question we will be doing. Now even in the marathon, still it's okay, we will do a high level question, because this will cover this entire concept of indifference point. But before that, quickly I will walk you through the concept of indifference point with all the formula explanation we will derive and see everything. So indifference point. Now guys, what is this concept all about? Quickly I will give you guys an example. Now long ago, right? So now don't think I'm talking about some previous generation, years and decades back. No, a few years back, right? Before 2016, right? Why sir 2016 specifically? That was the year when Jio came into this telecom sector. Before that, right, now there were multiple players in this telecom sector. Now they had this concept of prepaid, postpaid. It is still there, but it is not as vibrant as it was before, because Jio has come up with all this unlimited plans. So many people, they don't know the concept of prepaid, postpaid and all nowadays. That's why I started off with saying long ago, master stroke by the Reliance group of companies. Master stroke, they wiped off the entire market, and initially they gave all the SIM cards free of cost and everything, and people were actually making fun. They were thinking, why are these guys doing all this, right? And they thought in India people will use free of cost and then they will not buy. Slowly and gradually he introduced all this paid subscription into the market, and literally they swept off this entire telecom industry. Fine, the case study another part, maybe in a separate video I'll make. But right now let's take this example of telecom sector to understand the concept of this concept of indifference point. Now guys, let's say you have two models. One is called as prepaid, the other one is called as postpaid, right? Now in prepaid, generally what you have, in both the models you have a variable cost and a fixed cost. Let me take an example. Suppose if you are opting for a prepaid SIM, they will say, sir, monthly you should pay us a fixed charges of 100 rupees, right? What is this? This is going to be an amount which you pay them because they are retaining your number, mobile number. Variable cost, for every call you make, let us say you are supposed to pay them 50 paise, right? So which means if you're taking a prepaid SIM, flat 100 rupees every month, irrespective of your calls you need to pay, plus every call you make you need to pay them 0.5 rupees. Whereas if you're going for a postpaid plan, every month you need to pay them a fixed charges of 500 rupees. But the advantage here is every time you make a call, per call you need to pay only 30 paise, right? Now guys, prepaid plan, this is the cost model, 100 rupees flat every month plus 50 paise per call. Postpaid, 500 rupees every month plus 30 paise per call. Now you guys tell me, which is more beneficial? Which is more beneficial? Will I go for prepaid or will I go for postpaid? Out of the two, which one is the best? Now, you can't come up with a solution like always prepaid is best or always postpaid is best. Why? Because here we need to choose between two different alternatives, and in prepaid, the advantage is lower fixed cost. Instead of 500 here, it's only 100 rupees. Whereas in postpaid, the advantage is by way of lower variable cost. Instead of 50 paise, here it's only 30 paise, that is 0.3. Or in other words, both these options, alternatives, will have one advantage and one disadvantage each. In this case, you can't directly come to a conclusion saying one particular alternative is always better than another particular alternative. Are you guys clear with this? And this concept of indifference point will come into picture only when you are deciding to choose between either of the two alternatives. Between choice of multiple alternatives, only then will you have a concept of indifference point. By the way guys, this chapter goes on to achieve the objective of decision making. Here in this chapter throughout, we are going to take decisions, right? So that is the most important thing that you need to have in mind. Ideally, I should have told this before. This chapter has an objective of decision making, right? And by the way guys, now our subject, right, cost and management accounting, overall it has three objectives. One is your stock valuation and profit computation. The second objective is decision making. The third objective is control. Right now, this chapter helps you achieve the objective of decision making. Every single chapter has its own objective, either of the three objectives. This chapter has the objective of achieving your objective B, the second objective, decision making. However, in one area alone, that is in this concept called marginal costing versus absorption costing, we will also be seeing in this concept alone, it goes on to achieve the first objective, stock valuation and profit computation. This particular segment alone. Everything else in this chapter goes on to achieve your decision making objective. Now coming back here guys, now sir, prepaid is better or postpaid is better? You can't come to a conclusion like that, because each of these two alternatives have one advantage and one disadvantage each. Now but can I say there will be one point when both the alternatives will give me the same cost, same result. Now guys, you all think practically and tell. Let us say you are a missed call party, a conjuice party, right? So you will not make much of calls, you will only make missed calls. Literally, you want a phone number, for that only you actually subscribe to either prepaid or postpaid SIM, right? You will not make much of calls. If at all, you make only at emergency purposes, right? Beyond that, you will not make. In that case, you tell me, will you go for a prepaid SIM card or will you go for a postpaid SIM card? Now, clearly, you will go only for prepaid. Why? Sir, my volume is not less, so I need not commit 500 rupees. Prepaid, I need to commit only 100 rupees. If I make a phone call, only then 0.5 rupees I need to pay. Maximum, sir, my volume is very less, I will not make many phone calls and all. In that case, overall, your significant component of your cost is driven by your fixed cost, so you will go for that option that gives you a lower fixed cost. Generally, when your volume is less, you will go for that alternative that gives you a lower fixed cost. Suppose, let us say, now you are a businessman and you need to make a lot of phone calls every month. Now here you don't mind paying this 500 rupees, but every time you make a call, your volume is very high. Instead of paying 0.5, you just need to pay 0.30. So if your volume is very high, now overall cost comprises of fixed plus variable. If your volume is huge, then generally the variable cost will be actually the compensation of variable cost will be more. Hence, you will go for that alternative which gives you a lower variable cost per unit. In this case, if you are a person who makes multiple phone calls every month, you will go for a postpaid option because that will give you overall lower cost. Clear with this, guys? But there will be one point of volume where the total cost under prepaid will be exactly equal to the total cost under postpaid, and that volume at which the total cost under both the alternatives are equal is called as indifference point. Are you clear with this? Indifference point means what? I am not different to either alternate A or alternative B because both the alternative gives me the same result. The point of volume at which these two alternatives gives the same total cost is called as indifference point. Clear with this, guys? So now, how will I get this, sir? Simple. Let us keep this indifference point. Indifference point is nothing but volume as X. Now, what will be the total cost of prepaid? Can I say the total cost of prepaid will be 0.5x plus 100, correct? Now at the indifference point, this has to be equal to the total cost arrived under postpaid. What is the total cost of postpaid? 0.3x plus 500, right? Now take x on one side, I will say 0.5x. Now this comes to the other side, becomes minus 0.3x is equal to 500 minus 100, correct? So I have 500 here, 100 comes to the other side, it becomes minus 100. Clear? Now take x out in common. Can I say this is nothing but x into 0.5 minus 0.3 is equal to 500 minus 100, or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 rupees divided by 0.20. So 400 divided by 0.2 is equal to how much? 2000, right? 2000 units, or in this case it is not units, it is 2000 calls. Or in other words, if I am going to exactly make 2000 calls every month, then either if I go for prepaid or if I go for postpaid, both the alternatives will give me the same result. Clear with this, guys? Suppose your expected volume for the upcoming month is less than 2000 calls. If I am a person who is going to make less than 2000 calls, then I will go for that alternative. My volume is less, I will go for that alternative that gives me a lower fixed cost. I will go for prepaid. Suppose if my expected volume in the upcoming month is more than 2000 calls, right? In that case, I will go for that alternative that gives me a lower variable cost. I will go for postpaid at 2000 phone calls. In this case, what will I do? It is an indifference point. I am not different to either of the two alternatives because both the alternatives will give me the same result. Are you guys clear with this, right? This is the concept called indifference point. Or in other words, guys, how do we calculate indifference points? Very simple. Now look at this here, look at this. 500 minus 100 by 0.5 minus 0.3. So 500 minus 100 is nothing but difference in fixed cost, correct? This is nothing but difference in fixed cost divided by, now what is this? 0.5 minus 0.3. 0.5 minus 0.3 is nothing but difference in variable cost per unit. Are you all able to understand? Are you all able to understand? Or in other words, I will say indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. If I arrive at this, I will get what? The indifference point. Sir, with the help of indifference point, what can we do? Simple, guys. With the help of indifference point, let us say in this case, indifference point is 2000 calls. right? In this case, it is called, suppose if we are talking about a manufacturing company, it will be 2000 units, for example. Simple. With this, sir, what decision can I take? Simple. Now, sir, 2000 units is going to be your indifference point. Now, suppose in the next month you have your expected demand is less than 2000 units. What will you do? You will go for that option which has a lower fixed cost. Suppose in the upcoming month your expected demand is more than 2000 units, you will go for that option which has a lower variable cost per unit. Clear with this, guys? And sir, exactly it is going to be 2000 units. It is called as indifference point. Whether you go for alternative 1 or you go for alternate 2, in either of the two alternatives, it is going to give you the same result. In this case, I am going to make 2000 phone calls exactly. Whether I go for prepaid or I go for postpaid, it doesn't make any difference. Suppose I'm a person who is going to make less than 2000 phone calls every month, then I will go for prepaid option. Why do I go for prepaid option? It is the option which has a lower fixed cost. Whereas if I'm going to make more than 2000 phone calls, I'll go for postpaid option because it has a lower variable cost per unit. So I'll go for postpaid here. Are you all able to understand this, right? So just if you calculate this indifference point, one look at the expected volume for the upcoming month, now upcoming period, you can say, sir, I'm going to make 5000 units, sir. Go for postpaid. Why? Lower variable cost per unit, right? Over and above my, it is lying below, it is lying beyond my indifference point. Sir, I'm going to sell only 500 units, sir. Go for prepaid. One look at the volume, you can directly say which alternative is going to be better for you, and the deal breaker here is going to be your indifference point. For that purpose only, we have computed this indifference point. Are you all clear with this? How do I compute indifference point? Difference in fixed cost divided by difference in variable cost per unit. I proved this formula and showed it to you. As simple as that, guys. You need not even mug this up. Clear with this, guys? So by one look at the expected output for the next period, you will be able to clearly tell which option is going to be working out for you. Are you all able to understand this? Yes. Now, sir, now in this case, if you notice, here we have 100 rupees of fixed cost. Here we have 500 rupees of fixed cost. Right? Now, out of these two alternatives, which one has a lower fixed cost? Obviously, your prepaid. Correct? And here the variable cost is 0.5, here the variable cost is 0.3. Out of these two alternatives, which has a lower variable cost per unit? Absolutely postpaid. Clear with this, guys? So if my volume is more, right, I will go for postpaid. More means what? Beyond 2000 units, 2000 calls, right? If my volume is less, what do you mean by less? That is, my expected volume is only less than 2000 phone calls, then I will go for prepaid. One look at this itself, you will be able to understand. For example, if I am going to make 1000 phone calls, lies below indifference point, prepaid will be better for you, right? If you want, you can check and also calculate. So 1000 phone calls means how much will be the total cost under prepaid? 0.5 into 1000, that's going to be 500 plus 100. It's going to be how much? 600 rupees will be the total cost under prepaid. If I go for postpaid, how much will that is that going to be? It is going to be 1000 into 0.3. That's going to be 300 variable cost. Fixed cost is how much? 500. Overall, it's going to be 800. Clearly, if you notice, now your prepaid is cheaper than postpaid. Why? Because the expected volume lies below your indifference point. Like this, you can take one example of, let us say, 3000 phone calls and try. Obviously, postpaid will give you a lower cost than prepaid. There you will say postpaid is better. So here, now, there is no one best alternative. It depends on the volume. It's all about the volume game in this entire chapter. Clear with this, guys? So this is the concept of indifference point, where you can calculate it using this formula: difference in fixed cost divided by difference in variable cost per unit. Now let me add one more extra information here. With that one more formula we can cover for this indifference point. Let us say I am running a call center, right? And let us say ICICI Bank has hired me, right? I run a call center. ICICI Bank has hired me and they have told, right? Now, I will give you one database which has a list of all the phone numbers of almost all the citizens in this country. Now, your duty, the call center's duty, is to call every person and disturb them. Ask them whether they want credit card, debit card, whether they want to open a bank account, loan account, whatever it is, right? Now, what ICICI Bank tells me is that, or HDFC Bank, whatever bank it is, they are telling me for every phone call you make and disturb, I will pay you 1 rupee. Clear with this, guys? Now, they are not bothered whether me, the call center, is using a prepaid or a postpaid SIM card. Clear with this, guys? This is the scenario. Now, in this scenario, how will the cost figures look like? Now, guys, we have what? Prepaid plan. We have postpaid plan, right? Now, you guys think and answer whether I use a prepaid SIM or I use a postpaid SIM. How much is the amount I will be getting from the bank? 1 rupee. This is the selling price. We are calculating this from the perspective of the call center, right? Now, whereas how much will be the variable cost? If I use a prepaid SIM, we calculated the variable cost was slightly higher, 0.50. Whereas postpaid SIM, it was only 0.30, correct? Now, how much is going to be the contribution per unit, or in other words, contribution per phone call? Here we'll say one phone call is 1 unit. Here, if I use prepaid, it's going to be 0.50. If I use postpaid, it's going to be 1 minus 0.3. It's going to be how much? 0.70. Clear with this, guys? Now, how much is the fixed cost? Now, sir, if I use a prepaid SIM, the fixed cost is only 100. Whereas, if I use a postpaid SIM, how much is going to be my fixed cost? My fixed cost is going to be 500 rupees. Are you clear with this? Now, in this case, which alternative is better? Same situation. Now, option A, that is your prepaid, has an advantage. What advantage? Lower fixed cost. Whereas postpaid, what advantage it has? It has a higher contribution per unit. Are you all able to understand? Now, guys, this is nothing but lower variable cost results in higher contribution per unit. No, because my selling price was the same. Selling price minus variable cost gives me contribution. Postpaid had a lower variable cost, which in turn resulted in a higher contribution per unit. Agreeing with me on this? So literally what I can say, prepaid has an advantage of lower fixed cost, postpaid has an advantage of higher contribution per unit. Which is better? You can't directly say like that. Then you need to compute your indifference point. In this case, once again, guys, if your volume is lesser, you will go for that alternative which has a lower fixed cost. If your volume is more, you will go for that alternative which has a higher contribution per unit. But there will be one point where the profit under the first alternative will be equal to the profit under the second alternative. This point of volume is called as indifference point. Now, in that case, the profit under two alternatives should be equal, right? So now let's compute that. Now, how do we do it? Simple. Let's take the volume as X. In that case, tell me what will be the profit under prepaid plan. The prepaid plan profit is going to be 0.5x, correct? Contribution 0.5 into X is the number of units which we need to compute, indifference point, minus contribution minus fixed cost 100 rupees, right? That's going to be the profit under first alternative should be equal to 0.7x. This is going to be the contribution under the second alternative minus 500 rupees, right? So now what we need to do? So now we just need to take X on one side and the fixed cost on the other side, the values on the other side. So can I say this 500 comes to the other side, minus 500 becomes 500. So can I say 500 minus 100 is equal to 0.7x minus 0.5x. So here we have 0.7x and this 0.5 goes on the other side, it becomes a minus 0.5, right? So now how much will this be? How much will this be? So this is going to be, once again, I'll take x common out here. So I will say x the whole into 0.7 minus 0.5 will be equal to 500 minus 100, or in other words, x is equal to 500 minus 100 divided by 0.7 minus 0.5, right? Here literally x is equal to 500 minus 100 divided by, this comes to the denominator, 0.7 minus 0.5, right? So now I can say, or this is nothing but this is equal to 500 minus 100 is 400 divided by 0.7 minus 0.5 is going to be 0.20. So 400 by 0.2 gives me how much? 2000 units, or in other words 2004 calls. In this case, how did we compute? 500 minus 100. 500 minus 100 is nothing but difference in fixed cost. Correct? Is nothing but difference in fixed cost. And 0.7 minus 0.5, so 0.7, this is nothing but difference in contribution per unit. This is nothing but what? Difference in contribution per unit. Or in other words, I can say indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Are you guys able to understand? This is another formula for your indifference point calculation. See how logical it is. Now, sir, with this, what can you come to a conclusion? Simple. So now I have an indifference point. How much is my indifference point? It's going to be 2000 units. In this case, 2000 phone calls. If my expected volume is less than the indifference point, I will go for that alternative which gives me a lower fixed cost. If my expected volume is more than the indifference point, I will go for that option which gives me a higher contribution per unit, or in other words, lower variable cost. Because of lower variable cost, you will have a higher contribution per unit, because at the end of the day, selling price minus variable cost is only contribution per unit. If your contribution is less, if your variable cost is less, contribution will be more. As simple as that. Clear with this, guys? In this case, under the first alternative, lower fixed cost, hence I will go for prepaid plan. So if I am a person who is going to make less than 2000 phone calls, go for prepaid. That will always give you the highest amount of profit. Whereas if you are a person who makes more than 2000 phone calls, go for the option which has a higher contribution per unit, which is nothing but your postpaid plan, because that will give you the highest amount of profit. Are you guys clear with this? And at exactly, if you're going to make 2000 phone calls, whether you go for prepaid or you go for postpaid, both will give you the same amount of profit. Are you guys able to understand? This concept is called as indifference point. So two formulas we saw here. What are they? Indifference point is equal to difference in fixed cost divided by difference in variable cost per unit, or it is nothing but difference in fixed cost divided by difference in contribution per unit. Clearly understand, difference in variable cost, how much is it? 0.5, 0.3. The difference is how much? 0.2. And the difference in contribution, how much? 0.5, 0.7. How much is it? 0.2 only. So obviously, when my selling price is the same, the difference in fixed cost, the difference in variable cost is equal to difference in contribution per unit. Are you guys clear with this? Here, my contribution was 0.5, 1 minus 0.5. Here, what is the contribution? It is 1 minus 0.3. How much is it? 0.7 rupees. Clear with this, guys? Now, literally, why did this happen? Simple. From the same 1 rupee, here I'm subtracting 0.5, here I'm subtracting 0.7. So literally, this difference in contribution per unit of 0.2 is clearly because of this difference, variable cost difference, which is 0.2. So literally, guys, the difference in variable cost is equal to difference in contribution per unit when my selling price is the same. Clear with this, guys? That's why it can be calculated using two different formulas: difference in fixed cost divided by difference in contribution per unit, or difference in fixed cost divided by difference in variable cost per unit. Are you guys clear with this? So why do we use this indifference point? At the indifference point, you can use either of the two alternatives, but if your expected demand or the volume is less than the indifference point, go for that option which gives you the lower fixed cost. Always mention the advantage, right? If your expected volume is more than your indifference point, go for that option which gives you lower variable cost per unit, or you can say, in other words, higher contribution per unit. Are you guys able to understand? This is all about the concept of indifference point. Now, with this in mind, let us go and do one numerical problem. This sum is as per our CA intermediate. It is in our CA intermediate. I have kept it in our solved question bank. This is very much applicable even for CMA paper 8 and paper 12 students. You guys can also use it. It is not something out of syllabus. Absolutely. If there is something that is not applicable, I will clearly tell you. So here, the reason why I'm merging the marathon is because this is very much applicable for you guys. Right? That is the reason why I'm doing it. But please remember, all our courses and all are separately recorded. Even P8 and P12, I don't merge. Every single thing is separate only. Clear with this, guys? On this note, please take our solved question bank. This is in volume 2. This is our solved question bank looks like. This is CA intermediate solved question bank. So you can download all the materials I'm using here. You can download it from our website free of cost. All these things are available, right? In case you want a hard copy, that you can buy. We are just recovering whatever is the printing cost and the courier cost and other things. But if you want, you can even download this free PDF and use it. Now, please take this question number 12. It's on page number 412. It's in the volume 2. So please take this question. Right. So now, let me just read this question. It's a high-end question, high-level question. With this question, the entire concept of indifference point can be covered very, very easily. Now, guys, what are they saying? The following are the cost data for 3 alternative ways of processing clerical work for cases brought before LC court system. There is a court like magistrate court or high court. They are saying there are 3 different ways in which they can process some clerical work. Some files are all coming, so they need to process the files. So there are 3 different ways in which they can process the files. One is called as a manual way. Then the second option is called semi-automatic processing. The third one is fully automatic. 3 different alternatives are there. Now, what have they given? Particulars: monthly fixed cost, occupancy, maintenance contract, equipment lease. Now, if I'm going for manual, there is only one fixed cost, 15,000 rupees. Second alternative, if I'm going, I have 15,000 plus 5,000 plus 25,000. 3 different fixed costs I have. So literally, what is the total fixed cost? Let us keep this as alternative A. We will keep this as alternative B. We will keep this as alternative C. Each of the 3 alternatives tell me how much is the fixed cost. Manual, that is alternative A, fixed cost is 15,000 rupees. Alternative B, how much is the total fixed cost? 15 plus 5, that is 20,000. 20 plus 25, it's going to be 45,000 rupees. Right? So it's going to be 45,000. And alternative C, fully automatic, 15 plus 10,000 plus 1 lakh, it's going to be 1,25,000. This is going to be what? The total fixed cost under the third alternative. Fine, guys. Now, they have also given us the unit variable cost. 1 unit is 1 report. Clear with this, guys. Now, per unit or per report, what is the variable cost? Here, there are 2 different variable costs here. Supplies, labor. Simple, add the 2. Alternative 1, my variable cost is going to be 40 plus 200. How much is this? 240 rupees is my variable cost. Alternative 2, 80 plus 60. How much is it? 140 rupees. And alternative 3, 20 plus 20. How much is it? 40 rupees. Clear with this, guys. Now, what we need to do, for every alternative, we have the total fixed cost, total variable cost. Like that, for each of the 3 alternatives, we have the fixed cost, variable cost. Now they're asking, calculate the cost in different points and interpret your results. And part number 2, if the present case load, which means the number of files, is 600 cases and is expected to go up to 850 cases in the near future, select the most appropriate option, that is alternative, on cost consideration. They are saying, if I have a total of 600 cases, 1 case is 1 unit. So 600 cases means which is the best alternative. Suppose if I'm going to have 850 cases or 850 units is going to be the volume, in that case, which is better? Now, guys, first of all, in whatever I have taught you till now, we have seen clearly indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit. Sir, we had only 2 alternatives, sir, but in this particular question, if you see, we have 3 alternatives. How can we do this question? Now, simple, guys. Always remember, indifference point calculation can be solved only by taking 2 alternatives. In this case, what we need to do, we need to take 2 different alternatives at a time and take up all different combinations. For instance, first, A and B. Calculate indifference point of A and B. Then calculate indifference point of A and C. Then calculate indifference point of B and C. Right? So 3 different indifference point we need to calculate. AB, AC, BC. 3 different indifference point. First we need to calculate. And once we calculate this, then we need to interpret the results. Clear with this, guys? Now, the first part of the question is fairly simple. Calculation of indifference point. So AB, AC, BC, three different indifference points we need to calculate. Once we calculate this, then sir, we will be having three different indifference points. With this, sir, what do we do? Right, I will tell you what needs to be done. Clear with this, guys? Let's quickly do this particular question here. Let's quickly do this particular question. Okay, the solution is given here, but anyways, I would like to do this question in detail. So it's going to be let me just put it up here. This was question number 12, right? So question number 12 from our CA intermediate. Right, guys? Now, so first let me list out the options we have. Option A, option B, option C. That is your manual, semi-automatic and fully automatic. Then you have variable cost and you have fixed cost. How much was our variable cost? Now I'm just putting it up here. It was rupees 240, rupees 80 plus 60 was 140, and then rupees 20 plus 20, it was 40, right? Just now we calculated all of this, 240, 140 and 40. And about the fixed cost, 15,000, 45,000 and 1,25,000. I'm putting it up here. It was 15,000, then we had 45,000, and then we had 1,25,000, right? So I think this is what we had. Yes, 1,25,000. Now, what do we need to do? We need to compute the indifference point separately for each of the three different possibilities. AB first, then AC next, then B and C, right? In whichever order you want, you can calculate. So indifference point for A and B first I'm doing. Now, guys, we know the formula for indifference point. What is the formula for indifference point? It is basically difference in fixed cost divided by difference in variable cost per unit. So in this case, indifference point between A and B, difference in fixed cost, 45,000 minus 15,000. How much is the difference? It is 30,000 rupees divided by how much the difference in variable cost, 240 minus 140. How much is that going to be? 100 rupees, right? Divided by rupees 100. So how much does it come out to? 30,000 divided by 100. Just remove two zeros. That's about it. It's going to be how much? 300 units. Clear with this, guys? Clear with this, guys? Basically, what is the meaning of that? Now, exactly at 300 units, or in this case, the court, if it gets 300 cases, whether you go for A or you go for B, both will give you the same result. Suppose if your number of cases is less than 300, go for that alternative which gives you a lower variable cost. Which one? This one. Right? Sorry, if it is less than your indifference point, you go for that alternative which gives you a lower fixed cost, which is alternative A. Suppose if your number of cases is going to be more than 300, you will go for that option which gives you a lower variable cost per unit. You go for alternative B. Are you guys clear with this? This is what we need to do. Yes, we will come back to that later. Next one. Next is indifference point calculation for A and C. Let's do this. Once again, indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Now, A and C. What is the difference in fixed cost? Here 1,25,000. Here you have 15,000. The difference 1,25,000, 15. How much is the difference? It is going to be rupees 1,10,000. Divided by how much the difference in variable cost? 240 here. You have only 40 here. The difference is going to be 240 minus 40, rupees 200. Or in other words, 1,10,000 divided by 200. How much is it? 550 units. Or in other words, 550 cases is my indifference point. If my expected volume is less than 550, right, you will go for that alternative which gives you a lower fixed cost. Go for A. If it is more than 550, go for that option which gives you a lower variable cost per unit, which is going to be option C. Clear with this, guys? This is the interpretation. Next, we need to calculate indifference point between B and C. This is the last alternative. What is this, guys? What is this? Here, once again, indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. We're talking about what and what? B and C. What is the difference in fixed cost? 1,25,000 and 45,000. How much is the difference? 1,25,000 minus 45 gives you 80,000, right? So it's going to be rupees 80,000 divided by how much is the difference in variable cost per unit? 140 minus 40 is going to be rupees 100. How much is this, guys? It's going to be 80,000 divided by 100. It is going to be 800 units. Clear with this, guys? What is the meaning of that? So if I'm planning to have an output of exactly 800, you go either for B or C. It doesn't make a difference. If your expected demand is less than 800 units, you go for that option which gives you a lower fixed cost. Which one? Go for B. If your expected demand is more than 800 units, go for that option which gives you a lower variable cost per unit. You go for C. This is the interpretation. Now, sir, I have three different alternatives, A, B, and C. Because of that, I have three different indifference points. Now, sir, with this, how can I arrive at a proper conclusion? Now, let me clearly put this on a line and clearly explain what it is. This explanation is not there in your study material also, but based on this only they have arrived at the answer. Now, look at this. Look at this, guys. Now, plot this on, let me plot this on a graphical presentation. The first indifference point is what? 300 units, right? So the first indifference point was at yes, 300 units. Perfect. The next indifference point happens at 550 units. Okay, let me put it up here. It's going to be 550 units. And the next indifference point comes in at 800 units. Let me put it here. It's going to come at 800 units. Now 300 units is the indifference point between A and B, correct? I'm plotting it here. This is between A and B, right? Next, 550 is the indifference point between A and C, correct? A and C. And 800 is the indifference point between B and C. Now, we have plotted everything on this graph. Now, clearly, let us settle the score. Now, sir, 300 units, at 300 units, exactly if my demand is going to be 300, you can either go for A or you can go for B, right? Now, if it is less than 300, now we are just talking about A and B, you will go for what? The one with a lower fixed cost, which is A, correct? So here I will say, if I'm going to operate at less than 300 units, I will go for what? A. More than 300 units, I will go for what? B. Correct? This is the meaning of that, because it has a lower variable cost per unit. B has a lower variable cost per unit between A and B. Next is the clash between A and C. At 550 units level, exactly 550 units, sir, either go for A or you go for B. But sir, below 550, now which one will you go? We're talking about what? A and C. Between A and C, if my volume is less than my indifference point, I'll go for that option which gives me a lower fixed cost. I will go for what? A, right? So here, less than this, I will go for A as per this indifference point between A and C. So more than 550 units, I will go for C. Why? Because between these two, A and C, it has a lower variable cost per unit. Next, the last indifference point, 800 units, B and C. Now, if my expected volume is going to be less than 800 units, I will go for that option which gives me a lower fixed cost. Between what? Sorry, this is between B and C. B and C. Which one has a lower fixed cost? This one, right? So I will go for B, correct? More than this 800 units, I will go for C because it has a lower variable cost per unit. So here I will say, go for B. Beyond this, you can go for option number C. Clear with this, guys? Now, this is how each of the three indifference point comes to a conclusion. Now understand one thing. What is the issue here? Less than 300 units, you have only one player. A. Always A is best. More than 800 units, always C is best. There is no problem here. The problem arises only in this region, that is between 300 units to 800 units. Why? Look at this. As per this indifference point A and B, more than 300 units they have nominated whom? Option B. Whereas, as per this indifference point between A and C, less than 550 they have nominated whom? A. Or in other words, between 300 and 550, which is better, B or A? As per this indifference point, they have nominated B. As per this indifference point, they have nominated A. Sir, which one is better, sir? There's a confusion once again. Correct? Right? Similarly, in this scenario also, as per this indifference point, more than 550, they have nominated C. Here, less than 800, they have nominated B. Which means, sir, for this range, should I select C or should I select B? This is one issue. There is a clash. Right? Now, how will I resolve this conflict? Very simple. Now, first guys, now for this range we will talk. Who are the nominees for this range? Right? B and A. Correct? The nominees for this range are B and A. Now guys, between B and A, whatever was a conflict was clearly clarified here only. Right? Between B and A, in this case this was nominated between A and C. Because of that, A came into this picture. Correct? Now once again we are having a conflict between B and A. Go down and check A and B, between these two guys, where the indifference point clarification happened here. Now clearly between A and B, we already found out anything beyond 300, B should only come. A should not interfere there because A's territory is below 300. Clear with this guys? Whenever you have a conflict on the top, go refer between these two where the indifference point was actually calculated. It is calculated here. Now what does this say? Sir, above 300 units, go for B, not for A. Hence what I will do in this case, so obviously A will not come in this area, only B will come into picture. Are you guys clear with this? Why this conflict was resolved in this scenario? Once again, don't create a conflict because of another indifference point. More than 300 units between A and B, only B should come. Sir, once again, because of another indifference point, A has come back, sir. No, this area is actually clarified by this fellow. Are you all able to understand this? So only B will come. Next, in this area, the conflict is clashes between where? C and B. So between C and B, where did we compute the indifference point? Where was this conflict resolved? Sir, C and B or B and C, it was actually resolved here, sir. Right? So once again, because of this indifference point, C got nominated here. But as per the indifference point between C and B or B and C, as the case may be, less than 800, if there is a clash between C and B, always B should only come because this conflict was resolved here. So less than 800 units, only B should be nominated. This was clarified as per the indifference point clash between B and C. So here what I will do, C will not come. In this case, once again, B is only selected. Or in other words, if at all you want me to build a range and tell me, sir, when to go for which alternative, I will clearly say this is the final conclusion. What we will say is, if your expected demand or the number of units, in this case, in the court, number of cases, if it is less than 300 cases, always go for option A. At 300 units or cases, you can either go for option A or option B. Now, this itself is not relevant because this entire place is ruled by B, right? Now, more than 300 cases up to less than 800 cases, it is always B. Clear with this, guys? Always, if you check, B will give you the least total cost. At 800 units or 800 cases, you can either go for B or C because both of them will give you the same cost. Now, if your number of cases or volume is more than 800 units or 800 cases, C, it's better to go for C because that will always give you the best, least possible cost. Are you guys able to understand? So in this question, a high level question, why we calculated 3 indifference point and there were a clash between multiple indifference points. So we also saw how to resolve this conflict. Are you guys clear with this? So this is the one line summary of this particular area, of this particular question: volume and decision. If your expected volume is less than 300 units, go for A. If your volume is exactly equal to 300 units, you go for what? You go for A or B. If your volume is, I'm putting my volume here, if your volume is greater than 300 units but less than 800 units, right? Then look at this. I'm talking about this range. Sir, 550 will not come. No. What is the point of keeping 550 here? Because less than 550 B, more than 550 once again B, so there is no point at all. So the conflict got resolved here. So this is never one threshold point at all for you. Clear with this, guys? This entire place is ruled only by one particular alternative B, so it's going to be B. Now if your volume is exactly equal to 800 units, you come here, it is either B or C. And if your volume is expected to be greater than 800 units, always go for this particular alternative. Clear with this, guys? Clearly, if you build the range now, you just name your expected output that will give you the least possible total cost. Clear with this, guys? So with this, one look at this range itself, you will be in a position to come up with the correct answer out of the three alternatives, sir. Which one is best? Directly you can say. Now in this question, what have they mentioned? In this question, at present, they have a caseload of how many units? 600 units or 600 cases. Go back here and check here. So 600 means, where does it fall? It falls in this range. 600 falls more than 300 but less than 800. Clearly option B will give you the least total cost. You yourself can check and calculate. Clear with this, guys? The answer will be that. Look, this is what they have done. Less than 300 cases, it is A. Ideally it's not correct fully, because at 300 it is either A or B. They have not computed the indifference point. The second one, if you see, 300 to 800 only they have taken. In between we had this 550 that was not considered. Many students are struggling to understand, sir, why, sir, this is also an indifference point. The conflict resolution is not clearly mentioned in the study material. Final answer they have just given, but clearly understand this is how it needs to be done. Clear with this, guys? Right? So look at the range. 300 is one threshold. The next threshold is only 800. Right? And after that, so it's going to be less than 300, at 300, greater than 300, less than 800, at 800, above 800. Clear with this, guys? So now in this particular question, your answer lies between 300 to 800. Hence option B, alternative B, will give you the least total cost. Clear with this, guys? So it gives you the least total cost. Present caseload is 600, therefore alternative B is best. That's all. Answer is done. That's all you need to write. Suppose, sir, our cases are expected to go up to 850 units. In that case, which one will you go? 850 means above 800. You go for alternative number C. Clear with this, guys? Have a look at this. You go for alternative number C. Clear with this, guys? That's about it. So this is what they have mentioned. As the number of cases expected to go up to 850, alternative C is more appropriate. One look at this range table, you will be in a position to clearly say, sir, this is the output. This is going to be the best alternative for you. If you want, you can check and compute out of the three alternatives, whichever alternative I'm telling you as the answer will give you the least possible cost. Clear with this, guys? But in your study material as well as in your past exam searched answers, directly they have given this range. Many students struggle to understand how to build the range. Clearly, I've told you right now, this is how you need to build the range, by resolving the conflict. Are you guys clear with this? Right? With this, we have completed this particular question. So this I wanted to cover. This is applicable even for CMA students. Please don't think it's not applicable for you. It's a high-end question, one single question. I'm handpicking certain comprehensive questions. I'm doing it so that your entire revision is going to be super comprehensive. So please go and update your library of adjustments. Write down. Please give the cross-referencing and all. Write down indifference point hyphen calculation of 3 IDPs for 3 different alternatives, semicolon, range building. So calculation of 3 indifference points for 3 different alternatives, semicolon, range building. We saw the conflict resolution, how to build the range and all that. A very good question to revise this entire concept of indifference point. It has been coming in a lot of exams, past exams as well, both in CA as well as in CMA intermediate level. Clear with this, guys? So with this, we have finished this particular question, and with this we have also quickly revised this entire concept, right? Not quick, in fact we've done in a very elaborate manner as well. Now with this we are done with the concept of indifference point. Now let's move on to the next concept called as volume analysis. Now what is this concept all about? Quickly, I'll just give you guys an example, and with that we will also revise this particular concept of volume analysis. So volume analysis, what is this about? The explanation, everything has been neatly mentioned here. Volume analysis and all, clearly I have mentioned separately. Indifference point, look at this volume analysis. Whatever is the formula mentioned, all these things are here. But how do you arrive? What is the underlying concept here? This is there in our concept decoder for you to understand the logic. I'm quickly recapitulating here. In our courses, we do it in a much more elaborate manner. Since this is a revision, there is a time constraint. Even here, I'm trying to maximize out of the limited time available. Let's quickly get started here. Now, guys, let me just take an example. Our signature style of learning, always we take up examples that, even the complicated things can be easily understood. Now, let us say our selling price is 10 rupees, right? Your variable cost is going to be rupees 6. Your fixed cost is going to be rupees 10,000. Just an example, right? Now, I'm going to prepare an income statement for two different levels of output. First, I'm going to prepare an income statement for 5,000 units of output. Then I'm going to prepare another income statement for 7,000 units of output, right? Now let us take this example. Now what's your format of income statement and marginal costing? Come on, tell it along. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now what's going to be your total sales? 10 rupees per unit. So 5,000 units means sales of 50,000, and 7,000 units means 70,000 rupees of sales. What's going to be a variable cost? 6 into 5,000, that's going to be 30,000. And here it's going to be 6 into 7,000, that's going to be 42,000. Right? Next, what's going to be a contribution? It's going to be what? 10 minus 6, 4 rupees is the contribution per unit. So 4 into 5,000, it's going to be 20,000. And here it's going to be how much? So 4 into 7,000. It's going to be 28,000, right? Or you can even say 70,000 minus 42,000. That way also you can arrive. It's going to be 28,000. Next one, fixed cost. In both the cases, it's going to be 10,000, 10,000. Right, guys? Now, what's going to be the profit here? 20,000 minus 10,000, going to be 10,000. And here it's going to be 28 minus 10. It's going to be 18,000. Sir, this is something we know, no, sir. Why are you doing this particular example? I mean, why are you giving all this scenario? Now, one small observation. At 5,000 units level, how much was the contribution? 20,000 rupees. At 7,000 units level, how much was the contribution? 28,000 rupees. My contribution has increased by how much? 8,000 rupees. Correct? My contribution has increased by how much? 8,000 rupees. Now, or in other words, this contribution increase 8,000, right? Now, if you carefully observe, at 5,000 units level, what was your total profit? 10,000. At 7,000 units level, how much was your total profit? 18,000. Now, guys, in this case, your profit has increased by how much? 8,000 rupees. Conclusion, can I say? The difference in profit is purely on account of the difference in contribution. Agreeing with me on this. Sir, overall, my profit increases purely because of the increase in contribution. Absolutely. What do you mean by profit? Contribution minus fixed cost. Here, fixed cost has not changed. So clearly the change in my contribution is exactly equal to the change in my profit. Are you guys understanding this? Or in other words, can I say the change in profit is exactly nothing but the change in my contribution. Sir, this 8,000 rupees, sir, why it has increased? There's nothing but the contribution. Increase in contribution. Sir, why has my contribution increased? Because, sir, now I am not selling 5,000 units, I am selling 7,000 units. Or in other words, here I have increased my volume by 2,000 units. Or in other words, the contribution pertaining to this 2,000 units is only the increase in my profit. Are you all understanding this? So guys, one small summary here. The increase in profit is purely on account of increase in contribution. Why is there an increase in the contribution? Because there is an increase in the volume. So contribution per unit remains to be the same, but your overall volume will, because the overall increase in the volume, sir, for every unit I'm earning a contribution of how much? 4 rupees. Now from 5,000 units, now I'm jumping to 7,000 units level extra. How many units have I sold? 2,000 units. Every unit extra gave me a 4 rupees of contribution. So 2,000 into 4 extra contribution. How much I earned? 8,000 rupees. That extra contribution itself adds to my profit. Are you guys able to understand this? Are you guys able to understand? Sir, why are we doing this, sir? Why are we doing this, sir? Simple. The difference in profit is nothing but the contribution generated out of the difference in the units, a difference in the volume. Are you agreeing with me on this? If you know this, the entire concept of volume analysis can be mastered. Suppose in exam, they have not given all this data. They have only given you the top line and the bottom line. Sir, what is this, sir? Example, in your exam, they have just given you the scenario, right? They have just given you volume, right? And they have given you, let us say, for example, they have just given you volume, profit. Now, how much is the volume? 5,000 units volume. What is the profit? 10,000 rupees. Now, next, if your volume is 7,000 units, your profit is going to be 18,000 rupees. In exam, let us say this is all they have given. They have asked you to compute the contribution per unit, the fixed cost. This is all they have asked. Or in other words, they have asked you to prepare income statement for 10,000 units volume level. Sir, nothing has been given in this question. How can we calculate? Simple. What you can do is simple. My profit is how much? 10,000. At how many volume? At what volume level? 5,000 units level. If I increase my volume by 2,000 units, my profit increases by how much? 8,000 rupees. Or in other words, the 8,000 rupees, the delta profit, the difference in profit is nothing but the difference in contribution. Or in other words, this 8,000 rupees is nothing but the contribution generated out of this incremental units of 2,000 units. Or in other words, can I come to a conclusion and say contribution per unit is equal to difference in profit? It is called as delta profit. Delta means what? Difference divided by difference in units, that is volume. Correct? In this case, how much is the delta profit? The difference in profit is how much? So from 10,000 it has increased to 18,000, which means 8,000 rupees is the extra profit, right? This is the contribution generated on account of increase in volume. How much is the difference in volume? 2,000 units. Or in other words, can I say 8,000 rupees is the contribution generated out of 2,000 units. How much is the contribution generated per unit? 8,000 divided by 2,000. This is rupees. 8,000 divided by 2,000. It is going to be how much? Rupees 4 per unit. Are you guys able to understand? Now you got the contribution per unit. Right? With this, you can calculate your fixed cost. Sir, how can we calculate the fixed cost? Simple. We know the marginal costing income statement. Sales minus variable cost is equal to contribution. So we can say, look at this. Contribution minus fixed cost gives me profit. Take any one volume level. Sir, 7,000 units volume level you want to take. Simple. At 7,000 units volume level, what will be the contribution? Just now we computed the contribution per unit. So 7,000 into 4. How much is that? So 7,000 into 4 gives you So it's going to be 48,000. All right. So you get 48,000. Sorry, 7,000 into 4 gives you 28,000. So sorry guys, 7,000 into 4 gives you 28,000 minus fixed cost gives me what is the profit at 7,000 units level? 18,000 rupees. Right? So how much the fixed cost? This goes to the other side. I will say fixed cost is equal to 28,000 minus 18,000. It's going to be how much? It's going to be 10,000 rupees. Are you all able to understand? So now with this, we calculated the contribution per unit, we calculated the fixed cost. With this, at any volume level, you can prepare the marginal costing income statement. Suppose they are asking you the question for 10,000 units level, how much is going to be your overall profit? Simple. You just say contribution minus fixed cost gives you profit. What is the contribution? So 4 into 10,000, 40,000 minus fixed cost. Just now we calculated 10,000. You get a profit of how much? 30,000. Clear with this, guys? That's all. So they had just given us the total volume. They had just given us the total profit for two different volume levels, the top line and the bottom line. That is just the top line and the bottom line. If they've given, you can prepare the entire marginal costing income statement for any output level. For this, you need to understand the concept called volume analysis, where here we found out the contribution per unit is equal to delta profit divided by delta units. Sir, why sir this logic? No need to mug up. The delta profit, the difference in profit is nothing but the difference in contribution, and that difference in contribution of 8,000 rupees is nothing but the contribution generated out of the extra units, difference units, that is 2,000 units, which means per unit how much the contribution. We calculated the contribution per unit. With that, we can do all the other calculations and arrive at the fixed cost. Are you guys able to understand this? Are you guys able to understand? Suppose in this question, right, the sales, instead of volume, they have given it in value. Example, I'm telling you, suppose in this question they had given the sales in value, right? So the sales in value here, 5,000 hints of 5,000 units, they have given 50,000 rupees. The profit is 10,000. If my sales is 70,000 rupees, the profit is going to be 18,000. Suppose this data alone they had given. Now what you need to do, very simple. So instead of contribution per unit, I can calculate the PV ratio here. So can I say PV ratio is equal to delta profit divided by delta sales in value. Clear with this, guys? So I can say simple, this 8,000 rupees is the contribution pertaining to the incremental sales. How much was the incremental sales here? So 20,000 rupees of incremental sales. From 50 it became 70,000, right? So 8,000 rupees is the contribution pertaining to a sales of how much? 20,000 rupees, which means in this case, how much is the PV ratio? I can say the PV ratio is simple, 8,000 rupees divided by 20,000 into 100. It's going to be how much? It's going to be 40%. Are you guys understanding this? You can just play around with the figures. You can literally play around with the figures. So here we saw two formulas. One, contribution per unit is equal to delta profit divided by delta volume, sales in units, or PV ratio is equal to same formula, only instead of units you use sales in value, delta profit divided by delta sales in value. Are you guys able to understand this? Are you guys able to understand this? That's about this area. Fine, guys, clear with this? Similar thing you can also do on the cost side. On the cost side, literally the same question they can also give you, right? 5,000 units, 7,000 units are there, right? I will just put it up here. Let us say in the question, this is all they have given, right? So I'll mention it here. Volume and cost. Volume and cost. So what are the two different volumes we have? 5,000 units, 7,000 units, and let us say they are just given cost 40,000 rupees, right? Sir, at 5,000 units level, the total cost is 40,000. At 7,000 units level, the total cost comes out to 52,000. Now, in this case, they are asking us to find out how much is the variable cost, how much is the fixed cost. Will you be in a position to calculate? First, you tell me, is this a fixed cost? No. Why? Had it been a fixed cost, it would have remained constant in total, right? Is this a variable cost? Let us check. Now, variable cost, what is the behavior pattern of variable cost? It remains constant on a per unit level. So 40,000 divided by 5,000, how much you get? It's going to be 8 rupees. Whereas 52,000 divided by 7,000, you get how much? 7.4 something. So literally this is not constant on a per unit level. This is also not constant in total, which means it's a semi-variable cost. It has one component of fixed, one component of variable in it. Now in this case, how will you calculate? How will you arrive at the fixed component, variable component? Very simple, using this formula. Variable cost is equal to difference in total cost divided by difference in the total units. Right, sir? How will we do that, sir? Simple. Whatsoever, if I was selling 5,000 units, what was my total cost? 40,000 rupees. Now, if I increase my volume by 2,000 units, my overall cost increases by how much? 12,000 rupees. Now, why does my cost increase by 12,000 rupees? This cost comprises of variable plus fixed. Now, the increase in cost is purely on account of the variable component, because fixed component will not increase my total cost. Right, now can I say this 12,000 rupees is nothing but the variable cost pertaining to this extra 2,000 units, right? Or in other words, how much the variable cost per unit? 12,000 divided by 2,000. This is the variable cost for the extra units of 2,000, which means on a per unit level, how much is it? Delta cost by delta units. Here I will say it is nothing but how much the delta cost here. So the difference in cost is going to be 12,000 rupees. The difference is in units is going to be 2,000 units. It's going to be 12,000 divided by 2,000 units. You get how much? It's going to be rupees 6 per unit. Right, now with this you can calculate the fixed cost. So now how much will your fixed cost be? Simple, take any one volume level. From there, the total cost minus the variable component is going to be your fixed component. So the total cost minus variable cost gives you fixed cost. Now take any one volume level. 5,000 units volume level will take, what is the total cost? 40,000. From that, subtract your variable component. How much the variable component? 5,000 units into 6. So 5,000 into 6 is 30,000. So 40,000 minus 30,000 gives you how much? A fixed cost of 10,000 rupees. Are you guys able to understand? So literally guys, the variable cost is nothing but variable cost per unit is equal to delta cost, difference in total cost, divided by difference in total units. Are you guys clear with this? Are you guys clear with this? Suppose the same thing goes here. The volume, if it is not expressed in units, if they have expressed this in sales, right? If they had mentioned this in sales value, let us say this is going to be rupees 50,000 and this is going to be rupees 70,000. Let us say they had mentioned, when my sales is 50,000 rupees, my total cost is 40,000. When my sales is 70,000 rupees, my total cost is how much? 52,000. In this case, what I will say, sir, this extra 12,000 rupees of variable cost is something that I incur because my sales has increased by 20,000 rupees. Or in other words, this 12,000 rupees is the variable cost attributable to the sales of how much? 20,000 rupees. Or in other words, 12,000 by 20,000. Here you get variable cost ratio. Are you guys able to understand? So here I can say VC ratio is equal to delta cost divided by delta sales in value. Are you all able to understand? This study is called as volume analysis. What we are doing for a change in volume, we are analyzing for the change in volume, the impact it has on your profitability or your cost side. Are you guys clear with this? Literally guys, how did I arrive at this figure? 5,000 units, total cost is 40,000. How did I arrive? Simple. I took the total variable cost plus fixed cost, I added it up and I put it here. Similarly, 7,000 units, what is the total cost? 42,000 plus 10,000, it becomes how much? 52,000. Suppose in exam only this data is given, will you still be able to calculate and do all the workings? Yes, that is what I have just taught you right now. So if you just have the top line and the bottom line, you will be in a position to crack this entire area. So these are all the formulas which we saw here. PV ratio is equal to delta profit by delta sales, or contribution per unit is equal to delta profit by delta units. On the cost side, variable cost ratio is equal to delta cost, difference in total cost by difference in sales value, or variable cost per unit is equal to delta cost divided by delta units. The formula is mentioned here, the logic for that, literally we learned with the help of this particular example. Any sum that comes in this area, you will be able to handle it. Clear with this guys? And that is all about this particular concept of volume analysis. Simple, neat, and that's about it, guys. Beyond this, you need not take the pain of mugging up anything, right? This is once again a common concept in your CA Intermediate as well as in your CMA Intermediate, both in paper 8 and paper 12, right? So with that, we have finished this particular concept of volume analysis, right? So this particular concept is also now over. Now let's go ahead to the next concept called as sensitivity analysis, right? So first we will complete the sensitivity analysis and then we will come back to sales mix. Now guys, this sensitivity analysis, what does this talk about? What does this segment of discussion deal with? Now guys, if you notice in this chapter as of now, we talked about 4 different types of input. That is, there are 4 different factors which can affect our profit. What are these 4 factors? Simple. Selling price, variable cost per unit, right? Then fixed cost, obviously in total, and finally your volume, right? There are 4 different factors which can affect your overall profit, right? Now, which can affect your overall profit. Now, we have studied how these 4 factors impact my profit through certain tools like PV ratio, right? Your break even point, your margin of safety. Literally, guys, this is a summary of what we have learned till now. Literally, marginal costing is all about studying how these 4 different inputs can impact your profit through these 3 tools called as PV ratio, break-even point, and margin of safety. Now, in this concept, sensitivity analysis, what we are going to revise is that now, keeping the out of these 4 variables or the inputs, let us say I am keeping these 3 inputs constant, I don't change it. Suppose if I increase or decrease my selling price alone, keeping my variable cost per unit, fixed cost and volume unchanged, how is it going to impact my profit is the study called as sensitivity analysis, or in other words, the study of change in impact or the study of change in one variable while keeping the other variables constant and how it impacts my profit is called as sensitivity analysis. Literally, guys, this is what I would have mentioned even in our concept decode. Sensitivity analysis is a study of rate of change in one variable with respect to change in another variable, keeping the other variables constant. Sir, what is this? Quickly, I will just give you guys a practical flowchart and a practical case scenario. It's not a case scenario basically. So I will open up and I will show you a practical flowchart. With this, you will have a crystal clear clarity. Now, sensitive. What do you mean by sensitive? We say my friend is very sensitive. Means what? While other things being constant, suppose if one thing alone happens, how he or she reacts to that is called as sensitivity. Right here, let us say I don't change my variable cost per unit, I don't change my fixed cost, I don't change my volume. Suppose selling price alone, if I increase, how is it going to impact my profit? Will it increase or decrease my profit? We will study the impact of increase in selling price through the impact it has on PV ratio, break-even point, margin of safety. Suppose I keep the other 3 things constant, variable cost alone I increase, how it impacts my profit? This is a study of sensitivity analysis. Now, no problem. Let me just open this chart and show it to you. Now, we will do it together and this way, entire thing we will be completely finishing it off. Now, guys, now, what are the 3 tools that we study in this particular chapter? Basically, I told you PV ratio, break-even point, and margin of safety, right? Perfect. Now, one second. Yes. Now, look at this. Let us say I am keeping everything constant. Selling price alone, what I do, I am increasing. For example, let us take the same example which we saw. Selling price at present is 10, variable cost is 6, which means contribution per unit is going to be 4, right? Let us say my fixed cost is going to be 10,000 rupees. 10,000 rupees. Yes. In this case, what is going to be my break even point? My current break even point is going to be how much? 10,000 divided by 4. It is going to be 2,500 units, right? At present, my volume, let us say, is 6,000 units, which means at present, my margin of safety is how much? 6,000 minus 2,500, which is going to be 3,500 units. This is my current data which I am presenting it to you. Now, let us say I don't change my variable cost per unit, which means my contribution is also remaining. My contribution will not change because of variable cost. Fixed cost I'm not changing. Let us say the total volume I'm not changing. Selling price alone, let us say I am increasing. Now, what happens to my PV ratio? At present, what is the PV ratio? 4 by 10 into 100. 40% is my current PV ratio. Example, suppose if I change my selling price, if I increase my selling price to 12 rupees, variable cost continues to be 6, which means my contribution per unit becomes how much? 6 rupees, right? So now what is the PV ratio? 6 divided by 12 into 100. Obviously PV ratio becomes 50%, or in other words, if I do not change the other three variables, an increase in selling price will actually increase my PV ratio, correct? It will increase my PV ratio. Now, what impact will it have on my break-even point? Simple. Now, every time I'm selling one unit, right, obviously I am able to generate more contribution. In this case, now I will be able to recover my entire fixed cost quickly. Guys, clear with this, which means my break-even point will reduce. Are you guys clear with this? Right? So in this case, my break-even point will reduce. Why? Because I've increased the selling price. Every time I sell one unit, I will be able to generate more contribution, which means that in this case, now I will be able to recover the same fixed cost. Now, how much is the fixed cost? 10,000 rupees. Every time I sell one unit, I will generate 6 rupees. So literally, if you see 10,000 divided by 6, you get your break-even point is 1,666.66 units or 1,667 units. Earlier, it was taking me 2,500 units to actually recover 10,000 rupees. Now it only takes me 1,667 units to recover the same 10,000 rupees. Or in other words, every time I sell one unit, I recover more contribution, which means it takes lesser time for me to actually recover the entire fixed cost. My break-even point is less. It drops. Clear with this, guys? Now, what happens to margin of safety? Simple. My total volume remains unaffected, 6,000 units, but my break-even point is now reduced, which means the balancing figure, the number of units sold over and above my break-even point, it's obviously the balancing figure. So this will increase. Are you guys clear with this? So my margin of safety increases, and when my margin of safety increases, margin of safety is nothing but profit generating sales. Obviously my profit increases. Are you guys clear with this? So the impact of change in one variable, right? So what impact it has on my profit, we are studying through these three tools called as PV ratio, break-even point, and margin of safety. This study is called as sensitivity analysis. Are you guys clear with this? That's all it is, guys. So an increase in selling price, what will happen? So it increases my PV ratio. So now, because my contribution per unit will increase, now what happens? Since every unit gives me more contribution, I'll be able to recover the entire fixed cost quickly. So my break-even point will fall. Now, volume remains unchanged. Break-even point reduces. The balancing figure, which is basically my margin of safety, will now increase. And when my margin of safety increases, profit will automatically increase, because after all, margin of safety is nothing but your profit generating sales. Are you guys clear with this? Similarly, suppose there is a reduction in your selling price. In this case, what happens? Think and answer. Now, my selling price reduces. Let us say here, instead of 10 rupees, my selling price becomes 8. Variable cost continues to be 6, which means contribution per unit is 2 rupees, right? So now obviously my PV ratio falls. 2 by 8 into 100, which is 25% only. Obviously, guys, my PV ratio will fall. Now, what happens to my break-even point? Every time I sell a unit, now I'm generating lesser contribution. It means I will take more time to now break even. So break-even point increases. Now, what happens to margin of safety? Total number of units sold, volume is same, but break-even point has increased, which means now the balancing figure, margin of safety, will fall. And when my margin of safety falls, what happens to your profit? The profit also drops. Are you guys clear with this? That's all it is. That's all it is. Next, now let's go to the second variable. What is the second variable? The second variable is your variable cost. The second input factor is variable cost. Suppose other things remaining constant, I am increasing my variable cost. Visualize. Now, selling price is same. Variable cost I am increasing. If I increase my variable cost, what happens to my contribution per unit? My contribution per unit will fall. So when my contribution falls, obviously my PV ratio will fall. Clear with this, guys? Now, every time I sell a unit, I am generating lesser contribution, which means now it takes more time for me to recover the entire fixed cost. So break-even point will increase. Are you guys clear with this? Now, volume is same. Break-even point is more, which means the balancing figure, margin of safety, will fall. If my margin of safety falls, my profit will also fall. Are you guys able to understand an impact which a change in one variable has on my profit is studied through these three tools called as PV ratio, break-even point, margin of safety. This study or analysis is called as sensitivity analysis. Now you guys are getting it right. Now the other one, next one, suppose other things remaining constant, variable cost reduces. Now per unit variable cost reduces. In this case, what happens? Selling price remains the same, variable cost reduces, which means my contribution will increase. When my contribution increases, PV ratio will increase. Right now, every time I sell a unit, I'm able to generate more contribution, which means now I will be able to recover my entire fixed cost quickly. So my break-even point falls. Volume is the same, but my break-even point is less, which means my margin of safety balancing figure will now start to increase. So margin of safety is more. When my margin of safety is more, my profit will also increase. That's all, guys. That's all. It is very, very, very simple. Next one. Next one. Now, what is the third variable we've got? Fixed cost. Now, carefully think. Suppose other things remaining constant. Sir, selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost alone, let us say I am increasing. First, you tell me what will be the impact on PV ratio. What is PV ratio? Contribution per unit divided by selling price. Now, fixed cost I am increasing. Because of this, will my PV ratio change? Absolutely not. So with respect to my PV ratio, there will be no change at all. Now what happens to my break-even point? Sir, every time I'm selling one unit, contribution per unit remains to be the same. But suddenly fixed cost alone is more. Now break-even point is fixed cost divided by contribution per unit. Now in my break-even point, now what happens? The numerator, fixed cost has increased, which means I need to recover more amount right now. Obviously because of this, what happens? So now I take more time to recover because right now the fixed cost has increased. Are you guys clear with this? So my break-even point increases. Now what happens to total volume? Remains to be the same, but break-even point has now increased, which means the balancing figure, margin of safety, now reduces. Are you guys clear with this? This is all it is. Now, exactly the opposite of this. Suppose my fixed cost falls down. What will happen in this case? If my fixed cost falls down, now what happens to PV ratio? No change, because PV ratio is nothing but contribution divided by sales, right? Contribution per unit divided by selling price. This will not, fixed cost will not impact my PV ratio. But what happens to my break-even point? Now I need to recover only lesser amount as fixed cost, which means now the break-even point will fall, because now by selling lesser number of units, the entire fixed cost can be recovered. Volume is same, your break-even point is reduced, which means now the balancing figure, margin of safety, will increase. When my margin of safety increases, my profit will automatically increase. Are you guys clear with this? The last one, which is your volume. The last one, which is your volume. Now, other things remaining constant. So selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost in total, I'm not changing. Volume alone, I am increasing. Now, think and answer. What will happen to PV ratio? Absolutely no change. Why? Because obviously PV ratio is what? Contribution per unit divided by selling price. Now, on a per unit level, the contribution is not changing. Right? My selling price is not changing. Even variable cost is not changing. Obviously here, the PV ratio will remain unchanged. Guys, correct? Now, what happens to my break-even point? break even point is fixed cost divided by contribution per unit. Now fixed cost is not changing, contribution per unit is also not changing, which means even my break even point will not undergo a change. But now, wow, what happens to my margin of safety? Now, volume alone has increased right now. Let us say now, instead of 6,000 units, I am selling 8,000 units. Now, what happens? Now, what happens, guys? Break even point remains to be the same 2,500 units, but volume alone has increased, which means the balancing figure, margin of safety alone increases. Are you guys clear with this? In this case, your increase in volume will only impact what? Your margin of safety, and because of this, automatically you will be able to generate more profits. Are you guys clear with this? This is all it is. Suppose my volume drops, what will be the impact on PV ratio? Absolutely nothing, right? Break even point, nothing. Why? Break even point is fixed cost by contribution per unit, numerator denominator remains unchanged. What happens to my margin of safety? Now break even point is the same, but the total number of units sold is less. Because of this, the balancing figure, margin of safety, falls. Clear with this, guys? This is why generally they say if you sell more number of units, overall profit will increase. Why? Purely because break even point is a point. Anything excess sold in excess of the break even point is going to be margin of safety. So if the volume increases, margin of safety will increase. The volume decreases, margin of safety will reduce. Because of that, the profit will increase or decrease as the case may be. This will not impact your break even point and other things. Are you guys clear with this? This study is called as sensitivity analysis. If you put this arrow and study this entire area, you'll be able to master, and that's about this area, guys. Clear with this, guys? So literally what we have seen, your profit can be impacted by only these four variables, and what we have seen is a change in any one of these four variables will impact your profit, and we studied the impact of the change in any one of these four variables or inputs through PV ratio, break-even point, and margin of safety, and this entire study is popularly called as sensitivity analysis. As simple as that. Clear with this, guys? Now we will just go and solve one numerical problem. Once again, we'll be doing this from our CA Inter solved question bank. It's in volume number 2. So please go to question number 15A. Please go to question number 15A. I just want to take this. Yes. Right. Now look at this. This was, I think, I'm not sure if this was a past exam MTP question or an RTP question, but somewhere it was once asked. By noting PV ratio will increase or PV ratio will decrease or PV ratio will not change as the case may be, state how the following independent situations will affect my PV ratio. They are asking independent, they have asked about 10 scenarios, right? In each of the scenario, just they have asked for the impact on the PV ratio, nothing more. Conceptually you learn, please do not mug up anything, try to attempt it, and that's about this particular question. First, how will your PV ratio be affected? Will it increase or will it decrease or will there be no change? Right, this is what they have asked, right, in each of the following situation. Number 1, an increase in the physical sales volume. Now if I increase my physical sales volume, how will it impact my PV ratio? Now we all know PV ratio is nothing but contribution divided by, or contribution per unit divided by selling price, right? Now if there is a change either in the numerator or the denominator, only then PV ratio will change. Now first, an increase in the volume. Now tell me, will it impact my PV ratio? Absolutely not. We just saw an increase or decrease in the volume will only impact my margin of safety. Nothing else will be impacted, guys, correct? So in this case, what happens? An increase in the physical sales, it will not impact my, there will be no change. It will not impact what? It will not impact my PV ratio. Look at this. My PV ratio will not change. The ratio of sales value and the variable cost will remain the same irrespective of the change in the sales volume. Obviously, what happens? My numerator denominator does not change. Now, how will my PV ratio change? The next one. If there is an increase in fixed cost, will this change? Will this impact my Will this impact my PV ratio? Absolutely not. This will only impact your break-even point. When your break-even point gets affected, the balancing figure, margin of safety, will also get affected. Definitely, this will not impact your PV ratio. No change. Clear with this? Why? Because obviously here in the numerator or the denominator remains unaffected, right? Contribution per unit is not changing. Selling price per unit is also not changing, right? So obviously in this case, what happens is that your PV ratio will not change. Clear with this, guys? There will be no change. Next one, a decrease in the variable cost per unit. Now, if my variable cost reduces, what will happen? My contribution per unit will increase. Guys, clear? So, because of that, obviously my PV ratio will now start to increase. Clear with this? Now, look at this. PV ratio will increase. Are you guys clear with this? This is what we have studied in a chart format. Now, they're asking this. Easily, you will be in a position to answer. The next one, a decrease in contribution margin. Now, obviously, if my numerator reduces, contribution per unit reduces, what happens in this case? Obviously, my PV ratio will also fall. Look at this. PV ratio will decrease. Next situation, an increase in the selling price per unit. Now, if my selling price per unit has increased, what will happen? Because of this, contribution per unit will increase. If my contribution per unit increases, obviously my PV ratio will also increase. Now, look at the fifth one. PV ratio will increase. Then a decrease in the fixed cost. Fixed cost will not impact my numerator or my denominator. Hence, my PV ratio will not change. No change here. Question number 6, no change. Next, a 10% increase in both the selling price and the variable cost per unit. Now, in this case, now they are not changing one variable, they are changing two variable. How can you answer? You should take a scenario and do it. For example, selling price, variable cost, and then your contribution per unit. At present, let us say 10 minus 6 is equal to 4. What have they said? A 10% increase in both the selling price and the variable cost. 10% in selling price will be what? So 10 plus 1, it is going to be 11. Variable cost, 10% increase. What is this? 6 plus 10% of 6 is 0.6. So it's going to be 6.6. What will happen to the contribution per unit? So 11 minus 6.6 gives you 4.4. So what is the PV ratio at present? 4 by 10 into 100, it's 40%. Here it's 4.4 divided by 11 into 100. Once again, it's going to be 40%. Now, here what happens? There is no change when there is exactly a 10% increase in both the selling price as well as the variable cost per unit. You can take any one factor, any one figure, right here. Model data you can take, on that you can increment and apply the change and check it out. So here there will not be any change. Clear with this, guys, right? This is what you can just go ahead and update. Next one, a 10% increase in the selling price per unit and a 10% decrease in the physical sales volume. First one, understand here also two inputs are changing. One is an increase in selling price, the other one is increase in the volume. Now, first of all, understand, there is a decrease in the volume. Any change in the volume will not affect my PV ratio. So, the only impact here is on the selling price per unit. Clear with this, guys? Now, a 10% increase in selling price. What will happen here? Now, if my selling price increases by 10%, obviously my contribution will also increase, and because of that, my PV ratio will only increase. This will not have an impact on PV ratio. This will have an impact on profit. Here in this question, they have only asked for the impact on PV ratio. So my PV ratio will increase. That too, it's purely only on account of what? An increase in your selling price. So point number 8, look at this. PV ratio will increase. Clear with this, guys? The increase in selling price will increase the contribution margin, but the change in volume in any direction will not affect the PV ratio. You should write the reasoning in exam. How will you write it? Just visualize whatever chart which we did, and this is more than sufficient for you to crack these kind of questions, right? Thus, an increase in selling price will decrease your sales volume. With the decrease in sales volume will only increase your PV ratio. Anyways, decrease in sales volume will never affect your PV ratio. So the increase in PV ratio is purely on account of increase in your selling price. The next one, a 50% increase in a variable cost per unit with a 50% decrease in the fixed cost. First of all, understand, a change in fixed cost will not impact your PV ratio. it will impact your overall profitability by way of break-even point and all that. But here in this question, they have only asked for the impact on PV ratio. PV ratio will get impacted in this case only on account of change in the variable cost. Variable cost is increasing. So if my variable cost increases, selling price remains constant, contribution per unit will decrease. When my contribution per unit decreases, what happens? My PV ratio will also fall. So point number 9 here, PV ratio will decrease. Are you guys clear with this? Logically think and answer. That's all it is. An increase in the angle of incidence. Oh, what do you mean by angle of incidence? I will tell you. Very simple. This is actually presented in a graphical format. I will tell you here. 1 second. Now, look at this. This is basically your break-even chart, right? Where here on the y-axis you have rupees and on the x-axis you have the number of units. Now, simple. As you increase the number of units, this is your variable cost line. What is this variable cost line? Now, if I produce 0 units, variable cost is also 0. That's why it starts from here. If I slowly increase the number of units, parallelly my variable cost will also increase. Clear with this, guys? Right? Now, ideally speaking, here you have a fixed cost line. All these things you would have studied in your foundation or even in your school days economics. Fixed cost line is flat. It will not change with the number of units. Right? Let us say fixed cost is 2 lakh rupees, 200,000. Now, if I produce 0 units, still I will be incurring fixed cost alone. That's why your total cost basically is nothing but fixed cost plus variable cost. This line starts from here and it slowly increases, right? Here, this is your fixed cost line. Any increase in volume will not impact your fixed cost. So, your total cost alone, what happens? Increases because parallelly, your variable cost line is here. And parallel to this variable cost line, you will be having the total cost line because total cost is fixed cost plus variable cost. That's why it is running parallel here. Now, what we need to do here, this is your total cost line, basically your fixed cost plus variable cost. This is your sales line, right? Sales line, basically it starts from 0. So, if I don't sell any units, my revenue is 0. If I keep on increasing my units, obviously my turnover will also increase. Now, what happens, guys? This is going to be my sales line. This is going to be my cost line, total cost. Now, break-even point is a point where my total sales is equal to total cost. Only in that case, exactly I will be earning a profit of 0, right? So, this is my break-even point, right? Now, if you notice, this is going to be my sales line, right? Now, if you notice, below the break-even point, my cost is always greater than sales. This is the reason why you are reporting a loss. At the break-even point, my total cost is equal to total sales. Hence, there is a 0 profit or 0 loss. And above this break-even point, my sales, right, is greater than my total cost. Hence, above the break-even point, you are always making a profit. This is a graphical presentation. Now, from the break-even point to above, there is an angle that has been generated here, right? This angle is called as angle of incidence. Simple, guys. Now, if the angle is wider, obviously it means the difference between my sales and cost is more, or in other words, my profit is more. So, if this angle is more wider, let us say if the angle is like this, then what happens? The difference between my total sales and total cost will be more, and it indicates a more profitability. Or in other words, if there is an increase in the angle of incidence, my profit will increase. Are you guys clear with this? If there is a reduction in the angle of incidence, in that case my profit will reduce. So this is something that you need to understand in a graphical presentation. So now in this question, if you notice, they have asked what will happen, what will be the impact on PV ratio if there is an increase in the angle of incidence. An increase in the angle of incidence indicates that the company is earning at a higher rate, or in other words, there will be an increase in your PV ratio. This is all you need to know. Are you guys clear with this? This is once again logical, provided you know this particular graphical format, and as simple as that. So here we've seen, so my PV ratio will only increase if there is an increase in my angle of incidence. Angle of incidence represents the rate of profit earning after reaching the break-even point. Just now I taught you, right? And increase in the angle of incidence means the rate, there is an increase in the rate of profit earning, which is nothing but the PV ratio that contributes towards the profitability after recovering your fixed cost. Are you guys clear with this? So this is all about it. 10 different scenarios, right? We have just learned it. I mean, we have just revised all these things with a conceptual revision of sensitivity analysis. Now, for this particular question, I request you to please go and update your library of adjustments. So please go ahead and update, write down sensitivity analysis, hyphen impact on PV ratio in 10 different situations. In 10 different situations. An excellent question to summarize and revise the entire concept of sensitivity analysis. So this is once again logical. Now, please do not mug up. If you are a person who's been mugging this up, I've just proved it to you how simple and effective you can revise this entire area. We have studied conceptually. In fact, in the marathon itself, I have done one numerical problem, right? That's about it, right? In our batches, in our regular or EVO batches, we'll be doing a few more numerical problems. But here, since this is a marathon and I didn't want to miss this question also, so one full-fledged question we are solving, right? So with that, we have completed this particular concept of sensitivity analysis. So this particular concept of sensitivity analysis is now over. Now let's move. Sorry, there was an issue with the mic. So I'll just repeat this area again. So now we are going to get started with the next concept called as sales mix in marginal costing. Now, till now, in sensitivity analysis, we have learned that these four variables or inputs, namely your selling price, variable cost, fixed cost, and volume, these four variables or inputs will only impact your profit. A change in any one of these four inputs is only going to impact your profit. But now, in this next segment of discussion, which is sales mix, we will learn that ideally there is one more fifth input factor called as your sales mix, which will also impact your profitability. Now, let me take the heading here. Sales mix and marginal costing. Now guys, let me take an example of BMW. Now, as you guys know, BMW is in the business of manufacturing car as well as bikes, right? Now, let me take an example here. Now, I am taking 2 years. Let us say in the year 2025 and in the year 2026, right? Now, between these 2 years, BMW did not change the selling price of bike and car. They did not change the variable cost per unit of their products, bikes and cars. They also did not change the fixed cost. It was also constant. And for your information, the volume was also constant. That is, in the year 2025, they sold a total of 1 lakh units. This 1 lakh comprises of, let us say, 60,000 cars and 40,000 bikes. Now, in year 2026 also, they sold 1 lakh units. So here, the volume did not change, but the composition, that is the sales mix alone changed. Here, if you notice, they sold 40,000 cars and 60,000 bikes. So guys, if you notice here, selling price did not change, variable cost did not change, fixed cost did not change, even the total volume did not change, but the composition of the total volume, basically the sales mix alone changed. Now you tell me, the profit reported in 2025 and the profit reported in 2026 will definitely be different. Why? Sir, the 4 inputs we saw did not change, sir. Still, why was there a change in the overall profit? This was purely because of the change in the sales mix. Or in other words, sales mix represents the composition of the different products that the company is dealing in. Till now, whatever we have learned is all about a concept of all this marginal costing in case the company deals only in one product. But in real life, companies deal in more than one products. Now, in case when company deals in more than one product, in that case, there is a fifth factor which affects your profitability, which is called as sales mix, right? This is something that is very, very important. Now, guys, in this particular scenario, how do we apply the concepts of marginal costing is the study in this scenario called as sales mix. Now, the most important factor here is regarding calculation of break-even point. Now, guys, we all know break-even point formula. What is the formula to calculate break-even point? It is going to be fixed cost divided by contribution per unit, right? Now, there is a common fixed cost, right, that needs to be recovered by way of generating contribution, right? So fixed cost divided by contribution per unit. Now, let us say the company deals in 2 products, A and B. Now, in the denominator, should I take the contribution of product A or should I take the contribution of product B or should I jointly take the contribution of A as well as B is the study in this particular scenario. Or simply in other words, now there is a common fixed cost which is incurred, right, towards production on sales of 2 products. In our example, 2 products. A company can also have 3 products or any number of products. Now, this fixed cost has to be jointly recovered by both the products put together. In this case, how will you compute the break-even point? And all these things are the subject matter of discussion in this particular scenario. Now, without any further delay, now let's go and take up one numerical problem with the example of, with the help of this particular numerical problem, we will clearly be able to understand the concept of sales mix, and it's a good sum to revisit or revise this entire concept of sales mix, right? So now please go to your solved question bank, CA Intermediate Solved Question Bank, and please take question number 19. Question number 19. See, our question bank is comprehensive. Every single question from our study material, right, past exam, RTPs, MTPs, everything has been covered. Beyond this, you don't need any other thing, right, in your exam preparation. Beyond this, there is nothing more you need because everything I've compiled it in a single place, right? That 2 similar questions I've grouped and all. You can see the color pattern. For example, it is 18C. So 18 is the main question. A, B, C and all are questions which are similar to question number 80, something like that. So, right, so here you have MTP2, every single thing has been included here. So now please take question number 19. This is about your sales mix. Now, the following set of information is presented to you by your client AB Limited producing the 2 products X and Y. Now, what have they mentioned? Product X, product Y, right? Direct material, direct wages, the cost is given for each of the 2 products. The fixed expenses during the period was 1600 rupees, right? The variable expenses are allocated to the product at the rate of 100% of direct wages, and the selling price is given as 40 rupees and 30 rupees each, right? Now there are two products, X and Y. What is the selling price? 40 rupees and 30 rupees, right? Now, what is going to be my total variable cost? Now, for product X, literally, if you see, we have 20 rupees direct material, 6 rupees wages, and 100% of direct wages is variable overheads. So, another 6 rupees we have here. So, literally, 20 plus 6 plus 6 comes out to how much? 32 rupees, right? So, it's going to be 32 rupees is the total variable cost of product X. Similarly, for product Y, 18 material, 4 rupees is your direct wages, and 100% of direct wages, that is another 4 rupees is your variable overheads. If you add this up, how much you get? 18 plus 4 plus 4. So you basically get 26 rupees, right? This is going to be your total variable cost of product Y. So literally the contribution per unit of X is going to be 40 minus 32, 8, and contribution per unit of Y is going to be 30 minus 26, which is going to be 4 rupees. Right, guys? Now, 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 in this scenario, they have asked the proposed sales mix scenario number 1. Let us say they are selling 100 units of X, 200 units of Y. What will be the profit? Scenario 2, 150 units of X, 150 units of Y. What will be the profit? Scenario 3, 200 units of X, 100 units of Y. What will be the profit? You need to compute. The total fixed cost is 1600. Now, you tell me 100 plus 200 overall volume is 300 units. 150 plus 150 overall volume is 300 units. 200 plus 100 overall volume is 300 units. Here in these three scenarios, volume is not changing, but the composition mix alone we are changing. Clearly, because of that, what happens? Your profitability will change. Why? Because X is a more profitable product. 8 rupees contribution you get for every unit of X. Y you get only 4 rupees. So obviously in that mix, if you are selling more of units X, obviously the overall profit will be high. Are you clear with this? Right? This is how it works here. Right? So in each of these scenarios, you need to compute the profit. Nothing great. Number of units multiplied by the respective contribution per unit, you'll get the total contribution. From that, subtract your overall fixed cost, you will arrive at your profit. This is not the great thing. The most important thing is with respect to calculation of break-even point. Now, this also, the first part I will quickly do, and with that, this will be over. Now, look at this, the contribution per unit we have done. Suppose I'm selling 100 units of X, 200 units of Y. What will be the total contribution here? 100 into 8, I get 800, plus 200 into 4. How much is 200 into 4? That is once again another 800. So literally the total contribution will be 1600 minus your fixed cost, that is also 1600 rupees. So literally you will be left with a zero profit. Clear with this, guys? Right? So that is the first situation here. Look at this, 100 into 8 plus 200 into 4, that gives you 1600 rupees contribution minus fixed cost 1600, you get a zero profit. Suppose I'm selling 150 units of X, 150 units of Y. Simple, 150 into 8 plus 150 into 4. So 150 into 8 gives you how much? It gives you 1200 rupees, and 150 into 4 gives you 600 rupees. So overall, you get a contribution of, so 1200 plus 600 is going to be 1800. Minus your fixed cost of 1600, it gives you a profit of 200. See, the overall volume didn't change, but just because of the change in the mix, what happens? Your profit is changing. Clear with this, guys? This is not the big deal here. Now, the most important part is calculate the break-even point when the sales mix is 2:1. Now, in this case, now how will we actually calculate the break-even point? This is the most important part of calculation in this entire concept of sales mix. Quickly, we will revise. So now, what is going to be my sales mix? It is going to be 2:1. Now, each of the two products we have got here. Now, let me put it here. We have two products here. What are the two products? Product X and product Y. Now, how much is the contribution per unit of X? 8. Y is going to be 4. 8 and 4. This is going to be my contribution per unit. And what have they given? The sales mix is going to be how much? It's going to be 2:1. So the sales mix is going to be 2:1, which means what? Sir, every time you are selling 3 units, 2 units come from product X and 1 unit comes from product Y. So for every 3 units sold, 2 units are X and 1 unit is product Y. Clear with this, guys? Now in this case, we need to compute the break-even point. Now what is the formula for break-even point? Fixed cost divided by contribution per unit. Now in this case, will I take the contribution per unit of X or will I take the contribution per unit of Y? Ideally speaking, we should take the contribution per unit of both X and Y. Sir, how will we do that? Very simple. Now, you guys tell me 2:1 is the sales mix, which means for every 3 units sold, right? Now, can you tell me what is the total contribution? Simple, sir. If I sell 3 units, right, 2 units will come from product X, 1 unit will come from product Y. So, 8 into 2 plus 4 into 1. Are you clear with this? 8 into 2 units plus 4 into 1 unit. This will be the total contribution generated for 3 units. So on an average, the weighted average contribution per unit will be how much? Divided by 3. So this is the total contribution for 3 units. If you divide it by 3, on an average, what is the contribution per unit? You can calculate. Guys, clear with this? So how much does it come out to? So 8 into 2 is 16 plus 4 into 1 is 4 divided by 3. So 16 plus 4 is 20. So 20 by 3 comes out to how much? 6.6666. It keeps on going. Or in other words, you can also say, sir, this is nothing but weighted contribution per unit. Actually, we call it as weighted contribution per unit because in this case, this fixed cost is going to be recovered jointly by these two products. Hence, I will have to consider the contribution per unit of both the products. Hence, we don't take the contribution of X or we don't take the contribution of Y. We take the weighted contribution of X and Y. Or in other words, we can also say the weighted contribution can be calculated as follows. So what is product X's contribution per unit? 8. I can say 8 into 2 by 3, that is a sales mix, plus 4 into 1 by 3. This way also you can calculate. The same thing can be rewritten as 8 into 2 by 3 plus 4 into 1 by 3. Are you guys clear with this? This way also you can calculate and show it off, not a problem. Ideally, this is nothing but weighted contribution per unit. Now, in case when a company manufactures more than one products, ideally speaking, the formula for calculating the break-even point is nothing but fixed cost divided by weighted contribution per unit. Are you guys clear with this? So in this case, how much the weighted contribution per unit? 6.6666. So now in this case, you tell me what is going to be your break-even point? My break-even point is equal to how much is my fixed cost? My fixed cost is going to be 1600. We saw that. So rupees 1600 divided by what is the weighted contribution per unit? 6.6666. So retain the decimals in your calculator. So it's going to be 1600 divided by 6.6666. You get 240 units. So if I have a total volume of 240 units, I will be able to recover my entire fixed cost of 1600 rupees. I'll be left with no profit or no loss. Now you tell me, is this 240 units of X or units of Y? It is jointly units of X plus units of Y. Now what we need to do, this 240 units, split it into 2. So how many units of X, how many units of Y? We know the sales mix. Generally when the company is selling, they will always have the sales mix as 2:1. So which means, so 240 into 2 by 3 will be the number of units of X. 240 into 1 by 3 will be the number of units of Y. So 240 into 2 by 3, how much is that? It's going to be 160 units. 240 into 1 by 3, it's going to be 80 units. Or in other words, if I sell 160 units of X and 80 units of Y, I will be able to break even. That is going to be, I will be able to recover my entire fixed cost of 1600 and I'll be left with no profit or no loss. Are you guys clear with this? This is the way to compute your break-even point when you have sales mix, when you have more than one product for the company and the sales mix ratio is given. Are you guys clear with this? So when a company is having more than one product, in this case, how do we compute your break-even point? Break-even point is equal to fixed cost divided by weighted contribution per unit. How do you compute weighted contribution per unit? The respective contribution per unit multiplied by weight of that particular product. Are you clear with this? As simple as that. Or you can also say the total contribution divided by the total number of units in that particular mix. Are you guys clear with this? It's absolutely logical. Nothing needs to be mugged up here. And this is exactly what I've solved and showed here in this particular solution. Look at this. All these solutions I have improvised, right? So this is not as it is in the study material. It's not a copy paste. This entire question bank, we have revamped it, and literally the presentation also, just like how I've done here, I've presented it. So basically it's going to be 240 units. Ideally this is wrong. It has to be 240 units, right? So 240 units. So 2/3 and 1/3. Ideally, when the company sells 160 units of X and 80 units of Y, it earns zero profit. That's going to be your break-even point. Are you guys clear with this? Right? This is the most important learning objective here. Suppose if there is a change in your sales mix, accordingly, what happens? Recalculate the break-even point when the sales mix is 1:2. Very simple. Now, suppose it is going to be 1:2. Right? So what happens here? Instead of 2:1, it's going to be 1:2. Then what do you do? Recalculate the weighted contribution per unit. So weighted contribution per unit is equal to 8 into 1/3 plus 4 into 2/3. Correct? Because 1 is to 2 right now. Right? So 8 into 1/3 plus 4 into 2/3. Now once again, you need to compute. Quickly, let me do this here. Product X, product Y. What is the contribution per unit? Just now read it here, 8 and 4. So rupees 8, rupees 4. The sales mix is going to be 1:2, which means the weighted contribution per unit is going to be 8 into 1/3 plus 4 into 2/3. Alright, so how much is this going to be? 8/3 plus 4 into 2 is 8. So 8/3, right? Or another word is going to be 16/3. So 16/3 is going to be what? 5.3333. So here the break even point is going to be fixed cost 1600 divided by weighted contribution per unit 5.3333, right? So now here, how much is that going to be? 1600 divided by 5.3333, you get an overall 300 units. So if I sell 300 units overall, I will be able to break even. Now what is the breakup of that? X and Y. So X has to be, so 1:2, right? Overall X needs to be 300. One second. So X, number of units of X to be sold is going to be 300 into 1/3. Number of units of Y is going to be 300 into 2/3. So this is going to be how much? 100 units of X, and this is going to be how much? 200 units of Y. Or in other words, if I sell 100 units of X and 200 units of Y, I will be able to break even. This is how you need to arrive at it. Are you guys clear with this? So the most important part when it comes to sales mix is that the calculation of break-even point. So break-even point formula is going to be your fixed cost divided by weighted contribution per unit. And remember one more thing. Suppose in the question contribution is not available, PV ratio is available, I can say simply this is nothing but, so break-even point in sales value is going to be fixed cost divided by weighted PV ratio. As simple as that. If you want the figure in value, instead of contribution per unit, use PV ratio. Clear with this, guys? But that has to be a weighted PV ratio because you need to consider all the products for recovery of your fixed cost. As simple as that, guys. Clear with this? This is all about this particular question, and using this question we learned the concept of sales mix. The other part of the question is fairly simple, right? In fact, we have done that also, right? The most important part is with respect to calculation of your break-even point. So now please go and update your library of adjustments. Write down sales mix hyphen calculation of profit and break-even point in different scenarios. Calculation of profit and break-even point in different scenarios. right? That's about this concept of sales mix. Look at this. We can just knock off all these concepts without mugging up anything. That's the beauty of costing, guys. Trust me. Costing, FM, these subjects should never be mugged up. Mugging up is not even a sin. I told you it's a crime. So you should never mug up in these subjects and all. As simple as that. So here the break-even point is what? Fixed cost by weighted contribution per unit or fixed cost by weighted PV ratio. How will you do that? Simple. The respective contribution per unit into the weights or the respected PV ratio into weights, and as simple as that, guys. Clear with this, right? And that's about this particular concept of sales mix and marginal costing, right? With this, we have completed this particular concept called as sales mix. Now let's move on to another concept called limiting factor. We will do one concept called as limiting factor. Quickly, we will revisit this area. So let's get started. So I will take this up here. 1 second. Okay, guys. So limiting factor. Okay. Now guys, let us say I deal with two products A and B. Let us say the selling price is going to be 10 rupees for product A and 10 rupees for product B. The variable cost is going to be 6 rupees for product A and 4 rupees for product B. The contribution per unit is going to be 4 rupees for product A and 6 rupees for product B. Now, you guys tell me, these two products are there. Which product will I manufacture? Now, you might say, sir, product B, sir, I will manufacture because it gives me a higher contribution per unit. Now, I will say, why only product B? Product A is also giving me some positive contribution. So, I will produce both A and B, no? Who is stopping me? Yes, I can sell as many number of units of B possible. I will also parallelly sell as many number of units of A possible. Guys, clear with this. So why should I limit my production to only one product? I can produce as many products as possible, right? So generally, when there is no constraint, no one is stopping you from producing a product which has a positive contribution. You can produce all the products which will generate a positive contribution. Are you clear with this? Now, let me add one more data here. Let us say both these products are produced by using a common raw material called X. Now this X needs to be imported from, let us say, China, right? Now there is some import restriction and the Indian government has clearly mentioned that you cannot import beyond 10,000 kgs of raw material X, or in other words, raw material X is a scarce product. It is called as limiting factor. Are you clear with this? Any factor that limits your production or output is called as a limiting factor. In this scenario, your raw material is a limiting factor. So now you guys tell me, what is the total kgs of raw material available? 10,000 kgs. Clear with this, guys, right? And let us say to produce 1 unit of product A, I require 1 kg of raw material. To produce 1 unit of product B, let us say I need 2 kgs of raw material. And overall in the Indian market for product A, let us say I have a total demand of 2000 units, and for product B I have a demand of, let us say, 8000 units. This is the scenario. Now guys, first you tell me, in the market I have a total demand of 2000 units of product A and 8000 units of product B. Will I be able to fulfill the entire market demand? Is that possible right now? So to fulfill the entire market demand, sir, to produce 2000 units, 2000 into 1, I need 2000 kgs of raw material plus 8000 units of B, sir. 8000 into 2, 16,000 kgs of raw material. Overall, 2 plus 16, I need a total of 18,000 kgs of raw material. If I have 18,000 kgs of raw material, I can satisfy the entire market demand for product A as well as product B. But now you tell me, how many kgs of raw material do I have? Only 10,000 kgs of raw material, which means raw material is a scarce component. I call that as a limiting factor. This is a factor that limits my production. In this case, what should I do? I should judiciously and very, very carefully, I should use my raw material. Now, how am I going to use it? Which means I need to use this raw material properly and very judiciously towards production, right? Now, you guys tell me, I need to prioritize. Sir, which product should I produce first, A or B? Once I fulfill all the first priority product, then if any kgs of raw material is left, I will go to the second priority product. Now you guys tell me, which product should I manufacture first, raw material A or raw material B? We should do a ranking. Now, many of you might think, sir, first ranking will go to product B because it has a high contribution per unit. First produce this particular product B. Then if you are left with any raw material, then you can produce product A. So which means product B should get the first rank, product B should get the second rank, priority. The answer is wrong. Why? Now you need to compute something called as contribution per limiting factor. What is the limiting factor here? Raw material. So contribution per kg of raw material. Here, product A, you generate 4 rupees by consuming 1 kg, which means 4 by 1. My contribution per kg of raw material is 4 rupees. Whereas product B, no doubt, you generate a contribution of 6 rupees, but this 6 rupees can be generated by consuming 2 kgs of raw material. 6 divided by 2, you get how much? Rupees 3 per kg. Now you guys logically think. Now every time I lift a particular kg of raw material from my stores and issue it for production, if I use it for producing product A, this kg of raw material, if it gets converted into product A, every kg of raw material used for product A can generate 4 rupees. Whereas every kg of raw material used for producing B can only generate 3 rupees. Why, sir? No doubt product B has an advantage of higher contribution per unit, but product A has an advantage of lower consumption per kg, which may lower consumption per unit. So which means in this case, so you need to consider both the contribution as well as the consumption. Hence, what we do is we do the ranking by considering contribution per limiting factor. In this case, contribution per kg of raw material. Literally, this 6 rupees can be achieved by consuming 2 kgs of raw material, or in other words, per kg of raw material used for producing product B, I can generate only 3 rupees, whereas the same raw material is used for producing product A, I can generate 4 rupees. So now what we do here is, now I do the ranking. So as per the ranking, the first priority will go to product A. So use all the kgs of raw material and try to fulfill the entire market demand of product A. 2000 units of product A you produce. If you are left with the balance kgs of raw material, then you go ahead and use it for producing product B. That is going to be the second ranking product. So the first step in questions which have limiting factor is, doing the ranking. Ranking should be based on what? Contribution per limiting factor. In this question, I told you the limiting factor is raw material. Now, maybe in some question, they could have given you the limiting factor could be labor hours, right? The total labor hours available is 10,000 hours. In that case, what you need to do? Example. So, the labor hours per unit will be given in the question. Arrive at the contribution per labor hour, do the ranking, and then you need to do the allocation. So, basically, guys, the first step that we need to do here is about what? So, the step number 1 is ranking. Now, step number 2 we need to do, which is allocation. Sir, how will I allocate? So, allocation of raw material to the products. Sir, using this 10,000 kgs, what is the best possible combination of product A and B that I can produce so that I will get the maximum possible profit? Now, for this, actually, I have a template here. Rank product kgs per unit, kgs, and cumulative kgs. Sir, what is this? A very, very proper and a structured way of cracking questions here. First, what is the first rank product? Product A, right? One second, I think I missed out one thing. Okay, so here I will write it down. Units, kgs per unit, kgs, and cumulative kgs. I will tell you what this is. Product A. Now, what is the maximum possible demand of a product A? 2000 units, right? So 2000 units. Now, to produce 1 unit of product A, how many kgs of raw material do I need? It's given in the question, 1 kg, which means to satisfy this entire 2000 kgs, 2000 units, how many kgs do I need? 2000 into 1, 2000 units. So till now, cumulative kgs I've consumed is how much? 2000 units. Next, what is the second rank product? B. Now, come from the reverse. After I produce A plus B, totally how many kgs of raw material would have been consumed? The total 10,000 kgs, right? The total 10,000 kgs, right? So this is not units, this is kgs. Now, out of this 10,000, already I would have consumed 2,000 kgs for producing first product A, which means how many kgs are available for producing product B? Balance 8,000 kgs only. Now, to produce every unit of product B, how many kgs do I need? 2 kgs of raw material, which means using this 8,000 kgs of total raw material, how many units of B can I produce at max? 8,000 divided by 2. Max, I can produce only 4,000 units of product B. Are you guys clear with this? Or in other words, the most optimum allocation of this raw material is you produce 2000 units of A and then produce 4000 units of B. This combination will only give you the maximum possible profit. Now, if you deviate from this mix, definitely your profit will definitely reduce as compared to this particular allocation. Are you guys clear with this? So there are two steps involved in your limiting factor questions. Number one, ranking your the products based on contribution per limiting factor, and step number 2 is allocation of your limiting factor to the products. Are you guys clear with this? In this scenario, right, what we did, I narrated one particular question, and based on this particular facts, we have seen that the best optimum possible production is going to be to produce 2000 units of A and 4000 units of B. So we are fulfilling entire product A's demand. Product B, out of 8,000, we can only produce 4,000. This is because of the constraint of raw material. Are you guys clear with this? And that is all about the concept of limiting factor. With this, any kind of sum you will be able to do. And in fact, in our courses, in our regular and EVO batches and all the sums we do here. But since this being a marathon revision, right, here also I have taken one numerical example to explain the concept of limiting factor. The same logic you can apply for in case of instead of raw material. Suppose in the question it is being mentioned that labor hours or machine hours is a limiting factor. In that case, automatically instead of raw material you can use your labor hours or machine hours, as the case may be. Calculate the contribution per labor hour or contribution per machine hour, do the ranking and do the allocation. As simple as that. Clear with this, guys? So with this, we have also completed the next concept called as limiting factor. So let's go and tick off the scoreboard, right? So that's about this concept of limiting factor analysis. So now let's move on to the next concept called as shutdown point. Now, what is this concept of shutdown point? Now I've clearly explained this in our concept decoder notes as well. The limiting factor is mentioned, shutdown point, right? So I have neatly condensed all the formulas and everything has been mentioned here. So all these things, whatever I've written down here, it was actually done during our, the batch, that is your regular and EVO batches and all. So we use the same book, in fact, for all our, regular batches as well, and even in our exam-oriented batch. But anyways, this concept of shutdown point. right? It is applicable under situation of off-season or recession. A company may need to evaluate whether it should shut down. Remember, it's a temporary closure or continue with the operations. Now, guys, what are they talking about in this particular scenario? Now, this concept is called as shut down point. Now, guys, now understand, in some extreme cases, the market might be very, very dull. For example, COVID time. Now, what happens? Though my product is very, very good, it has all quality, it provides value addition to my customers, but still, during certain time of recession, a perfect example is COVID, people might not be having the money to buy the product, though my product is very good in all other aspects. Now, in this case, COVID time, let us say for the next 3 months, I am expecting that there is going to be a complete lockdown. My business is going to be dull. Now, after 3 months, once again, my business will pick up. Till now, my business is very good. Temporarily, for this next 3 months, right now, the market is going to be dull. I need to take a decision whether I should continue my operations for this next 3 months or I should keep my factory shut down. Clear with this, guys? This is called as shut down or continue decision. In this chapter, we're going to take decisions. That's all, right? Shut down or continue decision. Sir, after 3 months, I will continue. That goes without saying. This is a temporary or a short-term decision we are taking. In our subject, we only take short-term decisions. We don't take long-term decisions. Long-term decisions are taken in financial management. Only short-term decisions are taken in cost and management accounting. Now, guys, now, how do we do this? Simple, based on cost benefit analysis, right? What is this? Sir, if I shut down, what is going to be my benefit? What is going to be my cost? We need to compute. If my benefits are going to be more than the cost of shutting down, then I will definitely shut down. If it is the other way around, that is costs are greater than benefit, then I will continue. Are you guys clear with this? Now, let me take an example. Now, let us say I run a coaching institute. Example I'm giving you, right? In a face-to-face model, I have hired one classroom, and on an average, let us say 200 students generally come and attend my class. Now, during COVID, what happens? I got an inquiry only from 8 students. Everyone preferred online, right? I'm talking about a face-to-face batch. Now, only 8 students said, sir, we are living nearby in the same street. We can come, sir. Don't worry. Now, instead of 200 students, now I have a demand of only 8 students. In this scenario, now I'm going to take a call whether this particular batch or for this particular next 3 months, should I shut down or should I continue? Now, if I shut down the batch, what are all the benefits? I will write it down here. If I shut down the batch, because of shutting down, what are all the extra cost? I will write it down here. Now, guys, let us say I'm running an academy with multiple faculties, right? Now, let us say I have fixed costs, right? There are 2 types of fixed costs. One is called as avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what are these two, sir? Example. Now, the same example of coaching institute. Now, let us say I'm going to cancel the upcoming batch, face-to-face batch. Because of this, can I go ask my landlord, sir, next batch is not going to happen, so I will not pay your rent for the next 3 months? Can I tell him that? Absolutely not. So clearly, rent is an example of unavoidable fixed cost. Whether you shut down or you continue, definitely this rent has to be incurred. Whereas, let us say I have faculties for multiple subjects and I'm going to pay them for every batch. If you take one batch, I will be paying you a fixed amount of so much. It is not dependent on the number of students. Example, I'm telling you. Suppose if I cancel the next batch, I need not pay my faculties, obviously, because the batch is not conducted. Clear with this, guys? Now, the faculty fee payment is an example of avoidable fixed cost. It is fixed cost only. Both rent as well as faculty payment are examples of fixed cost, but your faculty payment is avoidable in nature, rent is unavoidable in nature. Are you guys clear with this? If I shut down, I will be able to save my avoidable fixed cost. Are you guys clear with this? So the benefit of shutting down, there is only one benefit. What is this? Savings in avoidable fixed cost. Are you guys clear with this? Savings in avoidable fixed cost, right? Now, what are the costs if you shut down exclusively? What are the costs you are going to incur? Now, don't say unavoidable fixed cost. Unavoidable fixed cost, example, rent will be incurred whether you shut down or you continue. On the cost side, what you should mention, if you shut down, only because of shutting down, if you are incur specifically some cost, that alone should be captured here, because we're doing a cost benefit analysis. If I shut down, what is the benefit? If I shut down, what is going to be the cost we are going to compute, right? Now, let us say during COVID, right? Now, lockdown was there. Now, we couldn't move around. So, lockdown was there, let us say for 1 month. After this 1 month, now, what happened? If you are going to start your two-wheeler, right? Because you cannot move around, your two-wheeler would have been just like that. You would have kept it down, right, in your garage or in your parking area. After 2 months, if you start this two-wheeler, it will not start. So the first place you will go is the mechanic shed. Or in other words, basically guys, this is the thing that happens for all machines. If you don't use a particular machine, then it requires some extra maintenance. Clear with this, guys? Similarly, if I am planning to shut down my factory for the next 3 months, I need to incur some extra cost which I will not be incurring if the business is running. Clear with this, guys? I need to do some trial run, extra overhaul, maintenance, lubrication, other things I need to do just to make sure that the machine will run after 3 months of shutting down. Clear with this, guys? So, or in other words, this is called as shutdown cost. What do you mean by shutdown costs? The costs which are exclusively incurred if I am shutting down my business. Are you guys clear with this? So if I shut down, there is an exclusive cost which I incur. It is called as shutdown cost. So this is one cost which I incur only if I shut down. Clear with this, guys? Next, there is one more cost, opportunity cost. This is nothing but the contribution lost on shutdown period demand. What is this? Now, I told you, instead of 200 students during the shutdown period, or in other words, during this 3 months upcoming batch, I got inquiries from 8 students. Now, because I am shutting down, now what happens? I cannot generate the contribution on this 8 students also. Are you guys clear with this? So, if I shut down, what happens? I am losing out on the contribution that I could have otherwise generated on the shutdown period demand. Whatever less demand it is, on that I could have generated some contribution, that also I will be losing. Clear with this, guys? Right? So now there is one benefit and there are 2 costs here. If the benefits exceed the cost, then you can go ahead and shut down. If your costs exceed the benefit of shutting down, then do not shut down, go and continue. Clear with this, guys? But there will be one point where the benefits is equal to the cost, that is called as shutdown point, and at that point, whether you shut down or you continue, basically you will get the same result because your benefits is equal to cost. Now let me give you a numerical example. With the help of this, you will be able to understand. Now let us say, guys, right, this is example number 1. So I'm classifying this benefits and cost. Let us say avoidable fixed cost is equal to 1 lakh rupees. Sir, if you shut down, you will be able to save fixed cost of 1 lakh rupees. But what happens? Sir, exclusively for shutting down, you need to incur some extra maintenance. How much is that? 40,000 rupees. And contribution lost, how much is it? Let us say, sir, for the upcoming 3 months, I predict I'm going to get a demand of 8,000 units. So generally, sir, for this 3 months, generally 1 quarter, I get a demand of 70,000, 80,000 units generally. Whereas now I'm getting only 8,000 units. But if you shut down, that 8,000 units also cannot generate a contribution. Ideally, if I sell 1 unit, I could have generated 4 rupees of contribution. But since I'm shutting down, 8,000 into 4, I'm losing how much? 32,000 rupees. Guys, are you clear with this? So now total cost is how much? 72,000. Or in other words, if you see, if you shut down, how much amount you will save? 1 lakh rupees benefits, right? But because of shutting down, extra how much you lose? 72,000 net off. You have a net benefit. If you shut down, you save 1 lakh rupees, but extra you incur is 72 net off. That is on 28,000 rupees of net benefit. So now what will you say? Sir, the decision is please go ahead and shut down, right? Because the benefit of shutting down exceeds the cost of shutting down. Are you guys clear with this? Now, let me give you a second situation. Sir, if I shut down benefits, avoidable fixed costs, I can save 1 lakh rupees. This will not change. Cost, shutdown cost is going to be equal to 40,000 rupees. This also will not change. Contribution lost. Suppose, let us say, during the next 3 months, I am predicting a demand of 20,000 units. I am predicting a demand of how much? 20,000 units. Each unit I will be losing contribution of how much? 4 rupees. So literally the contribution loss is going to be how much? 20,000 into 4, 80,000 rupees. Clear with this, guys? This case, what is the total amount I'm losing if I shut down? 1,20,000 rupees. But what is the benefit I'm getting because of shutting down? Only 1 lakh rupees. Here, the cost of shutting down exceeds the benefits of shutting down. In this case, what I will do? Sir, please do not shut down. It is better to continue. Are you guys clear with this? Right? Now, guys, why did we change the decision? Why did we change the decision? There is only one factor that played a role. Avoidable fixed cost did not change. Shutdown cost did not change. The entire thing here changed because of the shutdown period demand. Volume. Volume is the biggest hero of this chapter. Now, what happened here? If the shutdown period demand was only 8,000 units, right? Then in that case, I didn't lose much. Overall, I was losing to 72,000, right? But I was getting 1 lakh. Here, now since the shutdown period demand increased, so the contribution lost, opportunity cost increased significantly. Hence, what has happened? The costs exceeded my benefits, and hence what happened in this case? I felt no, please don't shut down, because if you shut down, what happens? You lose 20,000 units, and every unit you generate a contribution of 4 rupees. You have lost 80,000 rupees of contribution. Because of this, the entire decision changed. Are you clear with this? Or in other words, there is one point where my benefit is equal to cost. That point is called as shutdown point. Or in other words, shutdown point is nothing but how much demand of during the shutdown period do you expect, so that your benefit will be equal to cost. That is, the demand level at which my benefits is equal to the cost is called as shutdown point. How will we do this? Simple, equate the two. So at the shutdown point, benefit should be equal to cost. So here I will say 1 lakh should be equal to 40,000 plus 40,000 is this, plus I need to calculate the shutdown point only. I will keep the number of units as X into every unit will generate 4 rupees. Or can I say this is nothing but 40,000 plus 4x? Guys, clear with this? So now can I say, I'll put it on to the other side, 4x is equal to, now this goes to the other side, 1 lakh minus 40,000. So 1 lakh minus 40,000, or in other words, x is equal to 1 lakh minus 40,000 divided by 4. Are you guys clear with this? Or in other words, x is equal to 1 lakh minus 40,000 is 60,000 rupees divided by 4. How much is this? 60,000 by 4. It's going to be 15,000 units. Are you guys able to understand? So my shutdown point is equal to 15,000 units. Sir, with this shutdown point, what can we conclude, sir? What can we conclude? Sir, shutdown point is going to be equal to 15,000 units. What can we conclude, sir? Simple. Sir, shutdown point is 15,000 units. Suppose your expected demand, sir, during this next quarter, I am expecting the expected volume is less than your shutdown point. In that case, market is not vibrant. You can just go ahead and shut down. It is better to shut down, right? Suppose your expected demand for this upcoming quarter or the next 3 months or 2 months, as the case may be, is greater than the shutdown point. In that case, what will you do? Definitely you should continue, because the cost of shutting down will exceed the benefits of shutting down. Clear for this, guys? So if your expected demand, right, shutdown period demand is less than the shutdown point, it is better to shut down. If your expected shutdown period demand is less than the shutdown point, better to shut down, because market is not vibrant. Now if your expected shutdown period demand is more than the shutdown point, it is better to continue. And at the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? Or in other words, guys, nothing, shutdown point is nothing but, now in the numerator you had 1 lakh minus 40,000. What is 1 lakh? Avoidable fixed cost. Correct? 1 lakh was avoidable fixed cost. What is this 40,000? This is nothing but shutdown cost divided by 4. What is this 4 rupees? This is nothing but contribution per unit. Are you guys clear with this? Or in other words, my shutdown point is nothing but avoidable fixed cost minus shutdown cost divided by contribution per unit, right? This is all the formula, guys. Or in other words, this is very similar to your indifference points analysis. Difference in fixed cost divided by difference in contribution per unit. But here, look at this. This is nothing but difference in fixed cost divided by difference in contribution per unit. But if I shut down, I don't have a contribution per unit, so there is only one contribution per unit. Directly you can say difference in the two fixed costs. What are the two fixed costs here? Avoidable fixed cost minus shutdown cost divided by your contribution per unit itself. Or in other words, your shutdown point is an extension of indifference point analysis, and directly you can arrive at the shutdown point by using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. With this shutdown point, what can you take a decision? If during the upcoming 3 months or 2 months, as the case may be, it will be given in the question, for the shutdown period, if the expected demand is less than the shutdown point, market is not vibrant, go ahead and shut down. If the expected demand during the shutdown period is more than the shutdown point, it is better to continue. If your expected demand is exactly equal to the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? This analysis is called as shutdown or continue decision using the concept of shutdown point. As simple as that, guys. Beyond this, there is nothing here in this question, in this particular concept. Now if you go and read all these things, you will be able to understand. It is applicable under situation of off season or recession. The company may need to evaluate whether it should shut down temporarily or to continue the operations. Now all these things has been given, and finally the shutdown point can be calculated using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. Now shutdown point is also nothing but volume only, demand only. If you want to express this in units, in the denominator use contribution per unit, or if you want to express this in value, use PV ratio. As simple as that. Clear with this, guys? If the expected demand is less than the shutdown point, it is better to shut down. If it is equal to shutdown point, whether you can shut down or continue, it will give you the same result. If the expected demand is greater than the shutdown point, it's better to continue. And in the doubt buster segment, clearly I have mentioned here, what is this? The shutdown point concept is based on indifference point concept, and the formula is derived from indifference point formula: change in fixed cost divided by change in contribution per unit. As simple as that, guys. Beyond this, there is nothing great at all. So now let's quickly go and solve one numerical problem. So please take question number 18. One second. It's okay. We will take question number 18 from our CMA Inter book, right? Paper 8, cost accounting. Please take question number 18. So I have handpicked all these questions. So just so that we cover. Now for CA Inter students, please don't think that, sir, this is not applicable for me and all. Absolutely not. Absolutely not. In fact, in the CA Inter material also, few CMA questions I've kept for a simple reason, right? Separate books only, but still I've kept, because in past I've noticed one trend. If a good question comes in CMA Intermediate, now our CA Institute is keeping it here, right? And at times CA Inter questions are being tested in CMA Intermediate. So these kind of shuffling keeps happening. So please do not worry. If I'm doing something, it's absolutely applicable for your syllabus. Clear with this, guys? So now let's go and do this question number 18. Please remember, this question number 18, we are doing it from CMA Intermediate paper 8, cost accounting. That book, you can please download it. So It's on page number 275. Right? So this book. So cost accounting, paper 8, cost accounting, question bank. From here we are going to do this question. Right? So quickly, let's get started. 1 second, I'm taking out the question for you. Okay, so yes, question number 18. It's on page number 275. Mr. Young has 1,50,000 rupees of investment in business. He wants a 15% profit in his money. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of the sales. Means what? Variable cost ratio is 60%, which means PV ratio is going to be 40%. And fixed cost is going to be how much? 75,000. Show the supporting computations for each of the solution. Okay, what sales volume is required to break even? What sales volume is required to obtain his 15% return on investment? Right, these two are general questions. Right, this is on break even point, this is on calculating the required sales to earn a profit. Now the most important part, shutdown point, comes here in point number C. Mr. Young estimates that even if he closed the doors of his business, he would incur 25,000 rupees as expenses per year. At what sales would he be better off by locking his sales up? Now they are using some technical language and all, nothing great. No, the best part is nowhere in the question they have used the word shutdown point or anything, right? But ideally this question comes from your shutdown point analysis only. Now what they are saying, first of all, understand. Now in this particular question, there is no contribution per unit, so you should use your PV ratio. How much is the PV ratio? The variable cost ratio is 60%, which means my PV ratio is going to be 40%. As simple as that. Perfect. That's all it is. Next. Now, what is the formula for calculating your shutdown point? Shutdown point is going to be avoidable fixed cost minus shutdown cost divided by PV ratio. Correct, guys? Now, carefully read this question. How much is my total fixed cost? 75,000 rupees. Now they have said, even if I closed the doors of his, even if he closed the doors of his business, which means what? Even if he shuts down, he would incur 25,000 rupees per year. Means what? 25,000 rupees is unavoidable fixed cost. Clear with this, guys? So out of the total fixed cost of 75,000, 25,000 rupees is unavoidable, which means the balance 50,000 could be avoided if he shuts down the business, right? So avoidable fixed cost is going to be 50,000 rupees. Are you guys clear with this? Right? Now, shutdown cost is how much? Don't say shutdown cost is 25,000. Shutdown cost means what? A cost which I will incur only if I shut down. In this case, I am not shutting down my business at all. I mean, in this case, I am not going to incur any specific fixed cost or any specific cost. If I shut down, they have not given anything. So in this case, I will take my shutdown cost as 0, right? So by substituting it here, avoidable fixed cost 50,000, right? Minus shutdown cost 0 divided by PV ratio 40%. So how much does it come out to? 50,000 by 0.4, you get 1,25,000 rupees as your shutdown point. Are you guys clear with this? Now here they have used a different formula and all, but ultimately the answer matches. But trust me, this is the correct formula. Please write that only in your exam. Now 1,25,000 rupees is the shutdown point. What is the meaning of this? Sir, if in the expected upcoming next few months or in the year, as the case may be, right, for the temporarily in the next period, if your expected demand is less than 1,25,000, please shut down your business. If it is more than 1,25,000, please continue. If it is exactly equal to 1,25,000, whether you shut down or you continue, the result will be the same. Are you guys clear with this? This is the concept of shutdown point, and many students make a mistake in arriving at the correct avoidable fixed cost and the shutdown cost. They generally take a wrong figure. 25,000, they take it as a avoidable fixed cost directly. No, it is unavoidable fixed cost, which means out of the total fixed cost, 25,000 will be continued to incur even if I shut down, which means it is unavoidable, which means only the balancing figure 50,000 is avoidable fixed cost. And shutdown cost would be specifically given in the question. You can't assume anything. If it is not given in the question, take it as 0. As simple as that. Clear with this, guys? That is all about this particular question. right? Here we are focusing on the shutdown point analysis, and as simple as that, guys. Very, very simple. And we have taken one question from CMA Intermediate paper 8, right? But don't think it is not applicable. Please do not think even CA Inter students can definitely follow this question, right? It is 100% applicable for your examinations, because these kind of questions, right, gets tested across different courses, CA CMA. In fact, I've also noticed in US courses like CMA and all, certain questions, if it gets tested in one attempt, our CA Institute or CMA Institute are also taking, because globally costing FM, these questions are all, I mean, these subjects are all same, uniform. It is not country dependent. It is globally, it's going to be more or less the same. Hence, these kind of question gets tested in all professional courses that are having these subjects in their syllabus. Clear with this, guys? So with this, we have completed this particular question number 18. Please go and update your library of adjustments. Please write down. Please write down calculation of shutdown point. Please write down calculation of shutdown point. All right, fine, guys. So that's about this particular concept of shutdown point. So with this, we have completed this concept of shutdown point as well. Now let's move on to the next concept. So now let's move on to the next segment of discussion, which is marginal costing versus absorption costing. Now, guys, now this segment of discussion alone goes on to achieve the objective of your profit computation, your stock valuation and profit computation. All other aspects of this chapter will go on to achieve the objective of decision making. Only this segment of discussion goes on to achieve the objective A of our subject, which is stock valuation and profit computation. Now, guys, in this segment, right, we are going to see how stock gets valued in marginal costing and absorption costing, and accordingly we will be preparing this income statement under marginal costing and as per absorption costing, and finding out the difference between the profit reported under these two methods. And we will also be seeing the reason why each of these two methods or systems of costing, right, report different profits. Ideally, they are not methods, they are called techniques of costing. Now, right, once again, guys, this is a common segment in your CA Intermediate, your paper 4 cost and management accounting, in your CMA Intermediate paper 8 cost accounting, and paper 12 management accounting. It's a common area. Now, guys, now basically cost is broadly classified into two: manufacturing cost and non-manufacturing cost. Basically, manufacturing cost means cost that is incurred inside the factory, and non-manufacturing cost refers to all the costs incurred outside the factory, basically in your corporate office administration overheads and your sales depot selling overheads, right? Now, generally all non-manufacturing costs are considered as period cost, which means they are not considered for the purpose of stock valuation. They are P&L items. They are not trading account items. They are not considered for the purpose of stock valuation, right? However, CMA Institute, right, CMA students, generally CMA Institute considers administration overheads also as a product cost. However, in this segment of discussion, even in CMA, they have taken it only as period cost. Now, administration overheads and selling overheads are always considered as period cost, both under marginal costing as well as under absorption costing, right? Now, manufacturing cost, that is cost incurred inside a factory, can be classified into direct material, direct labor, direct expenses, and production overheads. Now, this production overheads can be further categorized into two: variable production overheads and fixed production overheads. Now, guys, under absorption costing, right, now every unit of stock is valued at full manufacturing cost, or in other words, right, product cost means all the costs incurred inside the factory, that is direct material, direct labor, direct expense, called as prime cost, plus entire production overheads, which means variable as well as fixed component of production overheads. Whereas marginal costing is dead against it. It says, no, every unit of stock can be valued at direct material, direct labor, direct expense, and variable production overheads. However, fixed production overheads should never be treated as a product cost, and it should never be unitized for valuing every unit of output. Who says this? Marginal costing. Clear with this, guys? Because marginal costing is completely against unitizing your fixed cost. Now, if you are incurring a fixed cost, even though if it is incurred inside the factory, I should treat it only as a period cost. I should never treat it as a product cost. Clear with this, guys? This is what marginal costing says. Or in other words, direct material, direct labor, direct expense, and variable production overheads, these four components are always treated as a product cost, both under marginal costing as well as under absorption costing. The only issue or the difference between marginal and absorption costing lies with respect to treatment of fixed production overheads. Now, in fixed production overheads, absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Marginal costing literally says anything which is fixed should never be unitized, should never be considered as a part of product cost. It should always be period cost. Clear with this, guys? Or in other words, under absorption costing, every unit of stock or every unit produced is valued at full manufacturing cost. Whereas, can we say, marginal costing values every unit produced at variable manufacturing cost. Clear with this, guys? Variable manufacturing cost. Don't say variable cost. Why, sir? Now, administration overheads, selling overheads. Here also, some variable component could be there. But marginal costing says anything incurred outside the factory should never be considered as a part of stock valuation. Clear with this, guys? So, AOH and SOH are always period cost, irrespective of whether it is variable component or fixed component. So, marginal costing is very clear. It says stock should be valued at variable cost, that too incurred inside the factory. So variable manufacturing cost alone is considered for the purpose of stock valuation. Clear with this, guys? Right? Under marginal costing. So clearly understand, with respect to non-manufacturing cost, AOH, SOH, always treated as period by both the systems of costing. And with respect to prime cost components and variable production overheads, always considered as a product cost under both the systems of costing. The only issue with respect to treatment of fixed production overheads, now absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Simple, guys. Now there is a famous movie dialogue in Tamil. So there is a movie dialogue that says, நண்பன்ல எங்கம்மா நல்ல நண்பன் கெட்ட நண்பன் நண்பனாலே நல்லவன் தான். Right? For those who do not understand Tamil, it's okay, fine, just a movie reference. Now similarly, marginal costing says fixed la engama product period, fixed nale period da. So fixed cost means period cost. Right? Now whether it is incurred inside the factory, outside the factory, marginal costing is completely dead against unitizing your fixed cost. It says simple, if it is fixed, even though if it is incurred inside the factory, I will only consider that as a period cost. Clear with this, guys? Or in other words, in marginal costing, every unit of stock is valued at variable manufacturing cost, whereas absorption costing values every unit at full manufacturing cost. The only difference between the two is with respect to treatment of fixed production overheads. All other areas, marginal costing and absorption costing, are agreeing. The only disagreement is with respect to fixed production overheads. And we all know in absorption costing, what we do is that, right? So we arrive at the predetermined rate and all, budgeted fixed overheads divided by your budgeted base quantity. Using absorption technique, we charge it the product. At the end of the period, you take the absorbed overheads, compare that with actual overheads, arrive at under or over absorption, give the adjustment. Here in marginal costing, there is no question of absorption itself. Only then will the question of under or over absorption come. So all these things are not even there in marginal costing. Only in absorption costing that issue is there. Clear with this, guys? Now with this background, let us go and do one numerical problem. With the help of this numerical problem, we will clearly understand the difference between your marginal costing and absorption costing. Why will there be a difference in the profit reported? If so, why? And all these things we will clearly understand. This is a masterpiece question, right? It has all the variety combinations, all the different kinds of combinations possible, right? And with this, the entire concept of marginal and absorption costing will be covered here, right? So please go to your CA Intermediate Solved Question Bank, volume number 2, and please go to question number 27. It's on page number 449. This is equally applicable for CMA students. So the kind of questions which I am picking here in the marathon revision is purely which is common for everybody, right? If there is something which is not common, I will clearly indicate. You need not have to worry about that, right, guys? So now on that note, let's get started with question number 27. Now, from the following data, compute the profit under marginal costing and absorption costing and reconcile the difference in profit. Now, the selling price per unit is how much? 8 rupees. The variable cost is 4. Fixed cost is 2. Assume all these are manufacturing costs incurred in the factory. Literally, guys, which means what? The total cost of production, the full cost, full manufacturing cost is how much? 6 rupees. Right? So under absorption costing, every unit of stock will be valued at 6 rupees, whereas under marginal costing, every unit of stock will be valued only at 4 rupees. Perfect. Now, the normal volume of production is 26,000 units per quarter. Every quarter, I plan to produce how many units? 26,000. Normally, this is the production level. The opening and closing stock consists of both finished goods and equivalent units of WIP as follows. Literally, what they have said. Q1, Q2, Q3, Q4. 4 quarters they have given. Quarter wise, how much is the opening stock? How much is the production? How much is the sales? How much is the closing stock? Everything is given. Q1, no opening stock. 26,000 units I produced and I sold entire 26,000 units, which means I'm left with no closing stock. Closing stock of Q1 becomes opening stock of Q2, 0. Plus production is how much? 30,000. So I have 30,000 units, out of which I have sold 24,000 units, which means units unsold. Closing stock is 6,000 units. Now this becomes the opening stock for the next quarter. So 6,000 plus 24,000 they have produced in that quarter. Overall, how many units are available for sale? 30,000. Out of this, they have sold only 28,000, which means the balance 2,000 is the closing stock, becomes the opening stock for the next quarter, right? Add 30,000. Overall, 32,000 units are available for sale. They have sold entire 32,000. Hence, closing stock is 0. Clear with this, guys? Quarter wise, they have clearly given opening stock, production, sales, closing stock. All the data is given. Now, what we need to do, quarter wise, we need to compute the profit. First under marginal costing, then under absorption costing. We will see what is the difference between the two. Clear with this, guys? Now, remember, in marginal costing, every unit of stock will be valued at what? 4 rupees. Clear with this, guys? Please have this very, very clearly. Now, one more thing in this question. Now, how much will be the fixed cost? Now, they have not given anything in specific. So, clearly we know normal production volume is how much? 26,000. So 26,000 per quarter. So 26,000 into 2 comes out to rupees 52,000. So quarter wise, 52,000 rupees is going to be my fixed cost in total. Clear with this, guys? Right? I will take this. Now, with this, let us go and prepare the profit statement under marginal costing system quarter wise. Now, first sales figure. How much is the sales figure? Respective number of units multiplied by the selling price 8. So 8 into 26,000 is equal to 2,08,000. So 24,000 is equal to 1,92,000. 28,000 is equal to 2,24,000. 32,000 is equal to 2,56,000. Literally quarter wise sales figure is done. Now from your sales, you should subtract the cost of goods sold, correct? Only then you will arrive at, ideally speaking, only then you will arrive at your correct profitability. So for the units sold, I should subtract, right, whatever is the cost of goods sold. But remember, every unit should only be valued at a variable manufacturing cost. Now first you guys tell me, how will I be valuing my cost of goods sold? Simple. Cost of goods sold is what? Literally this is my FG area. I have my opening stock. Plus the current year, I have some production. Right, this is the total units available for sale. Out of that, I have sold some units, right? I have sold some units and the balance is my closing stock. Can I say the cost incurred in respect of units sold is going to be opening stock plus the current year cost of production minus closing stock? Agreeing with me? If I do this, literally, I will be able to arrive at the cost of goods sold. But remember, all these units should be valued at 4 rupees variable cost. Clear with this, guys? So opening stock plus variable cost of production minus closing stock, I will arrive at variable cost of goods sold. Are you guys clear with this? So literally for Q1, opening stock is 0, right? Now variable cost, I mean per unit is how much? 4 rupees, right? So variable cost of production is at the rate of 4 rupees. Now what we need to do, everything, opening stock should be valued at 4 rupees, closing stock should be valued at 4 rupees. Now come on, tell me, now every quarter how much is the opening stock? The first quarter 0, second quarter 0, third quarter 6,000 units. So 6,000 units each should be valued at 4. So 6 into 4 is 24. Fourth quarter 2,000 into 4, it's going to be 8,000. Clear with this, guys? Similarly, so number of units of production, variable cost of production. So every unit should be valued at 4 rupees. 4 into 26,000 is equal to, you get 1,04,000. 30,000 is equal to, you get 1,20,000. 24,000 is equal to, you get 96,000. And 30,000 is equal to, you get 1,20,000. Clear with this, guys? Similarly, closing stock, first quarter 0, second quarter 6,000. So 6,000 into 4 is 24,000. 2,000 into 4 is 8,000. And 0 is the closing stock in Q4. That's going to be 0. So literally, the variable cost of goods sold is going to be how much, guys? The variable cost of goods sold, right? It's going to be opening stock plus current year cost of, I mean the variable cost of production for that quarter minus closing stock. If you adjust 0 plus 1,04,000 minus 0, it's going to be 1,04,000. Here 0 plus 1,20,000 minus 24, it's going to be 96. So 24,000 plus 96,000, right? You get how much? So 24 plus 96, you get 1,20,000 minus 8,000, you get 1,12,000, right? Similarly, 8,000 plus 1,20,000 minus 0, you get 1,28,000. Literally, quarter wise, now we have arrived at variable cost of goods sold. Clear with this, guys? Are you all able to understand? So now sales minus variable cost of goods sold, call it as gross contribution. It's not the final contribution. Why? Till now we have only considered the variable manufacturing cost. Now there could also be some variable SOH, AOH and all, right? Only if I subtract all my variable cost from my sales, I will arrive at my net contribution. Till now we have only adjusted for what? The variable cost incurred inside the factory. Hence I call this as gross contribution. So sales minus variable cost of goods sold, 2,08,000 minus 1,04,000 is 1,04,000. 1,92,000 minus 96 is 96,000. 2,24,000 minus 1,12,000 is 1,12,000. And 2,56,000 minus 1,28,000 is 1,28,000. Clear with this, guys? Now from this further subtract variable selling and distribution cost, right? Variable cost incurred outside the factory, that is variable AOH, variable SOH. In this question nothing is there, hence I am putting this as nil. From this you will arrive at the net contribution. It's nothing but the same figure because there is no variable selling and distribution cost. Clear with this, guys? Now from my contribution, now I should subtract my fixed cost. Fixed cost incurred where? Whether inside the factory or outside the factory. Anywhere you incur, I am not bothered about the location. Fixed means period with respect to marginal costing. So month, quarterly, how much the fixed cost? We saw this 26,000 into 2, it was 52,000. So directly go ahead and subtract 52,000 every quarter. So now what you get is the profit, quarter-wise profit reported under marginal costing. Are you guys clear with this? As simple as that. Simple, same statement. Sales minus variable cost gives you contribution minus fixed cost gives you profit. The same thing we are doing, but since this has stocks and all, here alone extra thing we are doing, variable cost of goods sold first we are computing. How do we do that? Opening stock plus variable cost of production minus closing stock, you get variable cost of goods sold, right? Sales minus variable cost of goods sold, you get gross contribution. From that further subtract variable cost incurred outside the factory, you get the net contribution. From that you subtract fixed cost, you arrive at the profit. Everything is same, but here the manner of presentation alone differs when you have stocks here. Are you guys clear with this? That's about it, nothing beyond this. Now quarter wise we have arrived at the figures, that is of profit reported under marginal costing: 52,000, 44,000, 60,000 and 76,000. As simple as that. Clear with this, guys? Next, now we need to compute the profits under absorption costing. Now before we do absorption costing, first you should understand one thing. Under absorption costing, every unit of stock is valued at how much? 6 rupees. Now also remember one more thing. In absorption costing, what we use is we use predetermined rate to absorb the fixed production overheads, correct? Now for that we need to know the budget fixed costs, the budget fixed overheads. We need to arrive at it. Clear with this, guys? Now divided by the budget units and all we do, accordingly we arrive at the predetermined rate. So that is how we need to do it. Now in this question, right, nothing is specifically given with respect to how much is the budgeted fixed overheads and all. Nothing is given, so we will assume that the budgeted fixed overheads is 52,000 rupees. How did we get 52,000? 26,000 units per quarter into 2 rupees, you get 52,000 per quarter. Guys, clear with this? And actual overheads incurred was also 52,000 rupees. In the absence of information, generally you can assume, right, your budgeted fixed overheads is equal to actual fixed overheads. Ideally, this is a discussion which is covered in overheads, which we have seen in detail in our regular classes, right? But I just want to set the context right even in this marathon. That's the reason this is a standard assumption you will take. Clear with this, guys? Now with this, first we should compute how much is the under or over absorption. How will you compute under or over absorption? Absorbed overheads should be compared with actual overheads, and based on this you will arrive at under or over absorption. Now the predetermined rate is 2 rupees, right? Absorbed overheads is going to be, right, your predetermined rate into actual production. So quarter wise you should arrive at the absorbed overheads first. So 2 into 26,000, 2 into 30,000, 2 into 24,000, 2 into 30,000 will be the absorbed overheads for the respective quarters. First we should compute under or over absorption. So absorbed overheads is going to be actual output into predetermined rate. So actual output we saw here 26,000, 30,000, 24,000, 30,000, right? Multiply that with 2 rupees of predetermined rate. How much you get here? If you look at it, it's going to be 52,000 for the first quarter. Second quarter, it's going to be how much? 30,000 into 2, it's going to be 60,000 here. Look at this, it's going to be how much? So it's going to be 60,000. For the third quarter, how much is it going to be? So 24,000 into 2, it's going to be 48,000. And for the fourth quarter, how much is that going to be? 30,000 into 2, it's going to be 60,000 rupees. Clear with this, guys? Right? Now what is the actual fixed overheads for every quarter? In the absence of information, we said budget is equal to actual. Every quarter it was 52, 52, 52 and 52. Clear with this, guys? Which means how much is the under or over absorption we need to calculate. Now for Q1, actual is 52, absorbed is also 52, which means there is no under or over absorption. In quarter 2, actual was 52, absorbed was how much? 60,000 rupees, which means absorbed is more than actual. There is an over absorption to the extent of 8,000 rupees. Clear with this, guys? For Q3, actual was 52,000, absorbed was only 48,000, under absorption to the extent of 4,000 rupees. And for Q4, 52 is the actual, absorbed was 60,000, over absorbed to the extent of 8,000 rupees. Clear with this, guys? So now literally quarter wise we have computed the under or over absorption, because this is an adjustment we need to do at the end. Now guys, coming back to the profit statement under absorption costing system. First, sales figure, you can just do it. The respective selling price multiplied by the respective units sold, you will be getting it. Right? From sales, if you subtract the cost of goods sold, right? From the sales, if you subtract cost of goods sold, right, you will arrive at the gross profit. Visualize your trading account, right? From the sales, you should subtract your cost of goods sold, you will arrive at what? Your gross profit. Now guys, under absorption costing, every unit is valued at how much? 6 rupees, right? So what I will do here, so opening stock is valued at 6 rupees. Current year units produced is also valued at 6 rupees, and even the closing stock is valued at 6 rupees. So the respective units, right, multiplied with 6 rupees, I will arrive at the respective figures. For example, here opening stock value will be 6 into first quarter is 0, second quarter is 0, third quarter is 6,000. So 6,000 into 6 gives you how much? 36,000 rupees is the value of opening stock for Q3. And for Q4, it's going to be 6 into 2,000, it's going to be 12,000 rupees. Clear with this, right? Now, cost of production, here you look at this. So 26,000, so 6 into 26,000 gives you 1,56,000 for Q1. So it's 1,56,000 for Q1. For Q2, how much is that? 30,000. into 6, so how much is that? 1,80,000. For Q3, how much is that? So 24,000. So 24,000 into 6 is 1,44,000. And for Q4, how much is it? It's going to be 30,000. So 30,000 into 6 gives you how much? 1,80,000. Clear with this, guys, right? And closing stock similarly. So 6 into 0 is 0. 6 into 6,000 is going to be 36,000. Here you get this closing stock 36,000, and 6 into 2,000 gives you how much? 12,000 rupees, right? And Q4 it is nil. So opening stock plus current year cost of production minus closing stock, if you do, you will arrive at the cost of goods sold for the respective quarter, right? Sales minus cost of goods sold, you will arrive at the gross profit. Gross profit is only reported in your trading account. From your gross profit, subtract all the non-manufacturing costs, selling and administrative expenses. Here variable or fixed, everything, irrespective of the nature of variable or fixed. We don't classify here as variable, fixed. Any cost incurred outside the factory comes in your P&L account. Clear with this, guys? You subtract, in this case it is nil. But remember, one more very important adjustment you need to do, which is with respect to under or over absorption. Ideally, all these things are a subject matter of discussion in your overheads area. Right? So under or over absorption, Q1 there is no adjustment. Q2, now what I would have done, I should have accounted only for 52,000. I have accounted how much? 60,000 already, which means I need to reduce the cost to the extent of 8,000 rupees. Reduction in cost will result in increase in profit. So add 8,000 rupees. So over absorption is added to the profit or reduced from the cost. Since you're computing profit directly, add it. Are you guys clear with this? All these are very technical discussion in your overheads area, right? And I hope, since this being a marathon, I'm not getting into too many details with respect to this area because it's covered in overheads actually. Clear with this, guys? Next one, with respect to quarter 3, you should have accounted for 52. You have accounted only for 48, which means 4,000 rupees is under absorbed, which means now you need to account for, you need to introduce cost to the extent of 4,000 rupees. So adding to the cost will reduce your profit. So 4,000 should be subtracted. Next one, 52,000 actual should have been accounted, but we have already accounted 60,000, which means 8,000 rupees of cost should now be reduced. Reduction in cost will result in addition in your profit. So 8,000 rupees should be added. Clear with this, guys? So from the gross profit, if you make the following adjustments, your net profit ideally that you will get is minus 52,000 in Q1, 56,000 in Q2, 52,000 in Q3, and 72,000 in Q4. Clear with this, guys? So these are all the profits reported under absorption costing, right, for each of the 4 quarters. Clear with this, guys? This is what it is. So now first we have prepared, this is not minus for 52. So this is ideally, this is not minus 52, this is positive only. 52,000 minus 0 is 52,000. 48,000 plus 8 is 56,000. 56 minus 4 is 52, and 64 plus 8 is 72. Clear with this, guys? Now, guys, now what happens? Now you tell me, is the profit reported under marginal costing and absorption costing the same? Here we have different figures. 52, 44, 60, 76. Here we have 52, 56, 52, 72 and all. The profit is different. Now, why is there a difference between the profit reported under marginal costing and absorption costing? Some of you might be thinking, sir, this is on account of under or over absorption. Absolutely not. Now, in marginal costing, right, we subtract the actual overheads. Whereas in absorption costing, we consider absorbed overheads, but at the end of the year, we match the absorbed with actuals. For example, here in Q2, I would have accounted for 60, but I compare it with actual and I say, look, by mistake I accounted 60. So now I will reduce my cost to the extent of 8,000 and net off I end up only accounting for actual overheads. Clear with this? So clearly understand, under or over absorption is not the reason for the difference between your marginal costing and the absorption costing profit. Sir, then what is the reason for difference? There is only one reason for difference, which is nothing but your difference in stock valuation. Now, guys, in marginal costing, fixed production overheads is not considered for the purpose of stock valuation. Whereas in absorption costing, the fixed production overheads is also unitized and it is considered for the purpose of stock valuation. Agreeing with me on this, right? Now, what happens? Always, every unit of stock is valued more under absorption costing and it is valued less under marginal costing. Do you agree with me on this? Yes, absolutely. Because every unit of stock is valued at 6 rupees under absorption costing, whereas every unit of stock is valued only at 4 rupees under marginal costing. Or in other words, absorption costing always values every unit of stock at 2 rupees more as compared to marginal costing. Right? Now, what happens? What happens? In Q1, in Q1, now what happens? Opening stock is how much? 0. Closing stock is how much? 0. Now understand one thing, guys. Opening stock is on the debit side. Closing stock is on the credit side. Now in this case, there is no opening and closing stock at all, right? Hence what happens? Net stock is not there. Because of this, there is no more stock valuation or under stock valuation. Hence, in the first scenario, the profit reported under marginal costing 52,000 is exactly equal to the profit reported under absorption costing 52,000. Sir, can you elaborate more? Don't worry, the second quarter we will take. The second quarter, what happens? Opening stock is 0. Closing stock is how much? 6,000. Closing stock is on the credit side, right? Now, credit side, 6,000 units are there. Every unit is valued at 2 rupees more, where under absorption costing. So 6,000 into 2, how much is it? 12,000 rupees. So 12,000 rupees is more on the credit side only under absorption costing. Hence, clearly absorption costing will be reporting a more profit to the extent of 12,000 as compared to marginal costing. If you want, you can go and check it. Marginal costing profit is how much? 44,000. How about absorption costing? 56,000. 56,000 minus 44,000. How much is this? 12,000 rupees. Why, sir? Because there is a net closing stock, and the closing stock is on the credit side, and always stock is valued more under absorption costing. So 6,000 into 2, 12,000 rupees is the difference. This is what I would have mentioned here, right? There is a net closing stock of how much? 6,000. So 6,000 into 2, 12,000 rupees is the difference in profit. Clear with this, guys? Let's go to the third scenario. Now, under third scenario, what happens? Opening stock is 6,000, closing stock is 2,000. You have both opening and closing. Now, you guys tell me, opening stock is how much? 6,000 units. Closing stock is how much? 2,000 units. If you net off the two, there is a net opening stock. Correct? The opening stock is more than the closing stock. Net opening stock is how much? 4,000 units. This is on the debit side. And always remember, stock is valued more only under absorption costing. So 4,000 into 2, how much is it? 8,000 rupees is more on the debit side, where under absorption costing, right? Now, when the debit side is more, obviously the profit will reduce. Hence, in this case, your absorption costing will be reporting a lesser profit than your marginal costing, exactly to the extent of 8,000 rupees. If you want, you can check. Marginal costing is 60,000. Whereas absorption costing is only 52,000. The difference between the two is 8,000 rupees. That is nothing but your fixed production overheads sitting inside your net stock. 6,000 minus 2,000. Net opening stock is there. Always stock is valued more under absorption costing. If the stock is on the debit side, the debit will be more, so profit will be less. If the stock is on the credit side, the credit is more, hence profit will be more. Are you guys clear with this? Right? So don't say more stock valuation means always absorption costing will be reporting more profit. No, it depends on where the profit is lying. If there is a net opening stock, right, the debit is more under absorption costing, hence your profit will reduce. If there's a net closing stock, so your credit will be more, again under absorption costing only, but this time since the credit is more, the profit will be higher. Are you guys clear with this? And look at Q4. What happens? Opening stock is how much? 2,000. Closing stock is how much? 0. So there is a net opening stock only. Once again under absorption costing. So always absorption costing value stock more. So 2,000 into 2, how much is it? 4,000 rupees is actually valued more on the debit side. So more debit means a lesser profit. Exactly what happens right now. Absorption costing will be reporting a lesser profit to the extent of 4,000 rupees. If you want, you check. 76,000 is the marginal costing profit. 72,000 is the absorption costing profit. The difference is what? 4,000 rupees, 2,000 into 2, net opening stock into, yeah, right, your fixed cost in sitting inside your net stocks. Clear with this, guys? Or in other words, we can come to a conclusion. When there is no stocks, or when opening stock is equal to closing stock, that is net stock is 0, right? The profit reported under absorption costing is equal to profit reported under marginal costing. Scenario number 1. When opening stock is more than the closing stock, or in other words, there is a net opening stock, right? So the debit side is more under absorption costing, hence the profit of absorption costing is less as compared to your profit under marginal costing. Clear with this? Which scenario is this? Scenario quarter 3 and quarter 4, there is a net opening stock. Clear with this, guys? So always in this case, see, marginal costing was reporting more profit, 60, 76. Here it was only 52 and 72. Clear with this, guys? Right? So when my opening is greater than closing stock, right, that is the net opening stock is there, absorption costing will report a lesser profit. When there is a net closing stock, or in other words, closing stock is greater than opening stock, in this case what happens? So obviously now the credit side is more, hence absorption costing will start reporting more profit as compared to marginal costing. This is quarter number 2. What happened here? So quarter number 2, I had a net closing stock, so here 6,000 into 12,000 rupees was more under absorption costing, 44 in marginal, but what happened? 56 in absorption. Are you guys clear with this? So a simple one-line summary here, you can say 4 scenarios when there is no opening stock or closing stock, or when opening stock is equal to closing stock, or when opening stock is greater than closing stock, or when opening stock is less than closing stock, or in other words, closing stock is more than opening stock. Clear with this, guys? When there is no opening or closing stock, right, marginal costing profit will be equal to absorption costing. Let us keep absorption costing as the base. Absorption costing profit will be equal to marginal costing profit. When opening is equal to closing, once again there is no net stocks here, absorption costing profit will be equal to marginal costing profit. Next, when opening stock is greater than closing stock, what happens in this case, guys? What happens in this case? So debit side is more under absorption cost. Always absorption costing will only have a more stock. If the net stock is on the debit side, profit will be less. If the net stock is on the credit side, profit will be more under absorption costing. Clear with this, guys? Here net stock is more on the debit side, hence absorption costing will be reporting a lesser profit than marginal costing, or you can say marginal costing reports more profit than absorption costing, right? When the opening stock is less than closing stock, or in other words, there is a net closing stock is more, in that case what happens? Absorption costing will report more profit than marginal costing. Are you clear with this, guys? And always remember, the difference in the profits reported under these two systems are exclusively on account of what? The fixed production overheads sitting inside your net stock. Are you guys clear with this? And that is the only reconciling item between the profits reported under marginal costing and absorption costing. And this question is a masterpiece question that covers all the situations that we saw here, right? The net opening stock is equal to closing stock, or opening stock is greater than closing stock, or opening stock is less than closing stock. All the scenarios in a single question, it gets covered. That was the reason why I wanted to cover this sum in the marathon itself. Clear with this, guys, right? And that's about the concept of marginal versus absorption costing. So I hope this completely recapitulated the entire concept, right? I think ideally, in a marathon itself, we are literally covering all the entire concepts here, right? Even for first timers, it could be useful, right? So please go and update your library of adjustments. Write down marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. So marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. Clear with this, guys, right? So with this we have completed all the concepts in marginal costing area, right? We have completed all the concepts in marginal costing area. The last segment of discussion is exclusively there for students doing paper 8 of CMA Intermediate. That will be covered exclusively for them, right? With respect to others, with respect to your CA Intermediate, right, this is all about it, as well as even for CMA Inter, paper 12. This is all about it. That's an accept or reject of special order, which is exclusively for CMA Inter paper 8 students, right? Fine. So now let's move on to the next and the last segment of discussion, which is accept or reject a special order, right? Ideally, though it is specifically a concept covered, it's not a specific concept as such, it is a variant of a question. Though it is, I've mentioned that it is exclusively applicable for students doing CMA Intermediate Paper 8. Now, I feel this is also a question which you can expect at your CA Intermediate level, right? So, definitely this is something even CA Inter students can also expect in their exams, because it is not a separate concept, it is more of an application driven area. So I would still say, I would rather still suggest students doing the CA Intermediate to follow this with one particular numerical question from your CMA Intermediate paper 8, right? Cost accounting. From that, I will take up one question. With the help of that, I will be doing this particular area. Once again, guys, let me tell you very, very clearly, this is not something that is, a specific concept as such, but this is one area which even CA Inter students can expect in their exam. On that note, let's get started with one numerical problem from your CMA Intermediate paper 8, right? Cost accounting solved question bank. So please take question number 12 of your paper 8 solved question bank. It's on page number 269. Now, look at this. The operating statement of a company is as follows. Now, what have they mentioned? Sales 80,000 units at the rate of 15. The sales value is given. Variable cost, material, labor, overheads. The total variable cost is given, right? Which means how much is the variable cost per unit? 7,20,000 divided by 80,000. 7,20,000 divided by 80,000. How much is that? The variable cost per unit is rupees 9. Correct? Overall variable cost per unit is how much? 7,20,000 total variable cost divided by the total units, right? Next one. How much is the fixed cost? It's given in the question as 3,20,000. The total cost is variable plus fixed. The profit is sales minus total cost they have given. Right, guys? So literally as of now, what you can make out is that how much is the sales? The selling price is going to be 15. Variable cost is going to be 9. So currently the contribution per unit is going to be how much? 6 rupees, right? That's what it is. The profit of 1,60,000, how did they arrive? 6 into 80,000. So 80,000 into 6. 4,80,000 is a contribution. From that, subtract 3,20,000 of your fixed cost. You will arrive at 1,60,000. Marginal costing income statement you can prepare. Next. The capacity of the plant is 1 lakh units. Overall, I have a capacity of 1 lakh, out of which currently I'm selling how many units? 80,000 units, which means 20,000 units I have an idle capacity. Sorry, 20,000 units I have an idle capacity. Next one. A customer from USA is desirous of buying 20,000 units at a net price of 10 rupees per unit. Now, a foreign customer, special order, he says, look, I am willing to buy 20,000 units from you, but max, the selling price which I will pay you is only 10 rupees. Advise the producer whether or not the offer should be accepted. We need to decide whether this offer should be accepted or not. And will your advice be different if the customer is a local one? This is actually a theory question. What it is, I will tell you. Now, you guys tell me, advise whether or not the offer should be accepted. Very simple. Logically, you think, I have a capacity to produce 1 lakh units. Currently, I'm producing 80,000 units, which means the extent of 20,000 units, I have an idle capacity. One guy is coming to me, US client, he's customer, he's saying, I'm willing to pay 10 rupees for every unit. Now, you guys tell me, to produce every unit, what is the variable cost you incur? 9 rupees, correct? Now, on this extra 20,000 units, each unit, right, you are going to earn how much? He says, he will pay you 10 rupees, right? And variable cost is how much? 9. So literally for every additional unit that you are selling, this 20,000 units, you'll be able to generate 1 rupee of contribution, right? So 1 into 20,000 units. So literally extra you'll be getting 20,000 rupees of contribution that will overall build your profit. Are you guys clear with this, right? That's all it is, no, right? So clearly, can you accept the offer? Yes. Why? because as long as for this extra units I am able to recover my variable cost. The selling price is more than the variable cost, so on each of these extra 20,000 units I'm getting a positive contribution. So whatever I get extra is going to build my profit, guys, because for this extra 20,000 units no specific fixed cost is incurred. Already this fixed cost 3,20,000 units, right, is being recovered by the existing 80,000 units, and I'm already reporting a profit of 1,60,000, right? The extra 20,000 units I'm going to sell. Each unit selling price is 10, variable cost is 9, contribution is 1. So 1 into 20,000 units is going to give me 20,000 rupees of extra profit. Guys, clear with this, guys, right? So literally speaking, extra profit that you're going to get, the profit will be increased by 20,000 by accepting the order. Hence, it is advised to accept the same. Clear with this, guys? Now, what they have done, simple. They have prepared the entire marginal costing under 80,000 units. Now, for this extra 20,000 units, what will be the sales? So 20,000 into 10, 2 lakh, minus all the variable costs. So 20,000 into 9, if you get, overall variable cost is how much? 1,80,000. So 2 lakh minus 1,80,000 gives you a contribution of how much for this incremental, for this extra 20,000 units? 20,000. No specific fixed cost is incurred for this. So literally your profit will be increased by 20,000. So what they have done, 80,000 units, they have prepared an income statement, marginal costing income statement. For this extra 20,000 units, they have prepared the marginal costing income statement, 80,000 plus 20,000. Overall for 1 lakh units, they have prepared the marginal costing income statement. But in my opinion, directly you can say no, right? So on this extra 20,000 units, I'll be able to generate a contribution, incremental contribution of 20,000 rupees, right? Clearly you can accept the order because your overall profit will increase by another 20,000. So from 1,60,000, add another 20, the new profit becomes 1,80,000. This way also you can answer and you will say, yes, as a profit increases by 20,000 rupees, you can please go ahead and accept the order. Clear with this, guys? Now, will your answer change if the customer is a local one? Yes. Now, this is not from a costing perspective. This is from a non-cost perspective. Now, generally, I sell it locally. 80,000 units I'm selling. Local sales price is how much? 15. For one customer alone, if I sell it at 10 rupees per unit, obviously the remaining people in the market, they will not be, silent. They will come and ask, for one guy alone you are giving discount. Why can't you give discount to me also, right? It will create tension and rift in the local market. Since this guy is an outsider, right, an export order or an international customer, whatever sales price I fix for him, right, generally is not known to the local market. Suppose in the local market, if I'm making this distinction, right, it will create a problem in my business. So ideally, if you are, if this customer is a local customer, no, do not encourage that. It's basically a theoretical one. If the order is from local one, it should not be accepted because it will adversely affect the present market. This is what they are saying. It is from a theoretical perspective. Are you guys clear with this? That's all this question is all about. Clear with this, guys? Now, you tell me, is there any specific concept here? No, this is just one variant of testing a particular question in marginal costing. That's why I said even CA intermediate students can just, have a look at this kind of question. You can watch out for these kind of questions in your exam, right, guys? So with this, you can just go and update your library of adjustment. Write down accept or reject a special order. Please write down accept or reject a special order. Fine, guys, right? So with this, we have also completed the last part, though I mentioned it is only for CMA Intermediate Paper 8 students, but still, in my opinion, other CA Inter students can also definitely watch out for this area because it is a common sense driven area. Clear with this, guys? So with this, we have literally covered this entire chapter of marginal costing. In fact, though it was marathon, we actually solved about 5 or 6 exact questions we solved, right? In the marathon itself, we solved the 2 comprehensive questions touching about every single concept covered in this particular chapter, right? It's more than a marathon ideally, in my opinion, because every single thing we have derived it based on concepts and other things. But during our regular lectures and all, right, during our regular or the exam oriented batch, we cover a lot of numerical problems, some 30-40 numerical problems depending on, right, the respective courses, CA CMA and all, whatever is that we do in detail. Since this being a marathon, here also I didn't condense on the concepts. Every concept was actually revised. every single concept we did, along with a few numerical problems, which in my opinion were very important for revision. With this, we have comprehensively covered this particular chapter called as marginal costing, right? On that note, let's move on to the next chapter. So now let's get started with the revision of yet another important chapter called standard costing, right? So now, before we get started, so first of all, guys, I want to tell you something very important. This chapter is once again a common chapter both in your CA Intermediate and in your CMA Intermediate, right? In CA Inter, paper 4, Cost and Management Accounting, and in your CMA Intermediate, this chapter is there in paper 8, Cost Accounting, as well as in paper 12, Management Accounting, right? Now, what is there in each of the respective courses? Clearly, I will be talking about that in a few minutes from now. But before that, first I want to make one thing once again very, very clear. This marathon is a common marathon. For this particular chapter, the marathon is common for both CA and CMA intermediate students. However, all our courses, right, be it regular or your exam oriented batch and all that, are exclusively recorded separately for CA intermediate, and even in CMA intermediate, paper 8 recordings are separate, paper 12 recordings are separate, and all the books that we use, right, be it your concept decoder as well as your solved question bank, are completely different, right? The recordings are all separately done, right? However, for the purpose of marathon, since the concepts covered are the same, right, so I'm going to revise it in a common lecture. Clear with this, guys? On that note, let's get started with this beautiful chapter called as standard costing. Now, guys, this particular chapter, standard costing, goes on to achieve the objective of control. Now, we all know that our subject, cost and management accounting, right, it has 3 objectives: stock valuation, profit computation, decision making, and the third objective is control. And each of the chapters in our subject goes on to achieve, right, either one or maybe 2 or maybe all the 3 objectives. In this chapter, right, it goes on to achieve the objective of control, right? Sir, how does it help achieve the objective of control, right? What is this chapter standard costing about and all that, right? Quickly, we will just brush it up here. Now, guys, what happens? Every company, before the start of the year or before the start of the period, they prepare a budget, and once the budget gets prepared, the employees of the organization are clearly assigned their respective duties and they are made to perform the task, right? And at the end of the period, the targets, right, are compared with the actuals, and they analyze the differences between what they were supposed to do and what they have actually done. And once they analyze the difference, obviously certain differences could be favorable for the company, right? Or maybe in certain places the employees would be efficient, in certain areas they might be inefficient. So accordingly, they will reward the employees or punish them. Reward in case they are efficient, or punish in case they are not efficient. Punishment could be a salary cut, or maybe a cut in the bonus, or as the case may be, dismissal, or maybe even a suspension, or as the case may be. So clearly, guys, control involves 4 steps in this particular chapter. Number 1, the company establish standards or targets. Number 2, these targets are evaluated, right? They are compared with the actual performance, and they analyze the variance. Variance means the difference between your target and actual. And finally, they are rewarded, or the company takes corrective actions in case they are not able to meet the targets. This is how control is being established by standard costing. How and all these things, in a few minutes from now, we will start with this chapter in detail, and that's when you will be able to have a crystal clear clarity. Now, guys, always remember, at the beginning of every period, the company prepares a budget. They will say budgeted sales is so much. These are all the budgeted cost I'm planning to incur. So sales minus cost, they will arrive at the budgeted profit. Now, at the end of the period, now all the actual performance is done and actual sales minus all your actual costs gives you your actual profit, right? Now, the budgeted profit and the actual profit will not be the same most of the cases, right? Now, there will be a difference between my budgeted profit and my actual profit, right? This difference is called as profit variance, the variance between my budgeted profit and my actual profit, right? Now guys, now sir, this variance, is it good or bad? It depends. For example, if my budgeted profit, I wanted to earn a profit of 80 crores, whereas my actual profit was 100 crores, I will say there is a 20 crore rupees of variance. Yes, but is this variance good or bad? Sir, you wanted to earn a profit of 80, but you've actually earned a profit of 100. So this is a very good variance for me. So I will call this as 20 crore favorable variance. So I will say the variance is 20, within bracket I will put this F. This F stands for a favorable variance. Suppose I plan to have a profit of 80 crores. The budgeted profit was 80, but the actual profit was only 60. In this case, once again, there is a variance of 20, but this variance of 20 is actually not a good variance. I want to earn more, but I've actually earned only less. So we call this as adverse variance. Clear with this, guys? So in exam, if you just mention the variance alone, it is not it is not relevant. This variance should be suffixed right after this number. You should always write whether it is a favorable variance F or an adverse variance A. Now please don't think, some students mug up, sir, if it is positive it's a favorable variance, if it's negative it's an adverse variance. Absolutely not. Simple. The variance which has the impact of increasing your profit is always a favorable variance. A variance which has an impact of reducing your profit is an adverse variance. Here, profit, we're talking about 80 crores I planned, I have actually earned 100, right? So obviously here it is a favorable variance. Here I plan to earn 80, but I've actually earned only 60. It has an impact of reducing my profit, hence I call it as an adverse variance. Clear with this, guys? Now, sir, profit variance, I say, for example, 20 crores adverse. Now, if I go to my managing director and tell him, sir, the profit variance is 20 crore. Now the next question he'll ask me is, who is responsible for that? Why did I have a 20 crore rupees of adverse variance? Now, the variance in profit can broadly happen because of two reasons. One is variance happening on the sales side. And number two, the variance is happening on the cost side. Once again, the variances happening on the cost side can be further bifurcated into material related variance, labor cost related variances, variable overhead related variances, and fixed overhead variances. Clear with this, guys? So the variance in profit is nothing but sales minus cost. So, sir, the variance in profit can happen because of variances happening on the sales side and variances happening on the cost side. So sales related variances and cost related variance. Further, sir, cost, what are the costs I have? Material, labor, variable overhead, and fixed overhead variances. So literally what we do in this entire chapter, we find out the reason for the variance in my profit, that is budgeted profit and actual profit. We split it out and find out how much is my sales related variance and how much is my cost variance. Cost variance is further bifurcated into material, labor, variable overhead, and fixed overhead variances. Clear with this, guys? So this is the overall objective and big picture of this chapter. And once we find out all these variances, we now know the actual reason why actually the profit has been varied, why there is a difference in between my budgeted profit and actual profit. With this, even a reconciliation statement can be prepared. Are you guys clear with this? Overall, this is the big picture of this chapter. Now guys, sir, what is applicable for my exam? For CA intermediate students, you have all the cost variances, material variances, labor variances, variable overhead variances, fixed overhead variance. CA intermediate, in your syllabus you have only these 4 variances. That's about it. With respect to CMA intermediate students, 2 papers are there. Paper 8 cost accounting, paper 12 management accounting. Paper 8 cost accounting, you have only material variances and labor variances. That's all you have. right? And with respect to paper 12 students, right, management accounting, literally guys, this entire chapter is applicable for you, right? You have all the four cost side variances, plus you also have your sales side variances. Literally this chapter is very extensive for CMA intermediate paper 12 students, group 2 students of CMA intermediate. Clear with this guys? So this is how your syllabus has been bifurcated. But trust me guys, every single thing, concept are all one and the same, right? And once again I'm telling you, this marathon is a common marathon for everybody, CA and CMA Inter students. However, right, our course recordings are completely different. All our paid batches, be it your regular or exam oriented, are exclusively recorded for CA Inter, CMA Intermediate paper 8 and CMA Intermediate paper 12. Even in CMA Intermediate, between the two papers, we don't have a common recording, exclusively done. The books are all separate. Clear with this guys, right? Since it's a common topic that is done here, for the purpose of marathon alone, I'm doing it in a common manner. Right guys, so on that note, let's get started with this particular chapter. Right guys, fine. Now before we enter into this particular chapter, once again let's quickly recapitulate what is the meaning of standard cost, right? So I will recapitulate the meaning of standard cost with a small example, right? Understanding the concept of standard cost, this is very important to set the context. Now guys, now let us say I plan to incur a cost of 1 lakh rupees, right? Budgeted cost was 1 lakh, but actually I ended up spending, let us say, rupees 96,000. Now you guys tell me, how much is the variance, and if so, that variance, is it favorable or adverse? Sir, you could have incurred 1 lakh. You have actually incurred only 96,000. Sir, 4,000 rupees you have incurred less, sir. So it is 4,000 favorable variance for us, right? This is what you might think. Now, let me add one more data here. Let us say this 1 lakh rupees you are allowed to incur for a budgeted output of 10,000 units, right? So I thought you are allowed to incur 1 lakh rupees if you are producing 10,000 units. You have actually incurred 96,000 rupees for producing 8,000 units. Now you guys tell me, first question, now can this 1 lakh be directly compared with 96,000? The answer is absolutely not. Why? Because this 1 lakh is pertaining to a completely different output, and 96,000 is completely pertaining to a different output, right? Actually, I have incurred a cost of 96,000 for producing 8,000 units, right? Now, this 96,000 cannot be compared with a cost pertaining to a completely different output level, right? Now sir, how will we be then able to compute the variance, sir? Now what I will do, based on the budget, I can understand, sir, you are allowed to incur 1 lakh rupees to produce how many units? 10,000 units, which means per unit, how much is the cost you are allowed to incur? 1 lakh divided by 10,000, it's going to be rupees 10 per unit. Clear with this guys, right? Now actually how many units you have produced? Sir, you have actually produced 8,000. So for the 8,000 units which you have actually produced, right, what is the cost you should have incurred? So for each of these 8,000 units you were supposed to incur 10 rupees. So overall you should have incurred 80,000, right? However, you have actually incurred how much? 96,000 rupees. Now this 80,000 can be compared with the 96,000. Why? This 80,000 is the cost which you are supposed to incur for the actual output, whereas this 96,000 is the cost you have actually incurred for the actual output. Here the two outputs are the same, so for the actual output, what is the cost you should have incurred should only be compared with the cost which you have actually incurred for the actual output. Clear with this guys? So here this 80,000 is what we call as standard cost. Clear with this? Are you all able to understand this? Yes. So now basically guys, standard cost, always remember, means the cost which you are allowed to incur for the actual output. So for the actual output, what is the cost you are allowed to incur is called as standard cost. Or in other words, now if you notice here, this 8,000 units is nothing but actual output, right? And this 10 rupees is nothing but standard cost per unit, right? Where did I get this 10 rupees? Using the budget data. So this budget was pertaining, 1 lakh was pertaining to a total of 10,000 units, but using the budget data, I could unitize and understand per unit what is the cost I am allowed to incur. Ideally, this is nothing but budgeted cost per unit, but when we unitize, we don't call it as budgeted cost per unit. When we are unitizing, we call it as standard cost per unit. So standard cost per unit was how much? 10 rupees. So now for the actual output, what is the cost you are allowed to incur? 10 rupees. So now here I will say that, look, you were supposed to incur 80,000, but what has happened? You have actually incurred 96,000. In this case, there is a variance of how much? 16,000 rupees. That too adverse. You have incurred 16,000 rupees more. So don't compare 1 lakh directly with the 96,000 and say 4,000 you have saved. No. For the actual output, you are only allowed to incur 80, but you actually end up incurring 96,000. This is a fundamental understanding before we enter into the standard costing area, because this is a very, very important chapter, as well as you need to have all this background concepts before we get into this particular area. Clear with this, guys? Perfect. Now understand one more thing. The concept of standard means what? For the actual output, what is the cost allowed, right? Or in other words, we can say budgeted cost, this 1 lakh rupees is nothing but the cost planned, whereas actual 96,000 we can say is the cost incurred, and the standard 80,000 is the cost allowed. Are you clear with this? There has to be a clear-cut distinction between understanding the concept of budget, standard, and actual. Clear with this, guys? And always standard only gets compared with actual, and that is the reason why the name of the chapter is standard costing, not budgeted costing. Clear with this, guys? Perfect. Now, I want you all to understand one more thing. The concept of standard is not only applicable on cost, right? For example, you can even apply the concept of standard on your labor hours. For example, now you were allowed to, let us say, take a total of 1 lakh labor hours to produce 10,000 units, which means per unit you are allowed to take 10 labor hours, right? But actually I have taken 96,000 hours to produce 8,000 units, right? Which means, what is the standard labor hours? Means, what is the labor hours you are allowed to take? Actually 8,000 units. Into every unit you are allowed to take 10 hours. Overall you could have taken 80,000 hours, but actually I have taken how many hours? 96,000 hours, which means 16,000 hours I have actually taken more. So, or in other words, the concept of standard can be applied on cost. The concept of standard can be applied on labor hours. The concept of standard can be applied on kgs of raw material consumed, on anything. Clear with this, guys? Basically, what do you mean by standard? For the actual output, how much of cost is allowed, or how much of labor hours is allowed, or how much of kgs you are allowed to consume, and so on. Clear with this, guys? So basically understand one thing, the concept of standard always keeps the actual output as the base to do all the computations. Clear with this, guys? So with this backdrop, let's get started with the first cost variance, called as material cost variances. Clear with this, guys? So first we will get started with material cost variances, right? Now this material cost variance, right, is applicable for, of course, CA intermediate students as well as CMA intermediate paper 8 as well as paper 12 students. So I told you, in CA intermediate all the 4 cost variances, material, labor, variable overhead, fixed overhead variances are there. CMA intermediate, only in paper 8 we have only the first 2 variances, material and labor variances, and in paper 12 all the 4 cost variances plus the sales variance. Entire chapter is there. Clear with this, guys? Have this in your mind, and with that we will get started. Now, guys, material cost variance, right? So is the formula for calculating material cost variance is standard quantity into standard price minus actual quantity into actual price. It is bifurcated into two: material price variance, material usage variance. Material price variance, the formula is standard price minus actual price into actual quantity. Material usage variance is standard quantity minus actual quantity into standard price. Now, this usage variance can be further classified into two: material mix variance and material yield variance. Material mix variance, the formula is revised actual quantity minus actual quantity into standard price, and material yield variance, the formula is standard quantity minus revised actual quantity into standard price, or actual yield minus standard yield into standard cost per unit, or standard loss minus actual loss into standard cost per unit. Sir, so many formulas are there, sir. How do we actually remember? Trust me, guys, you need not even mug up a single formula. Quickly, I will recapitulate every single thing that we are going to do here. Not even a single thing needs to be mugged up. Now, let me take an example. Let us say, guys, my actual output, I actually produced 100 units, right? Now, to produce 100 units, let us say, for example, let me tell you, to produce 1 unit, you are allowed to consume 1 kg of raw material, which means to produce 100 units, how many kgs of raw material you are allowed to consume? Sir, 100 into 1, so 100 kgs of raw material I am allowed to consume. Yes, every kg of raw material you should have purchased at a price of 10 rupees per kg. So I call this as standard price. Means what? The price at which I should purchase every kg of raw material. But however, if you see, actually I was able to achieve this output of 100 units by consuming only 90 kgs of raw material. So the actual quantity consumed was how much? 90 kgs only. Clear with this, guys? And every kg that I actually consumed, right, I purchased it by paying an actual price of how much? 12 rupees per kg. Clear with this, guys? So basically you only need 4 data here: standard quantity, right, standard price, that is the kg of raw material you are supposed to consume, and every kg you are supposed to pay 10 rupees. Actual quantity, you consume 90 kgs, and every kg you have actually incurred a cost of 12 rupees. So now material cost variance is what? Standard material cost, the material cost you are allowed to incur, minus the actual material cost, the material cost you have actually incurred. What is the formula? Material cost you are supposed to incur is what? Standard quantity into standard price. You are supposed to incur, or you are supposed to consume 100 kgs, each kg at a cost of 10 rupees. So 100 into 10, that is nothing but standard quantity into standard price. Literally 100 into 10, the total material cost should have been how much? 1000 rupees. Whereas actual material cost was how much, sir? Actual quantity, I actually consumed 90 kg, each kg I paid 12 rupees. So actual quantity into actual price, that's what is being mentioned here. So 90 into 12, so how much does that come out to? 1080 is the actual material cost which we have incurred. Or in other words, guys, you were supposed to incur a material cost of 1000 rupees, but you have actually ended up incurring a material cost of 1080 rupees. So 80 rupees you have incurred more than what you are supposed to incur, right? So I call the material cost variance as 80 rupees adverse. Clear with this, guys? Of course, because if my actual cost is more than the standard cost, so it will actually reduce my profit. Correct? No, right? It has an impact of reducing my profit. I call it as an adverse variance. Are you guys clear with this? Now, this is why I said don't mug up. Some people, what they do, sir, 1000 minus 1080, which means it is negative, sir, negative figure, which means I need to definitely go, and negative means adverse. Please don't mug it up like this, right? So here, logically think, actual cost is more than standard cost, which means it has an impact of reducing my profit. Hence, I call that as an adverse variance. Now, I go and tell my managing director, sir, material cost variance is 80 rupees adverse. Now he will ask me, who is responsible for this? Now, guys, if you notice, material cost comprises of two components. One is the quantity, the other one is the price, the rate, or the price at which I purchase every kg. Guys, correct? That is the reason why material cost variance is split into two. One is called as material price variance, the other one is called as material usage variance. Now, material price variance, right? Who is responsible for the pricing of this particular raw material, right? Now, actually, in a factory, the purchase manager is only responsible for the price, right? Now, every kg, right, he was supposed to purchase by paying 10 rupees to the supplier. He had to negotiate and make sure that he purchases every kg at 10 rupees only. It is his responsibility. However, due to his inefficiency, what he has done, he has ended up negotiating a deal by paying 12 rupees for every kg of raw material purchase. Clear with this, guys? So, this particular purchase manager is responsible for the price, right? So here what I do, he is responsible for what? Price. Hence, within the bracket I say standard price minus actual price, right? You are supposed to incur only 10, but you have incurred how much? 12 rupees. Clear with this, guys? Into, I multiply this with actual quantity. Sir, why sir actual quantity? If you notice, purchase manager is responsible only for the price decision. Quantity he will not decide. Whatever quantity the production manager asks the purchase manager to purchase, all those quantity he needs to purchase, and on every quantity that he has purchased, right, he is only responsible for the price. Clear with this, guys? Now my my production manager asked me to purchase how much? 90 kgs, because he's consuming only 90 kgs. On each of these 90 kgs, this purchase manager is responsible for the pricing decision. Are you clear with this? Hence, the material price variance will be what? Your standard price minus actual price into actual quantity. That is, the purchase manager is dependent on the production manager for the quantity decision. Hence, I multiply this with actual quantity. So, 90 kgs, sir, I purchase. On each of these 90 kgs, I ended up paying 2 rupees more. So, 90 into 2, 180 rupees is the extra cost I have incurred. Hence, it is an adverse variance. As simple as that. Nothing needs to be mugged up. Clear with this, guys? Next one. On the other side, what do we have? Material usage variance. Usage means consumption. Who is responsible for the usage? Production manager is responsible for the usage. Now, this production manager, he's responsible for what? He's responsible for the quantity, right? So within bracket, standard quantity minus actual quantity will come. You should have consumed 100 kgs, but you consumed only how much? 90 kgs. So 100 minus 90, so you have consumed 10 kgs less. Now I cannot leave it in kgs. I need to give it a monetary value into standard price. Sir, why sir here alone standard price? You are not taking the actual price. Remember, the purchase manager, this guy was dependent on the production manager for the quantity decision. Whereas this production manager is not dependent on the purchase manager for anything. There is a one-way traffic only. Purchase manager is dependent on production manager. Our guy, production manager, he is not dependent on purchase manager for anything, right? Suppose if I take actual price here, then the efficiency or inefficiency of the purchase manager will be passed on to my production manager, right? So I don't want to do that. I want to clearly identify which manager is responsible to the extent of how much to the variance. Clear with this, guys? Hence, I don't take actual price. I only take standard price here because our guy, production manager, is not dependent on whom? The purchase manager. Clear with this, guys? So he's responsible for what? Quantity. So within bracket, standard quantity minus actual quantity into standard price, because our guy is not production manager is not dependent on the purchase manager for anything. Clear with this, guys? So 100 minus 90 into 10. So 10 kgs you have consumed less into 10. It's going to be 100 favorable. Good for the company. Now if you notice, ideally speaking, because of the purchase manager, I have lost 180 rupees. And because of the production manager, I have actually gained 100 rupees. Net of the net extra loss for me is only 80 rupees. So if I just report this 80 rupees, there is absolutely no meaning by itself. Are you guys clear with this? So now what we actually do is that we bifurcate this into price and usage variant and clearly identify who is responsible to what extent and how much do they contribute to the overall variance of the company. Are you guys clear with this? So here, this purchase manager has been super inefficient. right? So I will clearly take a corrective action here. I will never give him a bonus, or I will ask him for a pay cut. Whereas the production manager has been super efficient. Here, what will I do here? So to him, I will say, very good, you have done a very good job. Maybe I will incentivize him by giving a bonus and all these things. This way, overall, it helps in achieving the control. Clear with this, guys? Are you all able to understand? And that's about it. And that's about this area. So now, your material cost variance. What is the formula? Standard quantity. Look at this. Standard quantity into standard price minus actual quantity into actual price, bifurcated into two: material price variance and material usage variance. Material price variance, halt. Whose responsibility? Purchase manager. So standard price minus actual price into what? Actual quantity. Why? Because I'm responsible for the pricing on every quantity that I purchase. Quantity is not in my control, so the quantity is something which the production manager asks me to purchase. Are you guys clear with this? Right now, how about the other guy? Material usage variance. Whose responsibility? Production manager. So standard quantity minus actual quantity into standard price. Why not actuals? Because if I take the actual, I will be passing on the efficiency or inefficiency of the purchase manager to the production manager, while ideally the production manager is not dependent on him for anything. Are you guys clear with this? Logically, if you just remember all these things, there is no way you will find this chapter difficult. It's that simple. Clear with this, guys? Now, suppose a company uses more than one type of raw material. If a company uses more than one type of raw material to produce an output, then your usage variance is further classified into two: material mix variance and material yield variance. Clear with this, guys? So if a particular company is actually using more than one type of raw material, right, to produce every unit of output, then the usage variance is bifurcated into mix and yield variance. Right now, the formula for material mix variance is revised actual quantity minus actual quantity into standard price, and the formula for yield variance is ideally the balancing figure: standard quantity minus revised actual quantity into standard price, or there are two other formulas prescribed here. Now, what is this, sir? Do not worry. This too alone, with the help of a numerical problem of actual example, an actual exam question I will take, and based on that we will be cracking this also. Clear with this, guys? Right? That is actually a strategy to crack all these areas. And the best part is, once you finish material cost variance, automatically labor cost variances, even variable overhead cost variances are very similar, and it will also be done together. As simple as that. Clear with this, guys? That's why I'm spending a little more time here, so that we complete it smoothly. And in fact, guys, we are going to do some numerical problems as well. So I'm going to give an exhaustive coverage in the marathon itself, so that you guys get a very good comfort in this particular chapter. Right, guys? So now I'm going to pick one question from your CA intermediate, uh, in your from your CA intermediate solved question bank. Now, guys, as I told you, there are separate question banks, separate materials we have for CA intermediate, CMA intermediate paper 8. We have a separate book. CMA intermediate paper 12 also we have a separate book. But this particular question, I'm going to take it from CA intermediate, right? CA intermediate solved question bank. It's in volume number 2, right? So I'm going to take this from volume number 2. I'm handpicking a few sums, and that alone I'm covering in the marathon, because in marathon, it is meant for revision purposes, right? When we are learning from the scratch, obviously every single sum we do in all our courses and all, in a marathon we are revising it. Still, for the benefit of all students, I'm setting the background concepts, and I'm handpicking a few sums and doing it in the marathon also, right? I'm doing it only for the benefit of students, but don't worry, in all our courses we do the entire chapter fully. Clear with this, guys? So now let's get started here. So please take question number 2, right? It's on page number 464. This is CA Inter solved question bank. This question is very much applicable for CMA intermediate, both paper 8 and paper 12 also, right? So this is a revision we are doing, so that is the reason why I'm doing it in a common manner. Fine, guys. So now let's get started here. Now, the standard cost of a chemical mixture is as follows. So, one second, I will just take this question separately. Okay, 1 second. Yeah. Okay, guys. Fine. The standard cost of a chemical mixture is as follows. 40% of the material should come from A at the rate of 20 rupees per kg. 60% of material B, that is 60% of the total input, should come from material B, and every unit of B, every kg of B should be purchased by paying 30 rupees. This is the standard price. The standard loss is 10% of the total input. It is expected in production. Now, the cost records for a period showed the following usage, which means what? Actual data is given. 90 kgs of material A was consumed by paying 18 rupees per kg, and 110 kgs of material B was actually consumed by actually paying 34 rupees per kg. The quantity produced was 182 of kgs of good product, which means the actual output was how much? 182 kgs. Right now, this is what they have given. Now, based on this, we need to compute all the material variances. Now, guys, this company is using more than one type of raw material to produce their output. In this case, what happens? You have material cost variance bifurcated into material price and material usage. Further, material usage variance is bifurcated into material mix and material yield variance. Right? Before that, first, guys, we need four figures. What are the four figures? Standard quantity, standard price, actual quantity, actual price. We need it, right? Now, how can we go about with this? First thing you need to know, the actual quantity, actual price and all are available, sir. Actual quantity, material A 90, material B is 110 kg. Actual price 18 for A, 34 for B. All these things I have, sir. Even standard data, standard price I have, A 20 rupees, B 30 rupees. Standard quantity is where many students generally struggle. Simple, guys, simple. Let me just take this up here and put it forward for you. So it's question number 2, your CA Intermediate question bank. Now, how do we go about with this? First, what have they given? What have they given? Raw material A, raw material B, total input. If you look at it, raw material A, basically, guys, what they are saying, say if your total input was 100 kgs, 40% should come from material A. Please have the book with you. You can download the book from our website. Please have the book with you, right? So 40 kgs will come from A. And how about B? 60%, 60 kgs will come from B. Clear, guys? Now they are saying out of this total input, a standard loss of 10% is expected. So a standard loss of 10% on the total input means what? 10% on 100 is 10 kgs of loss is expected, which means effectively you will get an output of how much? 90 kgs. Clear with this, guys? So, or in other words, can I say, if I input 40 kgs of A and 60 kgs of B, effectively only then I will be getting 90 kgs of total output. Guys, correct? This is the meaning. Now, based on this, can we compute the standard quantity data? Yes. Now, standard quantity means what? For the actual output, how many kgs of A and how many kgs of B I should have inputted. This is the meaning. Now, if you look at it, what is the actual quantity produced? 182. Now, keep that as the base, 182 kgs. Now, reverse work, simple. If I input 40 kgs, I need 40 kgs of A to get an effective output of how much? 90 kgs. So, to get an effective output of 182 kgs, how many kgs of A will I be needing? Simple, no? You can just reverse work and calculate. Guys, clear with this? So, 40 is for 90. How much is it for 182? So 40 by 90 into 182. If you do this, you effectively get 80.888888. Alright, so I'm putting it here. It's going to be the calculation. 40 is for 90. So 40 is for 90. How much is it for 182? Clear with this, guys? So literally we will say The standard quantity of A that I should be inputting is 80.888888 kgs, right? Don't round off the decimals. Please retain it fully in your calculator. Next one. Similar calculation for B. If I input, I need 60 kgs of B for an effective output of 90 kgs. For an effective output of 182 kgs, how many kgs of B I should have inputted? Simple, similar calculation. So you can just say, sir, it's going to be 60 is for 90. How much is it going to be for 182? So 60 by 90 into 182. How much you get? You get 121.333333. Right? It's going to be 121.333333. Clear with this, guys? You can add it up, or you can also say simple overall input will be how much? I need to input 100 kgs to effectively get 90 kgs. For an effective output of 182, what should have been my total input? 100 by 90 into 182. You can say that you will get 202.22222, or in other words, you can add these two, you will get that. As simple as that. Clear with this, guys? It's going to be what? 202.22222 kgs is the total number of is the total number of the input, the total quantity of input that I will be needing. Guys, are you all able to understand this? So now literally what has happened here, I should have inputted 202.2222 kgs, right, to effectively get an output of how much? 182 kgs, which means the balancing figure, the difference between these two is going to be what? My standard loss. Are you guys able to understand? So how much is going to be my standard loss? The difference between the two. So 202.222, or in other words, you can also say 10 is the standard loss allowed for 90 kgs. How much is it going to be for 182? So 10 by 90 into 182, you will get 20.222, or in other words, 202.22 is the input allowed to get an effective output of 182. So the standard loss allowed is going to be how much? So it's going to be 20.2222 kgs. Are you guys clear with this? Right? So literally, this is how your standard quantity column will look like. Guys, are you all able to understand? Now, this is exactly what I have already done here itself. This calculation. This is how I have done this standard quantity. 80.888888 kgs is the kgs of A that you should have inputted. Kgs of B you should have inputted is 121.33333. You can see all the calculations. The back working is all given here. Just now we have done it. Clear with this, guys? Right? The total input that was supposed to be done less loss, standard loss, you arrive at the effective output. Ideally speaking, this has to be 20.22222. Clear with this, guys? Right? Now, what is the standard price? Now, we know it's given in the question. Every kg of A should be purchased at 20 and B at 30. So you can put it up here, 20 and 30. And how about the actual quantity? So actual quantity, 90 kgs of A. This is the actual, right? 110 kgs of B. Overall, what was the actual input? I have actually inputted how much? 200 kgs. Effectively, I got an output of how much? 182. By inputting 200, I actually got how much? 182 kgs, which means the actual loss was how much? 18 kgs. This is nothing but the actual loss. Clear with this, guys? What is the actual price here? The price was for A, 18 rupees per kg. B was purchased by paying 34 rupees per kg. Clear with this, guys? All these things are available. So now what you need to do? Standard quantity into standard price. You'll get the amount column. So 80.888888 into 20. So 80.888888 retain full decimals into 20. Effectively, you get 1167.7777. Then 121.333333 into 30. If you do, you get what? 3639.999. That can be rounded off to 3640. If you add the two, you get how much? 9257, 5257.777. Right? Ideally speaking, this is the total cost of material which you were supposed to incur to get an effective output of 182. Ideally speaking, the standard quantity into standard price, the total raw material cost allowed to be incurred is going to be 5257.777. But what is the actual cost? 90 into 18. How much is that? 1620. 110 into 34. How much is that? It's going to be 3740. If you add up the two, you get 5360. So the actual cost incurred was 5360 for the actual output of 182. So literally first the material cost variance, standard quantity into standard price minus actual quantity into actual price. Clearly you can say this is the cost you are supposed to incur, whereas this is the cost you have actually incurred. Or you can do product wise, standard quantity into standard price minus actual quantity into actual price. You can do it. That's what we have totaled it up and we have arrived at here. So it's 5257.7777 minus 5360. You actually get 102.2222 adverse, right? So 102.2222 adverse is actually going to be my total material cost variance. Are you guys clear with this? So this is the cost I should have incurred, 5257.7, but I have actually incurred more, right? So 5360, hence clearly there is an adverse variance. Are you guys clear with this? The most important thing with respect to standard quantity, and the beautiful area is that standard quantity starts from the actual output. Reverse working you need to do. Sir, for the actual output of 182 kgs, what is the cost? I mean, how many kgs of A, how many kgs of B I was supposed to consume? This working you need to do. Only if you do this, you will arrive at the proper standard quantity. Every other data is available. We just need 4 ingredients: standard quantity, standard price, actual quantity, actual price. Right? Actual quantity, actual price was available. Even standard price was available. Only standard quantity was required. And if you do it this organically, that's all is required. That's the reason why I started off even this revision marathon with the concept of understanding your standard cost and all. This is the reason behind that. Clear with this, guys? So the first thing that we have done is what? The first thing we have done is arrived at the material cost variance. Next one, what should we do? Material price variance. Now, what is the formula for material price variance? Simple. Material price variance is going to be, first, who is the responsible person? Your purchase manager. So we will say standard price minus actual price into actual quantity. Correct? This is going to be my material price variance. Right? Now what we need to do, raw material wise, we need to compute. Simple. Clear with this, guys? The logic and everything we have seen here, right? So now we just need to do this raw material, I mean your every single raw material wise. So first, for material A, how much is the standard price? 20. How much the actual price? 18 into how much the actual quantity? 1620. So 20 minus 18, right, into actual, I'm sorry, actual quantity was 90. So 1620 is actual quantity to actual price, sorry. So 20 minus 18 into 90 kgs. So each of the 90 kgs I have purchased by paying 2 rupees less. So obviously it's a favorable variance. So 180 favorable. This is for raw material A. How about raw material B? Standard price minus actual price into actual quantity. You were supposed to incur 30. You have ended up incurring 34. 4 rupees you have incurred more on each of 110 kgs. So it's going to be 440 adverse. So net off, if you see 440 adverse minus 180 favorable, there is a net adverse of how much? 260 adverse. Are you guys clear with this? Right? And that's about this particular variance also. Guys, are you all able to understand? That's about it. Now comes your material usage variance. Material usage variance. So what is the formula for material usage variance? You guys tell me. So the material usage variance is going to be, right, standard quantity minus actual quantity into standard price, right? So this is the quantity, right? The quantity you should have consumed minus the quantity you have actually consumed into standard price. This is what we have seen, logic and everything we have seen now. Now guys, now material usage variance, what you need to do once again, so component wise you just need to compute, right? Once again they have mentioned all this. This is not required. Fine. What you need to do, so product wise you need to compute 80.888 for first raw material A. Standard quantity is 80.88888, but actual quantity was how much? 90. Correct? So which means you are supposed to consume only 80.88888. You have actually consumed how much? 90, right? Into standard price 20. So what you need to do, 80.88888 minus 90. Literally you have consumed 9.11111 kgs more, right? So 80.88888 minus 90 into, so how much is this? 20. So how much you get? 182.22222 adverse. Are you guys clear with this? Here what they have done, 80 into 182 by 80. So all those things are not required. Directly we have computed. So 80.8888. That's all you need to write here. So you just need to write 80.888888 minus 90 into 20. If you do the calculation, you get 182.222 adverse, right? Similarly, for material B, 121.33333 minus 110. You should have consumed 121.333, but you've actually consumed only 110. Guys, are you all able to understand, right? So the difference is how much? 121.33333 minus 110. You get how much? So 11.33333 into standard price. How much is standard price? 30. How much you get? So 339.999, or in other words, it's going to be 340 favorable. You were supposed to consume 121.33. You've consumed only 110. Your consumption is less, which means it's savings in cost. So it's a favorable variance to the extent of 340. Are you guys clear with this? So here it's going to be 121.333. I'm putting it down. 121.3333 minus 110. That is what has been mentioned here. Minus 110. I think there's a mistake, right? Minus 110, right? Into standard price, which is 30. If you calculate exactly, it is going to be how much? 340. So what's going to be your total usage variance, guys? Your usage variance is 182.222 adverse for A, 340 favorable for B. So now what happens? Net off 340 minus 182.22222. You get how much? 157.77777. You get it as favorable. Clear with this? Clear with this, right? So this is what you get it as. This is what you get as your material usage variance. Now quickly, I'll go here and sum it up. Quickly, I will just go here and sum it up. Till now, what have we got? So material cost variance. How much was the amount we got? We got 102.2222 adverse. Now this is bifurcated into two. What and what? Material price variance, material usage variance. Now how much is my price variance? We calculated it was 260 adverse, and the usage variance we calculated just now, it was 157.77. It was roughly 7777. It was going to be favorable, right? Or you can put it as 78, 777 or 78. So if you net off these two figures, if you add these two figures, you should get your topmost figure. Let us check that. So 260, it is adverse, and favorable is 157.78 roughly. So minus 157.78. If you do net off, you get how much? 102.22222 adverse. Clear with this, guys? So it is an arithmetical check which you can do. If you add your price variance plus your usage variance, you should get your top figure called as material cost variance. So this is one check that you can do. Clear with this, guys? Perfect. Now I told you this usage variance can be further categorized into two more. What and what? Material mix variance and material yield variance. Clear with this, guys? Right? Now, sir, how do we compute it? You gave some formulas and all. So now, sir, how do we go about with this? Now, I will walk you through here. First, material usage variance. You guys tell me, what is the formula? First, who is responsible for this? Obviously, your production manager, right? So now the formula for this is going to be standard quantity minus actual quantity into standard price. Correct? Now, I told you guys, this is bifurcated into two. What and what? Material mix variance, material yield variance. Material mix variance, the formula is going to be revised actual quantity minus actual quantity into standard price, right? Now what is the yield variance? Now yield variance is ideally the balancing figure. Now if you notice, now I have on the outside, within the bracket I have something. On the outside I have standard price, correct? So clearly here also I have standard price. Outside here also I will have standard price. Now look at this. On the top, I need to get standard quantity minus actual quantity. Whereas on the left side, I have RAQ, something new was introduced, revised actual quantity minus actual quantity. But if you notice, if I add my mix and my yield variance, I should get my top figure. Right now, I should get standard quantity minus actual quantity. But as of now, I have what? RAQ minus AQ. So minus actual quantity I have. But here I have introduced a guy called as revised actual quantity. So now what should I do? I should ideally get standard quantity, right? But now I have revised actual quantity. So literally what I will do, here I will introduce standard quantity and I will subtract revised actual quantity. Sir, why do you do this? Simple. Only then, if I add the two, what happens? Revised actual quantity is here. Now this will get knocked off with minus revised actual quantity, right? And if I add the two, I will get standard quantity, which I want, minus actual quantity, right? The whole into standard price. Clear with this, guys? Or in other words, this is nothing but balancing figure, right? I will also tell you the logic, don't worry. Or if at all you forget, you can remember only this. The other one is a balancing figure. So I have R revised actual quantity minus actual quantity, but I want a standard quantity minus actual quantity. So minus actual quantity is already there. So what I need, sir, I need to replace RAQ with SQ. So SQ minus RAQ. Only if I do that, RAQ gets knocked off and I get standard quantity, and minus actual quantity is already there into standard price. Clear with this, guys? But before that, first, sir, why do we do this? I will tell you how to compute revised actual quantity. First, I will tell you, and then you will be able to understand. First, material mix variance. Let us do this. Now, so your raw material revised actual quantity, standard price, and your material mix variance. Now guys, first fill this column actual quantity. Now let me go back to the question. Now what is my actual quantity? Here we have 90 kgs of A and 110 kgs of B. Correct? So I'll put it up here. It's going to be 90 kgs. So first A and B I will write down. A, B, then I'll write down the total. Now actual quantity is how much? 90 kgs of A and 110 kgs of B. So the total was how much? 200 kgs was the actual quantity consumed. Correct, guys? Right? I'm talking about the input. Right? Now what you do? Revise the actual quantity. Take the total and put it here. How much was the total actual quantity? 200. Perfect. Now revise the actual quantity means what? Fine. You have actually consumed a total of 200 kgs. Fine, be it so. But this 200 kgs of total actual input should have been consumed in the standard mix, the proportion. What is the proportion in which you should have consumed? Sir, 40% should have been A, 60% should have been B, right? So now what I will do, I will take the total actual input, right? And I will revise that actual quantity for the standard mix. 40% should come from A and 60% should come from B. That's what the question says, 40 for A and 60 for B, right? So 40A and 60B. So now put it here. So 200 into 0.4, 40 for A. How much is it coming out to? 80 kg should have been A. And 60% for B. So 200 into 0.6 is going to be how much? 120. Literally, guys, this should have been 40%. This is 60%. Are you clear with this? So I introduced a column called revised actual quantity. Means what? I take the actual quantity and I revise it only for the mix. Sir, it should have been, for some reason you have consumed actual quantity of 200. I am not comparing standard with actual. I am comparing here what I am doing. Sir, actual quantity itself I am taking and I am revising it for the standard mix. Clear with this, guys? So here literally I am comparing actual quantity at standard mix with actual quantity at actual mix. Mix means proportion. Clear with this, guys? So the actual quantity, this itself should have been in what mix? 40:60, right? But so that's why I revised my actual quantity. Clear with this, guys? And that I am comparing with the actual quantity, right? Clear with this, guys? So now how much is the standard price? I mean, for this question, standard price we already know. The standard price is here 20 and 30 respectively. Let's put it up here. It's going to be 20 and 30 respectively. So now what is my material mix variance? You could have consumed 80. You've consumed how much? 90. Clear with this, guys. So now how much you consumed? 10 kgs more into 20. So 10 into 20, how much you get? You get 200. Is it adverse or favorable? Obviously adverse. You've consumed more than what you're supposed to. And how about here? 120 is the revised actual quantity minus 110. You are allowed to incur you are allowed to consume 120. We've only consumed 110. So 10 kgs less into 30. How much does that come out to? It's going to be 300 favorable. So the net of these two comes out how much? 300 favorable, 200 adverse. Net off is going to be 100 favorable. Clear with this, guys? Now, sir, what do we calculate in this material mix variance? What does this indicate? Simple. Understand, guys, here if you notice, we are not comparing standard quantity with actual quantity. We are only comparing actual quantity with actual quantity. Then what are we comparing, sir? Actual quantity at the standard proportion, standard mix is being compared with the actual quantity as at actual mix. Now, for some reason, you have actually consumed 200 kgs. Let me keep it there. But this 200 at least, you should have retained the mix. Correct? Now, what has happened? What has happened? This 200 kgs at least, it should have been in the ratio of 80 kgs of A and 120 kgs of B. Whereas what you did, 90 kgs of A you consumed and 110 kgs of B you had consumed. Clear with this? Now, between A and B, which is a costlier raw material? Obviously, raw material B. 30 rupees per kg, sir. Whereas raw material A is only 20 rupees per kg. Now, what these people have done, literally for A, cheaper raw material, instead of 80 kgs, they have consumed 90 kgs. Or in other words, they have consumed 10 kgs more of a cheaper raw material. So how could they consume 10 kgs more? Because in raw material B, costly raw material, they consumed 10 kgs less. Or in other words, they changed the actual mix. The actual proportion was 90s to 110. How, sir? They consumed less of a cheaper raw material and more of a costlier. They consumed less of a costlier raw material. A costlier raw material was consumed less. And this kgs, 10 kgs, they actually consumed more of a cheaper raw material. Now, if you sacrifice a costlier raw material and instead that you use it in actually a cheaper raw material, what happens? Obviously, you will save some cost. Clear with this, guys? Or in other words, this 100 rupees of favorable variance has clearly been achieved not because of efficiency, because I deviated from the mix. This is nothing but adulteration. Sir, here I should have used what? I should have used 80 kgs of A and 120 kgs of B. But what I did, that's how 200 should have come. But this 200, how I achieved? Right, 10 kgs less I consumed B. 110 kgs only I consumed. What I did, this 10 kgs I added here in A. Right, instead of 80 I consumed 90. So I consumed more of a cheaper raw material, less of a costlier raw material. Because of this, I achieved this 100 rupees of favorable variance. Ideally speaking, this 100 rupees of favorable variance is not because of the efficiency of the production manager to the extent of material mix variance. Here, this favorable 100 rupees of variance is purely attributable to your adulteration, the mix. Clear with this, guys? So what we are doing here, the usage variance overall is being further classified into mix variance and yield variance. In the mix variance, we are calculating not standard and actual. We are comparing look, because of deviating from the mix, how much is it contributing to your total variance is what is being found out in this particular material mix variance. Are you guys clear with this? Now, on the other hand, you have material yield variance. Here, what do we compare? The balancing figure. Standard quantity minus revised actual quantity into standard price. Now, clearly understand here. Here, we are comparing the standard quantity with the revised actual quantity. Clear with this, guys? Clear with this? Sir, why, sir? Now, if you notice here, standard quantity and revised actual quantity is being consumed. Here we compare the standard quantity. Obviously, the standard quantity will be in 40s to 60 in the standard mix. We compare that with revised actual quantity. We are comparing the actual quantity at standard mix. So literally here we are not capturing any variance happening on account of mix, because this is also in 40-60 ratio. This is also in 40-60 ratio, revised actual quantity. So here the deviation in the mix is being separately captured here. So we don't consider any mix variance here. Here we only look at the overall quantity difference. Standard quantity is being compared with revised actual quantity. So because of the overall consumption, the quantity difference alone, how much is going to be your variance is what is being captured under material yield variance. Clear with this, guys? Or in other words, literally, you have standard quantity, you have actual quantity. In between, I introduced a guy called revised actual quantity. Now, this variance, usage variance, talks about standard quantity compared with the actual quantity. Now, what I did first, mix variance, I compared what revised actual with revised actual quantity with actual quantity. And now in the yield variance, I'm comparing standard quantity with the revised actual quantity. This way, I have broken down the material usage variance into material mix variance and material yield variance, where mix variance captures the deviation happening, the variance happening on account of change in the mix composition, whereas the yield variance captures the variance happening on account of deviation in the overall quantity consumed, while this will not capture any difference in the mix because that has already been captured under mix variance. Are you guys clear with this? This is how you need to learn this area. Nothing needs to be mugged up. So now just fill in the blanks, and that's about this area. So now what do you need to do? Standard quantity minus revised actual quantity into standard price. This is what you need to do. Simple. So raw material A. What is the standard quantity? Now standard quantity here, raw material A, raw material B. Let's put it up here. What's the standard quantity? Maybe you can just take it from here. Standard quantity is 80.888888 and 121.33333. So 80.8888 and it's 121.3333 minus revised actual quantity 80 and 120. So it's going to be 80 and 120 into what is the standard price? 20 and 30 respectively, right? So how much is this? 80.888888 minus 80, right? So you are allowed 80.88, you have only consumed 80, so 0.8888 less into 20. How much you get? 17.7777 favorable. 17.7777 favorable. Similarly here, 121.3333 is what you are allowed to spend, consume, but you have consumed only 120, so 1.333 kgs less into 30. You get how much? 39.9999, or it's going to be 40 once again favorable, right? So it's going to be total 57.77777 favorable. Clear with this, guys? Or here, if you notice, my mix variance is 100 favorable and my yield variance is 57.77777 favorable. Are you guys clear with this, right? So here, material mix variance, I'm updating. It is going to be how much? 100 favorable, and material yield variance is 57.777 or 78 favorable. Clear with this, guys? Once again, here you can check material mix variance plus material yield variance. So 100 plus 57.78 gives you 157.78, your material usage variance. Or in other words, what is the understanding, sir? Sir, production manager, how much is the variance he is responsible for? Usage variance 157.78. Very good, sir. Very efficient. No, to the extent of 57.78 shows his efficiency, because that is the difference between standard quantity and revised actual quantity. Standard is compared with actual. Whereas to the extent of 100, it was not because of his efficiency, because he used more of a cheaper raw material and less of a costlier raw material. Because of the change in the composition, 100 rupees was the actually variance that is attributable to this. So clearly now you can understand and judge. Now the managing director will not be happy for this 100 favorable variance. It is impacting on the quality of the product. Clear with this, guys, right? So literally, genuinely, he should be rewarded only for this yield variance, which genuinely it is because of his efficiency level. Mix variance is because of adulteration with this guy has done. Clear with this, guys? So this is the beauty of marginal costing. It will break down every your standard costing, it will break down every single variance and clearly tell who is responsible for what variance to what extent, and the reason. If you know for every single variance, nothing more you need. Clear with this, guys? And that's about this particular question. Now, guys, I told you for your material yield variance, you also have two other alternative formulas. Quickly, let me just walk you through that also. Now, another formula for material yield variance is actual yield minus standard yield into standard cost per unit. Now, let me just write it down here. Material yield variance. Yield means output. What was the formula we saw here? Actual yield minus standard yield into standard cost per unit, right? All these three are new terminologies. What it is, I will tell you, right? You can easily understand. Now, first, standard cost per unit. Per unit means it is not per kg of input, it is per kg of output. Clear with this, guys? What is it? I will tell you. Now, literally we saw standard, we computed, right? Overall, you should have incurred a cost of how much? 5257.777. You should have incurred this cost for an effective output of how much? 182 kgs, which means what is the standard cost per unit of output? In this case, the output is also in kg. So per kg of output, what is the cost you are allowed to incur? So 5257.77777 divided by 182. How much you get? 28.888888, right? So clearly I will say here the standard cost per unit of output or per kg of output is going to be rupees 28.888888. Clear with this, guys? Right? So suppose if they ask, you can actually do it in this way also. Now in your CMA intermediate, right, you have this formulas, these alternate formulas. In your CA intermediate, these formulas are not there as such, but at times I have also seen institute suggested answers where they have used these formulas. In RTP I've seen a couple of times where they have used this formula also. So it is not like it's not there for you. Definitely these are concepts of standard costing globally are there, right? So they are one and the same. So there's nothing like specific for CA Inter or CMA Inter here. Clear with this, guys? Now the standard cost per kg of output is how much? 28.888888. Clear with this? This is the cost per kg of output you are allowed to incur. Now yield means output, right? Actual yield minus standard yield. What is the actual yield? Actual yield is actual output. How much is the actual output the company has achieved? 182 kgs. Correct? So put it up here. 182 is the actual yield. Now standard yield here means, please understand, here it's nothing but standard output for actual input. Sir, what is the meaning of this? I will tell you, and logically also we will understand this. Now actually I have inputted a total of how many kgs of input? 200 kgs of input. Correct? Now they have mentioned in the question a standard loss of 10% is allowed. Correct? Now a standard loss apply on the actual input 200 kgs, right? Now you were allowed, let us say, for 200 kgs, assuming after allowing for a 10% of standard loss, so minus 10%, how much is that? 20 kgs. You would have got an yield of how much? 180 kgs of output. Output you would have got how much? 180. I'm repeating, the standard yield, the output, standard output for the actual input will be how much? 200 minus 10% loss 20 gives you how much? 180. This is called standard yield for the actual input. Clear with this, guys? How much is it? 180. Clear with this, guys? 180. Now what they are saying, for the actual input, they kept input as the base here. You have actually achieved how many kgs of output? 182. But you should have ideally got only 180 kgs of output. Clear with this, guys? So literally you have got how many kgs of output more? 2 kgs of output. Clear with this, guys? This is kg of output. Correct? Hence I am multiplying this with standard cost per unit. Now 2 into 28.888888. How much you get, guys? How much you get? This is nothing but here you get 57.77777. Is it favorable or adverse? Obviously favorable. You have actually got an yield of 182 units. or kgs, but you should have got, for the actual input that you had inputted, you should have got only 180. So 2 kgs you've got more, and every kg is valued at a cost of 28.8888. Literally, you have got yield variances. How much? 57.777 variable favorable. Clear with this, guys? This is exactly what we got using that formula also. This formula also you got 57.777, right? That is exactly what we've got here as well. Clear with this, guys? This is another way of computing. Or there is one more formula. What is that formula? Standard loss minus actual loss into standard cost per unit. I'm putting it here. Standard loss minus actual loss into standard cost per unit. Now standard cost per unit, you guys know it's 28.888888, right? Now standard loss minus actual loss, what it is, clearly understand here the wordings are a little different. Actual loss, actually I've lost how much? Sir, I inputted 200 and I got 182, which means actual loss was how much? 18. But for the actual input, what is the loss I could have earned? I mean, what is the loss that was allowed for the actual input? 10% was allowed. 10% on 200 is how much? 20. So you could have lost 20, but you have lost only 18. Clear with this, guys, right? So standard loss here represents standard loss for actual input. Clear with this, guys? So standard loss for actual input, for this two formulas alone, the actual input is kept as the base. Are you guys clear with this, right? So the standard loss for actual input, how much is it? 200 you have actually inputted. For that you could have lost how much? 20 kgs, but you have lost only how much? 18 kgs. Since you lost 2 kgs less, ideally this is the reason why you got 2 kgs more as an yield, guys, correct? Or in other words, the difference in your output is nothing but the difference in your loss, guys. Clear or not? That is the reason why you got an yield variance. So how much is it? The same 20 you could have lost, but you've lost only 18. So 2 kgs you've lost less. So 2 into 28.888888. Literally, what do you get here? You get 57.77777 favorable. The same answer you will get under all the 3 methods. Correct. This is for yield variance. First formula is standard quantity minus revised actual quantity to standard price. You use this formula generally. Suppose they have asked in a particular question, calculate the yield variance alone, right? And they have not given all this data. They have given actual yield, standard cost. Based on this, they have given all the data. Only then you will use either of these 2 formulas. Are you guys clear with this? This could be a trick hack in your exam. In case they ask this, you can cover this also. Are you all able to understand this? And that's about this question. A comprehensive question covering one question that covers the entire concept of material cost variance with all possible adjustments, right? And this was once tested as a past exam question as well, right? Definitely it will carry a huge weightage in your exam. Fine, guys. So please go and update your library of adjustments. Write down material cost variance hyphen mix of raw material with losses. Mix of raw material with losses. A very good question, a signature and a masterpiece question, a must visit the day before your exam. That is the kind of importance I would attach to a question like this. So please mark this as a very, very important question. Fine, guys. Perfect. So now let's move on to the second segment of discussion, which is labor cost variances. Right? Fine. Now, guys, labor cost variances is exactly same as your material cost variance. Only one difference is here. Now, instead of quantity, here you have hours, right? There it was standard quantity, actual quantity. Here we have standard hours, actual hours. There we had price. For material, we call it as price. Standard price, actual price. Here we use standard rate, actual rate. So instead of price, here we have rate. Instead of quantity, here we have hours. That's all is the difference here. Look at this. Labor cost variance. What is the formula? The labor cost which you should have incurred, standard hours into standard rate, minus the actual labor cost you've incurred, actual hours into actual rate. Now, it's bifurcated into 2. What and what? labor rate variance and labor efficiency variance. Now, who is responsible for rate variance? The HR manager of the company. Now, he is responsible for negotiating the wages with the workers. Now, so what is his responsibility? Rate. So, standard rate minus actual rate into actual hours. Why? He doesn't decide for how many hours he should make the workers work. That is a decision of production manager. So, literally, for the actual hours which the production manager is making the workers work, our HR manager is responsible only for the rate. Hence, that is going to be standard rate minus actual rate into actual hours. Whereas on the other side, labor efficiency variance, whose responsibility is this? The production manager's responsibility, right? So what is the formula? Standard hours into standard rate into, standard hours minus actual hours into standard rate. Why? Here, the HR manager is, the production manager is not dependent on the HR manager for anything, right? Suppose instead of standard rate, if I take the actual rate here, then I am passing on the efficiency or inefficiency of the HR manager to the production manager, which is wrong. That is the reason why here have standard hours minus actual hours into standard rate. Are you guys clear with this? Now, efficiency variance is further classified into two: labor mix variance and labor yield variance. Mix variance is also known as gang variance, right? And yield variance is also called as sub efficiency variance, right? Efficiency, this is sub efficiency. Simple. When will these two variances, mix and yield variances, when will they arise? When a company is using more than one type of skill set laborers, that is skilled, semi-skilled, unskilled. When I have more than one variant of workforce, labor force, in that case I have mix variance and yield variance. Now, what is the formula for mix variance? Revised actual hours minus actual hours into standard rate. Exactly everything is same. Here you have what? Balancing here. Standard hours minus revised actual hours into standard rate. By the way, guys, I think I forgot to mention this. Now, earlier we had this in your material mix variance, I told you the formula is revised actual quantity minus actual quantity to standard price, right? Now, for examination purposes, logically speaking, revised actual quantity is the more sensible usage because the actual quantity is now being revised, correct? So, on the actual quantity, I'm revising with what? Standard. That's why I'm calling it as revise. So, the revision happens on the actual quantity. But in exam, in your study material, both in CA as well as in CMA intermediate study materials, they have mentioned this as revised standard quantity. That is, the manner of computation is same. The terminology alone, the wording alone, they have made it differently, right? Instead of revised actual quantity, it is better to mention it as revised standard quantity. In exam, just write it down as revised standard quantity. But however, you remember, the manner of computation is same. Clear with this, guys? That's why I told this as revised actual quantity and did, so that, for understanding purpose, you will understand the logic, right? Later on, at the end, I wanted to mention it as revised standard quantity. That's why I have put a circle here and written it down as revised standard quantity. Just in examination, use the words revised standard quantity. Manner of computation, same. Now, here, what do we have? So similarly here, revised actual hours. Actually speaking, what do we do? On the actual hours, we revise it for the standard mix, but in examination, write this as revised standard hours. Right? The terminology around is different. The manner of computation is exactly the same. Clear with this, guys? And or there is another formula here. Actual yield minus standard yield into standard cost per unit. Here you don't have the loss because in labor there is no concept of loss. So actual yield minus standard yield into standard cost per unit. This is another formula exactly same as what we saw in our material variances. Now, sir, without any further delay, let's go and do a few numerical problems. With the help of that, we will complete this aspect also. So that's all, sir, in labor cost variances. There is one more thing called as idle time variance. What is it and all? I will just walk you through with the help of a numerical example. Quickly, let's get started. Now, please take your CA intermediate, once again, CA intermediate solved question bank, right? Please take question number 4. Please take question number 4. Yes, please take question number 4. Right? This is definitely applicable even for CMA intermediate students. Don't think that it is something applicable only for CA inter students. Nothing of that sort. It's applicable even for CMA intermediate students. Right? So I will definitely not take something which is not applicable for one particular set of students. If that is the case, then I will make it separate. Nothing to worry, and I will clearly mention what is what as well. Right? So come on, let's get started. The standard and actual figures of the firm are as under. Standard time for the job. For a job, you are allowed to take how many hours? 1000 hours. Okay, perfect. So this is nothing but your standard hours. What is the standard rate per hour? Every hour you should have paid how much? 50 rupees. Actual time taken 900 hours. It is actual hours. Actual wages paid. How much was it? 36,000. What is the meaning of this? Literally, actual hours into actual rate is equal to how much? 36,000. So now with this we can compute actual rate, no? Yes, how? Because actual hours was how much? 900 rupees, 900 hours. So 900 hours into actual rate would have been 36,000, or actual rate is equal to, so 36,000 rupees is the overall labor cost for 900 hours. What is the cost per hour? It's going to be 4 rupees per hour. So it's going to be 40 rupees per hour. So yes, 36,000 divided by 900, it's going to be 40 rupees per hour. Clear with this, guys? So now we have all the ingredients. Standard hours 1000, standard rate 50, actual hours 900, actual rate is 40. So now you just have to go ahead and compute. So what is going to be a labor cost variance? So now quickly I will just write it down here. One second, I will just take the question for my reference. That easy. I hope you guys have downloaded the materials. So yes, writing down, this is question number 4. Yes, so question number 4. So standard hours is going to be 1000 hours. Standard rate is going to be 50 rupees per hour, and the actual hours is going to be 900 hours, and the actual rate is going to be how much? Rupees 40 per hour. Now what is going to be my labor cost variance? Standard hours 1000 into standard rate 50. This is the cost you should have incurred, whereas actual cost is how much? 900. Actual hours into actual rate. So it's going to be 50,000. One second. Yes, 50,000 minus, so 900 into 40 is going to be 36,000. So you were supposed to incur a cost of 50, but you have incurred only 36,000 rupees of labor cost, which means there's a 14,000 rupees of favorable variance, right? This is bifurcated into two. What and what? Labor rate variance and labor efficiency variance. That's about it. Labor rate variance. What is the formula? Who is responsible? The HR manager. Hence, what is going to be the formula? Standard rate minus actual rate into actual hours. So you should have paid 50, but you've paid only 40 on how many hours? Actually 900 hours. So on each of these 900 hours, you've saved 10 rupees for the firm, for the company, which means how much is the rate variance? So it's going to be 900 into 10, 9,000, obviously favorable. You've saved money for the company. And on the other hand, the efficiency variance is what? Standard hours minus actual hours into standard rate. How much is this going to be? Standard hours, every hour, you should have spent a total of 1000 hours, but you've actually spent only 900 hours into what is the standard rate? It's going to be 50. So you've saved 100 hours for the company. So 100 into 50, how much is that going to be? It's going to be 5,000, right? And it's going to be favorable. So you can also check, it's going to be 9,000 favorable plus 5,000 favorable. You get your top figure, 14,000 favorable. As simple as that, guys. Logical, simple and straightforward. Literally, look at this. We spent very little time in labor variance. Why? Because the foundation of this, we actually spent more time on material cost variances. As simple as that. Nothing beyond it. So please go and update your library of adjustments. Write down labor cost variance hyphen single skill set. Only one skill set is that. That is, there is no mix of skill set and all. Please write down single skill set within bracket without idle time. Within bracket without idle time. Within bracket without idle time. That's about it. Look how beautifully we can cover this area. So that's why we spent more time on material cost variance, and the two other variants, labor and variable overhead variances, are very similar to the concepts which we have studied there in material variance. That's why there's a beautiful saying of Abraham Lincoln: if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe, right? So we spent more time on the preparation so that the execution takes only a lesser span of time. That's about it. Now please go to the next question. We can take question number 5 from the same CA Intermediate only solved question bank. We will take question number 5, and with the help of this particular question we will see the treatment in case of idle time. All right, now quickly, the standard output of a product X is 25 units per hour in a manufacturing department of a company employing 100 workers. Perfect. Now what have they mentioned? Right, the standard output of a particular product is 100 units per hour in a manufacturing department of a company employing 100 hours, 100 workers, which means what? If 100 workers simultaneously, if they are working for 1 hour, 25 units can be produced, or in other words, can we say 100 man hours. If you spend 100 hours totally, that is 100 workers each spending 1 hour, means what? 100 man hours if you are spending, you will be able to generate how many units? 25 units. This is the standard. Next, the standard wage rate per labor hour is 6. So per person per hour, per man per hour, I'm going to pay them. You are allowed to pay how much? 6 rupees. Next, in a 42-hour week, in a week there are 42 hours, the department actually produced how much? 1040. The actual output, this is the base for all calculations, is 1040. Despite 5% of the time paid being lost due to abnormal reason. The hourly wages actually paid were 6.2, 6 and 5.7 respectively to 10, 30 and 60 of the workers. Calculate the relevant labor variances. Now guys, now a very important calculation is something that we need to do here. Now if you notice what has happened here, now there is no multiple skill set of workers and all. Look, 100 workers you have, all the 100 workers should have been paid at the rate of how much? 6 rupees. But what did this HR manager do? To 10 workers, for 10 workers, maybe his relatives and friends, he paid more, 6.2 he paid, right? Then for 30 workers, he paid 6 rupees, maybe strangers. Then for balance 60 workers, he paid 5.7 rupees, his enemies, right? He paid less. Clear with this, guys, right? Actually seeing there is no multiple skill set, but this HR manager, he has paid a different amount for a different set of people. Why? For some reason. Clear with this, guys. Now we need to calculate all the relevant labor variances. Now how do we go about with this question? Now this is fine. The rate variance can be calculated separately for 10, 30, 60 workers. That is not a problem. Look at this. 5% of the time paid have been lost due to abnormal reason. Now how do you go about with this? First of all, guys, there is a very important calculation that we need to do. Now first we need to calculate the total standard hours that you should have taken. Now clearly we know that 100 hours, totally 100 hours, 1 hour where 100 people are working is equal to 100 man hours, right? So 100 hours you are allowed to take to produce how many units? 25 units. So to produce 1040 units of output, how many hours you should have taken is what we need to calculate. That is called as standard hours, guys. Correct? Simple. So how do you do? If 100 hours is allowed for 25 units, how many hours are allowed for 1040 units? 100 divided by 25 into 1040. Clear with this, guys? So 100 divided by 25 into 1040. That is what I have mentioned here. So 100, okay, 100 divided by 25, if you do, clearly you will get 1 unit you are allowed to take 4 hours. So 4 into 1040. You can also do it like this, or 100 by 25 into 1040. You are allowed to take a total of how many hours? 4,160 hours. Are you guys clear with this? So you are allowed to take 4,160 hours. Clear with this, guys? This is a very, very important calculation that you need to have. Fine, guys? Now, very good. Now, what has happened? This is the standard hours which we have now computed. Now, look at this. In this particular question, there is one more unique adjustment. What is it? 5% of the time paid has been lost due to abnormal reason. What is the meaning of that? Now, first, let me clearly put it in a tabular format. Then you guys will be able to appreciate this in a much more easier manner. Now, what is the standard hours you are allowed to take? 4,160. Perfect. Now, what has happened? What has happened? Let us look at the actuals. Now, actually, if you notice, please have the question with you. If you notice, right, what has happened is that, so number of workers, if you see, this HR fellow, he has actually categorized them into so many different workers, that is 10 workers, 30 worker, 60 workers and all. He has categorized overall 100 workers totally. Now, what has happened? Actual hours actual hours for which I am going to pay them, I call it as actual hours paid. Clear with this, guys? Now, actual hours paid. Now, for how many actual hours am I going to pay them? Simple. They have come to my factory and they have spent 42 hours in my factory. Clear with this, guys? So literally for all the workers, 100 workers, sir, they worked here. Correct? So 100 workers, each of them have spent 42 hours in my factory. So literally 100 into 42, total hours for which I need to pay them is 4,200 hours, right? Fine. Category of worker, you can say. So you have 42 into 10 is equal to 420 for this 30 workers. So 42 into 30, it's going to be 1260. And 42 into 60 is going to be 2,520. Clear with this, guys? Right. Next one. Now, what they have mentioned here, there is an idle time of how much? Sir, 5% of the total hours for which I am paying them is idle time. Or guys, simply put in other words, simply, guys, so now 10 workers are working for a total of how many hours? I mean, they didn't work. I am paying them for how many hours? 420 hours. So 0.05 into 420. How much does it come out to? 21 hours. So 21 hours are idle time. That is meaning these 10 workers, sir, I pay them for 420 hours. But out of this 420 hours, 21 hours they didn't work. Why? It was not because of their problem. Maybe power cut has happened. Because of that, they were sitting in dark. Machines will not work. Right? Literally, 420 minus 21. This is going to be the actual hours worked. How much is that? 420 minus 21. How much is that going to be? 399. They have actually worked for 399 hours. But abnormal idle time was for 21 hours, for which I can't penalize them. It was an issue with the company. So overall, I have to pay them for 420. The breakup of 420 hours, actual hours I'm paying is 21 hours idle time and 399 hours is the actual hours worked. Clear with this, guys? Similarly here, 1260. So 0.05 into 1260 is equal to how much? It's going to be 63 hours of idle time. Right? And here 2520 is equal to how much? 126 hours of idle time. So out of the total 4,200 hours, 5%, 210 hours are idle time. You can add it up, you get only 210. Clear with this, guys? Which means the remaining 95% is only the actual hours worked. So 1260 minus 63. So 1260 minus 63, you get actual hours worked 1197. 2520 minus 126, you get 2394. You add up everything. So plus 399 plus 1197 plus 23794, you get 3990. This is the actual hours for which they are working. Now, guys, now you tell me one thing. Now, labor cost variance. What is the formula? Standard hours minus actual hours. Right? Sorry. Standard hours into standard rate minus actual hours into actual rate, right? Fine, guys. Sorry for this. I mean, someone knocked the door, so there was an attention lapse. Coming back here, the labor cost variance is going to be standard hours into standard rate minus actual hours into actual rate. Correct? Now here, actual hours is going to be actual hours for which I am paying overall. Let's not take the breakup. Overall, 4,200 hours I am going to pay them. Guys, clear with this? So here I only take the actual hours for which I am paying them. Now, this is broadly bifurcated into two. Labor rate variance and labor efficiency variance. Here in labor rate variance, right, who is the responsible person? The HR manager. So standard rate minus actual rate into actual hours. What will I take? Actual hours paid, that is, I'm just talking about the total, forget this breakup, right? Actual hours paid or actual hours worked. The HR manager needs to pay them for 4,200 hours, not for 3,990 hours. They have worked for 3,990, but anyways, he needs to pay them for 4,200 hours. So here, it's going to be actual hours paid only. Are you all clear with this? Now, go on to the other side. Efficiency variance. So who is responsible? Production manager. What is the formula? Sir, standard hours minus actual hours into standard rate. Now, if you look at it, standard hours, we calculated already. Sir, for this task, you are allowed to take a total of how many hours? 4,160 hours. So I'm putting it here somewhere. Standard hours is equal to 4,160 hours. Now we are judging the efficiency of the workers. Now you should have taken how much? 4,160. Now minus actual hours. Now here will I take actual hours paid or actual hours worked, or in other words, will I take 4,200 hours or will I take 3,990 hours? Now you guys tell me, we're allowed to take 4,160 hours. However, effectively these guys completed the job in 3,990 hours itself, right? Sir, then this extra 210 hours is not a time that these guys took, right? So please don't consider this 210 hours. If you add 3,990 plus 210, you get 4,200. Correct? Now, please don't say that we have taken 4,200 hours. The employees are saying, sir, we took only 3,990 hours and we completed the job. Extra 210 hours, we were made to sit idle because there was a power cut. Please don't put it in my efficiency. So literally, for judging the efficiency, what will I say? Standard hours minus actual hours worked will only come. Clear with this, guys? So standard hours 4,160 minus actual hours worked will only come. Right? Clear with this? Into standard rate. Are you clear with this, guys? Are you clear with this? Now you tell me, sir, on the top, literally, sir, we have considered only actual hours paid. Correct? Here also rate variance, actual hours paid only. He's not bothered about how much is worked, idle time and all. For every hour they spend in the factory, this HR will have to pay. But for efficiency alone, I took actual hours worked now, sir. Now, how will it tally? It will not tally. That's why you have another variance called as labor idle time variance. What is it? Simple. Now, the difference between your actual hours worked and actual hours paid is only your idle time, right? So, literally what we will do here is idle time into standard rate. We will take it here. Clear with this, guys? Idle time is how much? 210 rupees into standard rate you will take. This will always be an adverse variance. Are you guys clear with this? So literally, if you are having idle time, there is a third variance called as idle time variance. And in this case, clearly understand, guys, whenever you are having idle time, you have standard hours, standard rate, actual hours paid, actual hours worked. Difference between the two is idle time. So this is split into three, right? Not one actual hours. You have actual hours paid, actual hours worked. The difference between the two is called as idle time, and then you have actual rate. Are you guys clear with this? So when you have an idle time, in that case there is one more variance called as idle time variance. It's nothing but idle time into standard rate, or this idle time, guys, is nothing but actual hours worked minus actual hours paid. Are you guys clear with this? So literally, if you see here, if you add this up, actual hours worked and actual hours worked gets knocked off, right? And here standard hours minus actual hours paid only will come in. Are you guys clear with this? Or in other words, this is the logic for idle time variance. Now sir, who is responsible for idle time variance? Idle time variance is the responsibility of the maintenance department. Are you guys clear with this? Why? Simple. Now they should have made sure, these maintenance guys should have made sure that this 210 hours should not have been lost. Sir, if there is a power cut, you should have arranged for a generator, genset, right? Now there should not have been a downtime or an idle time. But these guys were not efficient. Hence, I should pin it on the maintenance team. I should not pin it on my production team. Are you guys clear with this? Hence, I take this idle time separately, create a variance called as idle time variance, and then on that we compute. And that's how we pin on the responsibility to the maintenance department. Are you guys clear with this? Now, on this note, let's do all the calculations. Now look at this. This is what we have done. Standard hours is going to be 4,160 hours. Right? What is the standard rate in the question? The standard rate is given 6 rupees. So 6 rupees. If you multiply the two, this is going to be standard hours into standard rate. So 24,960. This is going to be the total labor cost you are allowed to incur. Guys, clear with this. But how about the actuals? We calculated the actual hours paid, idle time, actual hours worked. We calculated. Guys, clear with this. Now, what was the rate? Actual rate was given 6.26, 5.7. So you have 6.26, 5.7. So now, to compute the overall variance, so now we need to have here, we can have this column, actual hours paid into actual rate. Literally speaking, 420 into 6.2, 420 into 6.2, you have how much? 2604. 1260 into 6, how much you get? 7,560. Next, 2,520 into 5.7, 2520 into 5.7, you get how much? 13,364. You add up, this is the total labor cost actually incurred. Are you guys clear with this? So now what is the labor cost variance? You were supposed to incur 24,960, you have actually incurred only 24,528. So the difference between the two, 24,960 minus 24,528 gives you 432. Favorable is going to be your labor cost variance. Are you guys clear with this? Very, very simple, guys, provided you have the conceptual understanding. Please do not fall into the trap of mugging up things here. It's all 100% logical. Next, what's going to be your labor rate variance? The formula is going to be standard rate minus actual rate into actual hours paid. Guys, correct? Who's responsible? We all know, the HR manager. Now, here 3 categories, we need to do it separately. Now, what is the standard rate? Always it is 6 rupees. So 6, 6 and 6. Whereas, what is the actual rate? Sir, for 420 hours, I used a rate of 6.2. Right? For the next 30 workers, actual hours paid was how much? 1260. I paid them at 6 rupees. And for the next 60 workers, I paid them at 5.7. So there are 3 different actual rates here. So 6.2, 6, 5.7. Correct? 6.2, 6, 5.7. Right? So standard rate minus actual rate into actual hours paid. You can take these figures. 420, 1260 and 2520. Are you guys clear with this? You do all the calculations. So 6 you should have paid, but you've paid a 6.2, 0.2 more on 420. So 420 into 0.2 gives you how much? 84 adverse. 6 minus 6 into 1260 is 0. Then 6 minus 5.7, so you get 0.3. You have saved 0.3 rupees for the company on how many hours? 2520 hours. You get how much? 756 favorable. So net of 756 favorable minus 84. 756 minus 84, you get how much? 672 favorable. This is going to be what? This is going to be your overall labor rate variance. How about your efficiency variance? What is the formula? Standard hours minus actual hours worked into standard rate. Correct? Simple. In this case, what is the standard hours? 4160. What is the actual hours worked? Right? You can take the total. Why? Because into standard rate only we are doing. Directly you can take the total. Clear with this, guys? You are allowed to take 4160 hours, but you have actually taken only 3990 hours. So literally how many hours you have saved? 4160 minus 3990. You've saved 170 hours for the company into 6. Literally 1020 rupees favorable. Look at this. 1020 favorable. Are you guys clear with this? Right? So that's about this. So 1020 favorable. Then the difference is an idle time. So how much is my idle time? So 210 hours, sir. So 210 into 6. So 210 into 6. 1260 adverse is going to be my labor idle time variance. Look at this. 1260 adverse idle time into standard rate 1260. It is always an adverse variance. Clear with this, guys? So now if you knock off these three, you will get your topmost figure, your labor cost variance. Let's check for this. So 672 favorable plus 1020 favorable. So 1629, 1692 you get minus 1260, you get 432 favorable. Clear with this, guys? That's about this question. Nothing beyond it. The only thing that you need to know is in this particular question, since idle time was there, in this case what you need to do is segregate your idle time separately and calculate an idle time variance. In that case, your labor efficiency variance will be standard hours minus actual hours worked. Correct? So because when I'm judging the efficiency, you should have taken so much hours and I should compare with how much actual hours you actually worked for. Clear with this, guys? So standard hours minus actual hours worked into standard rate. That's how it should be. And the difference between actual hours worked and actual hours paid, which is your idle time, that should be separately taken idle time into standard rate. It's always an adverse variance which is captured, which is the responsibility of the maintenance department. That's the learning objective here. And with that, this particular variance, your labor cost variances with your idle time variance is also done. So please go and update your library of adjustments. Write down labor cost variance hyphen single skill set, labor cost variance hyphen single skill set within bracket with idle time. Labor cost variance hyphen single skill set within bracket with idle time. Right, guys? Fine. So in the marathon itself, we are doing a few numerical problems and all these are signature problems, right? You can expect these kind of questions as it is in the exam also, or maybe variants of this also you can expect. But the main objective here is from an examination perspective, as well as I'm picking up, hand picking questions to cover all variety of concepts covered across this particular chapter. Clear with this, guys? Now on that note, let's do one more question here. One last question in this labor related variances. Please take question number 7 for the same CA intermediate solved question bank. Please go and take question number 7. Question number 7. Okay, so please take question number 7. Okay, look at this. NPX Limited uses standard costing system for manufacturing its product X. The company is following a budgeted data given in relation to labor hours for the manufacture of 1 unit of product X. To produce 1 unit of product X, you are allowed to take 2 hours of skilled labor, 3 hours of semi-skilled labor, 5 hours of unskilled labor. Total is 10 hours. And every hour of skilled labor should be paid at the rate of 6. Unskilled labor should be paid at the rate of 4, and every hour of semi-skilled should be paid at the rate of 4, and unskilled should be paid at the rate of 3. Now what happens? You have different skill set of workforce to produce every unit of a product. Now in this case, your mix and yield variance, right, will also come into picture. Your labor mix variance is also called as labor gang variance. That will also come into the picture. That's about it. For that purpose only, I've taken one more sum. In the month of Jan 2021, a total of 10,000 units were actually produced, right? And the following are the results. What have they given? Actual hours they have given here is going to be how much? 18,000 skilled, 33,000 semi-skilled, unskilled was 58,000. Total hours is given. Actual rate is also given. They have multiplied and arrived at the amount. Now, idle time, abnormal idle time during the month is also being given here. Calculate all the labor variances, right? Then they've also asked, show the effect of labor rate variance if 5,000 hours of skilled labor are paid at the rate of 5.5 and the balance are paid at the rate of 7. Now, let's focus on this, the first part of the question, the main thing here for this marathon. That's the most important thing. Now, guys, what have they given? Now, this is going to be, guys, this is going to be my actual rate, correct? Now, this is going to be my actual hours paid. Sir, how do you know? So this is actual hours paid. This could also be actual hours worked, idle time is there. Now, that is the reason why they have clearly given actual hours paid, right? You can check it. 18,000, right, into 7 will only give 1,26,000, correct? 18,000 into 7 is 1,26,000, right? Now, when they have given the amount, right? It means they are paying at the rate of 7 for how many hours? 18,000 hours, which means this 18,000 is not actual hours worked, it is actual hours paid. Clear with this, guys? Since they have given the amount, you can clearly take this as actual hours paid. Now, there were also some idle hours and all. So now what will you do? Sir, actual hours paid respective 3 types of labor. From that minus your abnormal idle time, you will arrive at actual hours worked. Clear with this, guys, right? So now this is also available for your information. And then you can go ahead and do this question, right, guys? So now what I will do is right now, first look at this. What is going to be the standard hours? How many units were actually produced? 10,000 units, which means 10,000 units you have actually produced. So you are allowed to take a total of how much? 10,000 into 2, 20,000 skilled hours, then 30,000 semi-skilled hours, then 50,000 unskilled hours. This is the time allowed, correct? Standard hours. So 20,000, 30,000, 50,000, right? Clear with this, guys? The total time that is allowed was how much? 1 lakh labor hours at the rate of how much? 6, 4 and 3. So this is going to be your standard rate. Are you guys clear with this? So standard hours we have, standard rate we have. If you multiply the two, standard hours into standard rate, right? So now you get the total labor cost which you are allowed to incur, right? So 20,000 into 6 is 1,20,000, 30,000 into 4 once again is 1,20,000, 50,000 into 3 is 1,50,000. So 1,20,000 plus 1,20,000 plus 1,50,000, how much is it? 1,20,000 plus 1,20,000 is 2,40,000, and 1 lakh, add 1,50,000 to that, you get 3,90,000. So 3,90,000 rupees is the labor cost which you are allowed to incur to produce 10,000 units of output. Clear with this, guys? Now what happened to the actuals? The actual hours paid is given 18,000, 33,000, 58,000. These figures are all given, right? The actual rate, this is also given 7, 3.5 and 4. In fact, these figures are also given. They have multiplied and given total actual labor cost incurred is how much? 4,73,000. So this is actual hours paid, this is actual rate, and this is actual hours paid into actual rate. Clear with this, guys? Now one more thing, please have it very clear in your mind. Idle time is also given in the question. 500, 700, 800 hours respectively. 500, 700, 800 hours respectively, which means actual hours worked is going to be how much? Simple. Actual hours paid, I paid them for 18,000, out of which 500 was idle, which means 18,000 minus 500, 17,500 only effectively they worked. Clear with this, guys? 33,000 minus 700, 32,300. Similarly, 58,000 minus 800, 57,200. This is the actual hours worked. You get the total figures. So now we have standard hours, we have standard rate, we have actual hours paid, idle time, actual hours worked, then we have actual rate. Now literally all the ingredients are available. With this, you can go ahead and do this question. Clear with this, guys? So first, labor cost variance. What is the formula? Standard hours into standard rate minus actual hours into actual rate. Simple. This is the labor cost you were supposed to incur, right? 3,90,000, but you've actually incurred how much? 4,73,500. So literally if you subtract it, how much is the difference? 83,500 rupees you have incurred more. So literally 83,500 rupees adverse is going to be your total labor cost variance. As simple as that. Just list out the ingredients required, go ahead and crack the question. That's all is needed, guys. Clear with this? Next one, labor rate variance. Come on, tell me, what is the formula? Standard rate minus actual rate into actual hours paid. Correct? So now what you need to do here? Simple. So standard rate 6 minus actual rate 7 into actual hours paid 18,000. That is what we do here. 6 minus 7 into 18,000. Here what do you have? 4 minus 3.5 into 33,000. 4 minus 3.5 into 33,000. Similarly, unskilled, you were supposed to pay them 3, but you have paid them 4. Actually, for how many hours? 58,000. So 3 minus 4 into 58,000. For skilled, you should have paid 6, you have paid 7. 1 rupee more on how many hours? 18,000. So it is 18,000 adverse. That's all. Semi-skilled, you should have paid them 4, you paid them only 3.5. 0.5 rupees you saved on how many hours? 33,000. 33,000 into 0.5 gives you 16,500. Favorable because you paid less. You should have paid 3 for unskilled, but you've paid 4, which means 1 rupee more you have paid on how many hours? 58,000. So totally 58,000 you have paid more. It's an adverse variance. So add up everything. So here you get, these two are adverse. So 18,000 plus 58,000. Total adverse is 76 minus 16,500 favorable. Net off you get 59,500 rupees. This is going to be what? This is going to be your labor rate variance. Clear with this, guys? Next one. Next one, labor efficiency variance. How much is that going to be? How will you calculate standard hours minus actual hours worked into standard rate? So literally, I will compare this column, standard hours. I will compare this with actual hours worked. You were allowed to take this time, but you actually took only so much. I'm judging the efficiency into standard rate. That's about it. Clear with this, guys? So respective figure, this column, standard hours minus actual hours worked, 17,500, 32,300 and 57,200. We only take this actual hours worked, clear with this, into standard rate 6, 4 and 3. You can just take it up and you will arrive at this figure, right? I'm not getting into the calculation once again. So this is the amount you get. Clear with this, guys? Are you all able to understand? And finally, you have your labor idle time variance. What is that? Idle time into standard rate. Simple. So take this column, 500, 700, 800, multiply that with the standard rate. Look at this, 500, 700, 800, multiply with the standard rate, you will arrive at the figures. This is always an adverse variance, 8,200. Clear with this, guys? Right? So now what do you do here? Basically, you should understand efficiency variance is what? Here you have, this is actual hours worked. Please have this in your mind. So now, guys, so now ideally, always you should do the checking. So rate variance plus efficiency variance plus idle time variance should give you your labor cost variance. So 59,500 adverse plus 15,800 adverse plus 8,200 adverse, you get 83,500, right? So 83,500 adverse, it matches. Now, guys, I'm just summing it up here, and from here we will do that the gang yield variance and your mix and yield variance, we will be doing it, right? One second, I will just summarize this here. So labor cost variance, how much was the labor cost variance? It was 83,500, right? 83,500 favorable, sorry, adverse, right? Now this is bifurcated into two. What and what? Labor rate variance and labor efficiency variance. How much is my labor rate variance? We calculated it was 59,500 adverse. And how much was my efficiency variance? My efficiency variance was 15,800 adverse, right? And in between you have your labor idle time variance. So it is going to be how much? 8,200 adverse. 8,200 adverse. Now, guys, your efficiency variance is further classified into two. What and what? Labor mix variance, also known as labor gang variance. Mix or gang. Why gang? Gang means a group of people. So here you have multiple skill set of people. Labor mix variance or gang variance and labor yield variance. It's also known as sub efficiency variance. Formulas, same formulas, guys. So here labor mix variance. What is going to be the formula? Come on, revised actual hours minus actual hours into standard rate. Clear with this, guys? And here it's going to be what? The other way around, right? Actual hours, sorry, it's going to be standard hours minus revised actual hours into standard rate. That's about it. But please understand one thing here, actual hours stands only for actual hours worked. Why? Look, under efficiency variance only these two variances come. So in efficiency variance, right, what do we calculate? It is going to be standard hours minus actual hours worked only, right? Obviously, so these two are these two are actually offroots of efficiency only. So wherever you find actual hours, it is always actual hours worked only. Are you guys clear with this? So there's absolutely no second thoughts about that. Now with this, let's go and quickly wrap this off also. Now, guys, now I'm just going here and now taking this table. I'm just taking this table, okay? So now, what is going to be my actual hours worked? So this is the table that we are bothered about. So actual hours worked. So let me just take this table. 1 second. Right. So now, here, I'm just using this table once again. So first, let me come up with a template. Skill set, right? Or in other words, you can say the type of workforce, type of labor, then revised actual hours, actual hours worked, standard rate, and labor mix variance. Now, what is the type of workforce? Skilled, semi-skilled, unskilled. This is what you have here, right? Now, first, which column will you fill? Actual hours worked. How much is actual hours worked? 17,500, 32,300, then 57,200. What is the total? 1,07,000. Now, what will you do here? This figure, you will plug it here. 1,07,000. Now, here I am taking the actual hours, but I am revising it for the standard mix. Sir, what is a standard mix, sir? Go to the question. Now, clearly they have given, look, out of 10 hours, right? This is standard data. 2 hours should come from skilled labor, 3 hours should come from semi-skilled labor, and 5 hours should come from unskilled labor. Or in other words, 2 by 10 of the total hours should be your skilled labor, 20%. 30% of the total time should come from semi-skilled, 50% should come from your unskilled, correct? Now what you will do, simple. So 2 by 10 into 1,70,000, 1,07,000 will be the revised actual hours for skilled. Similarly, 3 by 10 of your 3 by 10 into 1,07,000 will be semi-skilled, and your 5 by 10 into 1,07,000 is going to be your unskilled. So how much? 1,07,000 into 2 by 10, that's going to be 21,400. Then 3 by 10, it's going to be 32,100. And 5 by 10, it's going to be 53,500. Clear with this, guys? Right? Now, what's going to be the standard rate here? The standard rate, it's available in the question 6, 4, and 3. Right? This is going to be our standard rate. Perfect. So now, go and calculate your labor mix variance. So now, labor mix variance, how much is it going to be? So, you were allowed to take 21,400. You've taken 17,500. So 21,400 minus 17,500. You've saved 3,900 hours into 6. How much is it going to be? So 23,400 rupees favorable. Similarly, you could have taken 32,100. You've taken 32,300. So 200 hours you've taken more into 4 gives you how much? 800 adverse. Next, you could have taken 53,500. You've taken 57,200. So 53,500 minus 57,200 is 3,700 hours. You've taken more into 3. It's going to be 11,100 adverse. So now if you net this off, how much will you get? So 23,400 minus 800 minus 11,100. You get 11,500 rupees of hot favorable variance. What happened here? Literally guys, skilled labor is the most costliest labor. Semi-skilled, little lesser costly, and unskilled, it is the least costliest. Now what I have done, skilled labor, I should have taken 21,400 hours, but I've taken only 17,400 hours, which means I have used less time of a costly workforce. That's why I got a favorable variance here. And I have more time of a cheaper workforce. That is the reason why I have a favorable variance. Why favorable variance? I took more time of a cheaper workforce, less time of a costlier workforce. I actually changed the mix. Because of that, I ended up getting 11,500 rupees favorable variance. You tell me, is this because of efficiency? No, it is because of changing the mix of the gang. Are you guys clear with this? Now let's go on to the next one, which is labor yield variance. Now labor yield variance is going to be standard hours minus revised actual hours into standard rate. Now quickly, let's complete this also, and then the sum will be over. So here we have skilled, semi-skilled, and unskilled. So standard hours minus revised actual hours into standard rate. Right? Now let's do this quickly. So what's my standard hours? So it's already there. We've done this. Standard hours is going to be 20,000, 30,000, and 50,000. It's going to be 20,000, 30,000, and 50,000. Minus, what's my revised actual hours? the revised actual hours, just now we computed. It's 21,400, 32,100 and 53,500, right? So now let's do this. So 21,400, then you have 32,100 and 53,500. All the figures are available. Nothing needs to be computed now into standard rate 6, 4 and 3. Come on, guys. So 20,000 you were allowed to take, but you've actually taken 21,400. So 1,400 into 6, it's going to be how much? It's going to be 8,400 adverse. This is the extra cost you have actually incurred, right? Next one. So you would have taken 30,000, but you've taken 32,100, 2,100 hours extra into 4. It's going to be 8,400 once again adverse. Then here 50,000 you have taken, 53,500 you have actually taken. So 3,500 into 3, it's going to be 10,500 once again adverse. Right? So now if you add this up, you get how much? So 10,500 plus 8,400 plus 8,400, you get 27,300. What is it going to be? Adverse variance. Now guys, that's all it is. So your labor mix variance or the gang variance was 11,500 favorable, and here you have an yield variance of 27,300 adverse. So 27,300 minus 11,500, 15,500 rupees adverse is going to be your labor efficiency variance, and hence our computation is correct. Clear with this, guys? This is all it is. Now literally, why did you have a mix variance, right? The mix or the gang variance you had, because simple, it was a favorable variance. Why? Skilled was the most costliest source of your labor, right? What happened? We consumed, or we actually incurred less time from a costlier labor source, and we took more time in a cheaper source of labor. Because of this mix difference, actually we had a variance to the extent of 11,500 rupees we could save. And actually if you see, because of efficiency, these guys were inefficient, so labor yield variance is clearly proved that they've got 27,300 rupees adverse is the variance attributable to your labor yield variance. Clear with this, guys? So with this, we have completed this full question. This is the maximum complication you can have this in labor variance. You have labor variance with the multiple skill set, that too with idle time and all. That's about it. So please go and update your library of adjustments. Write down labor cost variance hyphen mix of skill set within bracket with idle time. Labor cost variance hyphen mix of skill set within bracket with idle time. This is the most comprehensive question in your labor variances, right, guys? So with this, your labor related variance is also over. Now ideally, your CMA Intermediate Paper 8 students, if you are a student attempting CMA Intermediate Paper 8, literally in this chapter you have only material and labor cost variances. The remaining are not applicable for you. Clear with this, guys? So CMA Intermediate Paper 8 students, only material and labor cost variances are applicable, and literally we have covered in depth all the concepts, everything we have revised with the numerical problems itself. So with that, we have completed our labor related variances. Let's move on to the next segment of discussion. Variable overhead cost variances. So that's the next segment, which is part 3 of this particular chapter. Variable overhead cost variances. Very, very simple. All the formulas that we're going to see here are exactly the same as your labor related variances. So variable overhead cost variance, what is the formula? Standard hours into standard rate, that is the standard variable overhead, minus actual variable overhead, which is actual hours into actual rate. Right? Now this is bifurcated into two. Variable overhead expenditure variance. There in labor we saw this was a rate variance. Here we don't call it as a rate, here it is expenditure variance, and on the other side we have variable overhead efficiency variance. Now guys, variable overhead, an example of variable overhead is your power cost, right? Your power bill, electricity bill. Now let us say, right, so a company has to incur, let us say your power cost is incurred as and when you run the machine, correct? Now standard hours, right, for my actual production, I should have taken so many number of hours, and every hour, let us say I was supposed to pay a power cost of 10 rupees, right? So this is standard hours into standard rate. But actually what happened, actual hours, my machines ran for so many number of hours, right, into actual rate at which I am paying the electricity department. Clear with this, guys? Now this is bifurcated into two: expenditure variance and efficiency variance. Expenditure variance, now this is the responsibility of the maintenance department. With respect to the maintenance department, now the company will actually tell them, look, for every hour you have to negotiate, talk with the electricity board or the electricity department, right, and make sure that for every hour that we are running the machines, right, the rate that you are supposed to pay is only 10 rupees, right? But actually, let us say these guys, our maintenance team, they were not that good in negotiation. They ended up striking a deal for 12 rupees per hour. Now before that, first, sir, here electricity, power bill and all, we only generally pay what the government asks us to. No, sir. Then how can these guys negotiate? No, for us what we have is a domestic connection, electricity connection. In factories they have industrial connection, where there are certain things where they can go and liaison and maybe they can negotiate a deal with the department. That's how it works there. Now what is the responsible for the maintenance guy? The rate. So obviously within the bracket, standard rate minus actual rate into actual hours. Why? Because the hours are not in his control. For how many hours the machines are being run. Clear with this, guys, right? So for those many hours, the maintenance team is responsible for the rate. So here the formula is standard rate minus actual rate into actual hours, where on the other side it is variable overhead efficiency variance. Whose responsibility? Production department responsibility. So here what do you have? Standard hours minus actual hours into standard rate. Why do I take standard rate here and not actual? If I take the actual, then I'm passing on the efficiency or inefficiency of the maintenance department to the production department, which should not be done. Hence we use standard rate. Are you guys clear with this? That's about this area. That's about this area. Exactly the same formulas as compared to labor. And in fact here the efficiency variance is not further subclassified into mix and yield and all. Absolutely not there, because you can't have different types of power and all these things. Absolutely not. So it stops here, as simple as that. Now here if you notice one very important thing, always remember actual hours in this entire calculation of variable overhead variances. Actual hours is always actual hours worked. You don't have actual hours paid, actual hours worked separately. Actual hours means actual hours worked for the purpose of variable overhead variances. Why, sir? Simple. Only for those many number of hours for which my workers are working, right, my machines will be parallelly running, right? Suppose idle times, power cut, how will my machines run? So actual hours means actual hours worked only. Only for the actual hours worked, my machines will be running, and only for the machine hours that is being run, I will incur the power cost. Are you guys clear with this? And that's about the story of variable overhead variance. Quickly, let's go and do one numerical problem in this regard. Now, please take once again your solved question bank of your CA intermediate, right? Please take question number 9. Fairly decent question. This one is a fairly decent question. So let's quickly go and do this. From the following information of G Limited, calculate the variable overhead cost variance, the variable overhead expenditure variance, and the variable overhead efficiency variance. Okay, fine. All the variable overhead variances they are asking. Budgeted production is 6,000 units. The budgeted variable overhead is 1,20,000. The standard time required for 1 unit of output is going to be 2 hours. And the actual production is going to be 5,900 units. Actual overheads incurred is 1,22,000. Actual hours worked is going to be 11,600, right? These are the data given. With the help of this, we need to do what? We need to arrive at all the variable overhead variances. Fairly a direct and a simple question. Let's quickly get started with this. So this is going to be question number 9 in your variable overhead variances. So question number 9. Okay, so now first we only need 4 ingredients. What are they? Standard hours, standard rate, actual hours, and actual rate. And always remember, for the purpose of variable overheads, actual hour represents actual hours worked. Now standard hours, please have the question with you. So what is my standard hours? Actual production. So I have produced how many units? I've actually produced 5,900 units, and for each of these 5,900 units, I should have taken how many hours? 2 hours. So 5,900 into 2 is going to be my standard hours. So 5,900 units into each unit I was supposed to take 2 hours. So 5,900 into 2 gives me 11,800 hours. It's going to be my standard hours. I should have taken a total of 11,800 hours. Now, what is going to be my standard rate per hour? Now, look at this. Now, what's my budgeted variable overheads? 1,20,000. Right? Now, the standard rate per hour means what? Budgeted overheads, right? Variable overheads divided by budgeted hours. Correct? Right? Now, what was my budgeted variable overheads? 1,20,000. What was my budgeted hours? They have given budgeted production is going to be how much? 6,000 units. Every unit, the standard time allowed is 2 hours, which means the budgeted hours would have been how much? 6,000 into 2, 12,000 hours. Guys, are you clear with this? So literally, the standard rate of variable overhead per hour is going to be 1,20,000 divided by 12,000. How did we get 12,000 hours? Budgeted hours, 6,000 units into 2 hours each. Are you guys clear with this? So here, it's going to be 1,20,000 divided by 6,000 units. Each unit can take 2 hours, which means the budgeted hours are going to be 12,000 hours. So 1,20,000 divided by 12,000 is going to be 10 rupees per hour. Are you guys clear with this? So it's going to be rupees 10 per hour. How did we get? If you want, you can put the calculation. Rupees 1,20,000 divided by 12,000 hours. Clear with this? It just requires some little bit presence of mind, and that's about it. Next one. Actual hours. Actual hours, they've actually worked for how many hours? 11,600 hours. And what is the actual rate? So the actual variable overhead incurred is given 1,22,000. So this divided by actual hours worked, you will get the actual rate, right? So 1,22,000 divided by 11,600. So it's going to be 1,22,000 divided by 11,600 hours. So it's going to be how much? 122,000 divided by 11,600. You get roughly 10.51724. It just keeps on running. You should retain the decimals in your calculator. As simple as that. So now what do? We can just go ahead and actually prepare this variable overhead cost variance. So first one, your variable overhead cost variance is going to be what? Standard hours into standard rate minus actual hours into actual rate. So standard hours 11,800 into standard rate 10. This is the cost you should have incurred. Whereas, what is the cost you've actually incurred? 11,600 hours into 10.5172 something. It keeps on running. Retain the decimals in your calculator. So the standard variable overhead cost is going to be 11,800 into 10. So it's 1,18,000. Whereas the actual overheads incurred was 11,600 into 10.5172 something. So it comes out to, we anyways have the actual overhead figure. It's 1,22,000. So which means you should have incurred a variable overhead of 1,18,000, but you've actually incurred 1,22,000. So the difference between that, how much is it? 4,000 rupees adverse is the variance here. Are you guys clear with this? So that's about the variable overhead cost variance. Now this should be classified into two. What and what? Variable overhead expenditure variance and variable overhead efficiency variance. Right? So now variable overhead expenditure variance, we know the formula. It's going to be standard rate minus actual rate into actual hours, and efficiency variance, standard hours minus actual hours into standard rate. Nothing needs to be mugged up. Even the formulas, logic, we are discussing in the marathon itself. So now come back. So what's going to be my standard rate, guys? So standard rate is given 10 rupees you were supposed to incur, but you have incurred actually how much? 10.5172. Please retain all the decimals in your calculator. Into actual hours were 11,600 hours. So now 10 minus 10.5172 something, right, into 11,600, you get how much? 5,999.999, or in other words, it's going to be 6,000 rupees, obviously adverse, because you've actually incurred more than what you're supposed to incur. It's an adverse variance. Clear with this, guys? And how about your efficiency? You were supposed to take 11,800 hours, but you've actually taken only 11,600 hours. So you've saved 200 hours of the company into standard rate of 10. So 200 into 10, that's going to be 2,000 favorable. Clear with this, guys? Yes. So now your expenditure variance is 6,000 adverse. Your efficiency variance is 2,000 favorable. So if you net off, you get 4,000 adverse. That's going to be your variable overhead cost variance. So now clearly we know that our maintenance team is not doing a good job, 6,000 adverse. Whereas our production team is doing a very good job. They are super efficient. That's why 2,000 favorable. Net off, you have 4,000 adverse. Are you guys clear with this? And that's about the concept of variable overhead cost variances. That's about it, right? That's why I said it's the power of conceptual learning. If you complete your labor, automatically variable overheads is also done and sorted. Please go and update your library of adjustments. Write down variable overhead cost variance hyphen direct computation. Variable overhead cost variance hyphen direct computation, right? And that's about the concept of variable overhead cost variances. Now let's move on to the next segment of discussion, which is part 4, fixed overhead variances. Now guys, one very important thing that you need to have in your mind, fixed overhead variance is a separate animal altogether, because it has nothing to do with the previous 3 variances. The previous 3 variances were similar in all aspects, whereas fixed overhead is separate altogether. Sir, why sir? Now let us say I budgeted to incur 1 lakh rupees of fixed overheads, and I budgeted to sell, or my budgeted output was 10,000 units. Whereas actually I ended up incurring 96,000 rupees of fixed overheads, and my actual output was 8,000 units. Now think and answer. You guys tell me, can I compare this 1 lakh rupees with 96,000 rupees as such? The answer is yes. Sir, just now you said it was not correct, right? So maybe some time back we understood the concept of standard cost and all, where you said, sir, this cost is pertaining for a different output level, whereas this cost is pertaining for 8,000 units level, so which means they are not comparable as such. Arrive at the standard cost, and that should only be compared with actuals. But here you are saying directly the budget can be compared with actuals. Wait, those concepts applied for all components of cost which are variable in nature, be it your material, labor, variable overhead. But fixed overheads, you logically think and answer. Fixed overheads means what? It is a cost which is incurred irrespective of your volume of output. Or in other words, guys, let us say factory rent. You were supposed to pay a factory rent of 1 lakh rupees, but you ended up paying 96,000. Here, this output is not relevant, because irrespective of my output, right, the fixed cost is not going to change. Or in other words, when it comes to fixed overheads alone, the budget can be directly compared with the actual, because your fixed cost has nothing to do with your output. Are you guys clear with this? Or in other words, there is no concept of standard when it comes to fixed overheads. So the concept of standards applies only with respect to all the variable components of cost, namely your material, labor and variable overhead. First of all, this is something that you need to remember. Now, given the fact, which means, sir, can I say 1 lakh rupees is the cost you should have incurred? Yes, correct. Budgeted overheads, fixed overheads itself is the cost you were supposed to incur, but you have ended up paying only 96,000, which means you have saved 4,000 rupees of fixed overheads for the company. Are you guys clear with this? Or in other words, the first thing that you need to understand when it comes to fixed overheads is that there is no concept of standard. Now, coming to your formulas and all these different types of fixed overhead variance. First of all, please consider this separately. Do not think that here we are comparing the standard fixed overheads with actual. No, there is no concept of standard, first of all. Now, fixed overhead cost variance. What is the formula? Absorbed fixed overheads minus actual fixed overheads. Now, clearly, if you notice, here they are comparing what with what? Absorbed with actual. Or in other words, simply put, fixed overhead cost variance is nothing but calculation of under absorption or over absorption. Are you guys clear with this? Because here in fixed overhead variance, we are not computing how much is the fixed overhead cost you should have incurred. We are not comparing that with the actual fixed cost incurred. We are comparing how much was absorbed. Over fixed overheads absorbed is nothing but the overhead accounted, right, minus your actual fixed overheads. Clear with this, guys, right? Now, for you to understand this, obviously you should have studied your overheads chapter. Only then the concept of absorption costing you will be able to understand it. Anyways guys, right? So here absorbed fixed overheads minus actual fixed overheads. Sir, absorbed fixed overheads, how can we calculate? Simple, standard hours into standard rate per hour. Clear with this guys? That is the predetermined rate. Clear with this guys, right? Or there's another formula also, right? Standard rate per unit into actual output. If you recall the discussion in your overheads, right? So what we use is predetermined rate per unit, right? That we multiply directly with actual units produced. If you do that, you arrive at what? The absorbed overheads. It's completely a subject matter of discussion in your overheads chapter. Or you can, if you want to go everything based on hours, standard hours into standard rate per hour. Clear with this guys, right? The next one, so absorbed overheads minus actual overheads is what your fixed overhead cost variance computes. So this is not like your other variable components of overheads. Now this is classified into two. One is called as expenditure variance, the other one is called as volume variance. Clear with this guys? Very simple. Overheads expenditure variance, what does it calculate? Budgeted fixed overheads minus actual fixed overheads. Clear with this guys? So here what we compute, what is the fixed overhead cost you should have incurred, that is being compared with what is the fixed overheads you have actually incurred. Are you guys clear with this? Or in other words, very simple, very simple. Now if you look at it here, now we have budgeted fixed overheads, we have actual fixed overheads, in between we have absorbed fixed overheads. My main fixed overhead cost variance calculates what with what? It computes the variance between absorbed with actuals. Clear with this guys? Now this is bifurcated into two, I told you, expenditure variance and volume variance. Expenditure variance, what does it calculate? The difference between budget and actuals. Clear with this guys? It compares what? Budget with actuals. But my topmost figure, it only computes the difference between absorbed with actuals. But on one side of the chart, expenditure variance computes the difference between budget with actuals, which means your volume variance should be the balancing figure. So absorbed minus budgeted. So it removes this variance. Are you guys clear with this? Look here. Once again, I am repeating. So here, your fixed overhead cost variance, the topmost figure, it computes the difference between what and what. So you have budgeted, we have absorbed, we have actuals, right? Here fixed overhead cost variance compares the difference between absorbed and actuals, right? On one side of the chart you have expenditure variance, which compares budget with actuals, budgeted overheads minus actual fixed overheads. And on the other side, balancing figure is your volume variance. It compares the difference between absorbed fixed overheads minus budgeted fixed overheads. So literally this is removed. So from this, basically guys, so budget minus actual is your expenditure variance. Volume variance is absorbed fixed overheads minus budgeted fixed overheads. So literally if you add the two, you should get the top figure. Literally if you see here, so this budget minus budget fixed overheads gets cancelled here. Literally it becomes what? Absorbed fixed overheads minus actual fixed overheads. That's what you wanted on the top. Are you guys clear with this? So literally fixed overheads expenditure variance calculates what? Your budgeted fixed overheads minus actual fixed overheads, and your volume variance calculates what? The balancing figure, absorbed fixed overheads minus your budgeted fixed overheads. Are you guys clear with this? So you can remember this as a balancing figure. So there is no direct logic. Yes, there is logic only. It is absolutely logical, but it's not direct logic. Here if you see here, literally guys, absorbed overheads is absorbed for the actual volume, guys, correct? Whereas budgeted fixed overheads is pertaining to your budgeted volume. Because of the volume difference, how much is the variance is what we are computing. All these things happen because of the concept of using predetermined rate of absorption, which is a purely subject matter of discussion in your overheads chapter. Clear with this guys? That's why this fixed overhead variance is completely a different manner of computing. It's not as direct as your other three variable components of your cost variances. Clear with this guys? So simply put, first one, fixed overhead cost variance, under or absorption, absorbed overheads minus actual overheads, bifurcated into two, expenditure variance and volume variance. Expenditure variance, budgeted fixed overheads minus actual fixed overheads. How much you should have incurred, compare that with how much you have actually incurred. And fixed overheads volume variance, the balancing figure, absorbed fixed overheads minus budgeted fixed overheads. Are you guys clear with this? That's about it. Now volume variance is further classified into two. fixed overhead capacity variance and fixed overheads efficiency variance. Clear with this, guys? Now, fixed overheads capacity variance, how do we calculate? Now, guys, one thing alone. Now, I want you to remember here, if you see absorbed fixed overheads, how will you compute absorbed fixed overheads? Yeah, it's going to be standard hours into standard rate per hour. That's how we compute this, right? It's going to be standard hours into standard rate, obviously per hour. Correct? This is your absorbed fixed overheads computation. Correct? Now, here if you see fixed overhead capacity variance, only one thing is new here: actual hours into standard rate per hour. This actual hours alone, I want you to remember. Sir, is it not logical? It is fully logical only. But if I start explaining the logic right now, it will take so many other, I will have to take the explanation of so many other areas which are not a subject matter of your CA or CMA intermediate level. That is the reason why I'm not getting too technical here. One thing alone, let us accept: actual hours into standard rate per hour minus whatever is your budgeted fixed overheads. That's all. Clear with this, guys? And efficiency variance is going to be the balancing figure. So absorbed fixed overheads minus AH into SR, right? Only if I do this, what happens? AH into SR gets cancelled, right? And I get absorbed fixed overheads minus budgeted fixed overheads. Are you guys clear with this? Once again, I'm repeating: fixed overheads capacity variance. What is the formula? One thing alone I asked you to remember. In the entire subject, this is the only place where I ask you to remember something. Actual hours into standard rate per hour minus whatever is your budget fixed overheads. And your efficiency variance is the balancing figure. Absorbed fixed overheads minus AH into SR. Only if I do this, this gets knocked off, right? And I get absorbed fixed overheads on the top minus budgeted fixed overheads on the top. Clear with this, guys? And that's about the concept of fixed overhead cost variance. Now, actually seeing there is one more variance called calendar variance. Now, what happens in case of calendar variance? Separately, I will teach you with the help of a numerical example. But as of now, this is the base for you to compute. First, guys, once again, I'm summarizing. Many students struggle in fixed overhead variances. That's why I'm just repeating this again and again. Fixed overhead cost variance. First of all, understand there is no concept of standard in fixed overheads. So fixed overhead cost variance is nothing but a computation of under or over absorption. So what do you have here? Absorbed overheads is compared with actual overheads, bifurcated into two: expenditure variance and volume variance. Expenditure variance compares what and what? Budgeted fixed overheads with actual fixed overheads, right? Budget with actuals, right? On the other side, volume variance, absorbed is compared with budgeted. Clear with this, guys? Only if I do that, budget gets cancelled, and on the top I get absorbed fixed overheads minus actual fixed overheads. Are you guys clear with this? Now, the sum total of these two should be equal to your top figure, your daddy, right? This is daddy and these are two kids. So sum total of these two kids should be equal to your daddy. Right, once again, so now fixed overhead volume variance is bifurcated into two: fixed overheads capacity and fixed overheads efficiency variance. Capacity variance, one thing alone I asked you to remember: actual hours into standard rate minus budgeted fixed overheads. And on the other hand, efficiency variance, balancing figure: absorbed fixed overheads minus AH into SR. Clear with this, guys? Right, and absorbed fixed overheads, how will you compute? Standard hours into standard rate per hour, or if you want to use units, predetermined rate per unit, that is standard rate per unit into actual output. These are two different ways of computing your absorbed fixed overheads. Ideally, this is covered in your overheads area. Clear with this, guys? Now, with this backdrop, let us go and do one numerical problem. With the help of that numerical problem, every single thing in this particular area will be covered. Clear with this, guys? Fine. Let's get started. Now, once again, please take question number 10 of your CA Intermediate solved question bank. Please take question number 10. Now, this question you please take. Now, to solve this question, first, guys, once again, any sum that you want to solve in your fixed overhead variance. Now, first you list out the ingredients. Sir, what all do I need? I need to compute absorbed fixed overheads. For you to compute absorbed fixed overheads, you need to know standard hours. You should know standard rate per hour. Then you should know actual fixed overheads. Then what else should you know? Budgeted fixed overheads you should know. Then all these data are done. And then one more thing, actual hours you should know. 5 ingredients if you know, this entire fixed overhead variance you will be able to crack. What are all the 5 ingredients? Standard hours, standard rate per hour, then actual fixed overheads, then budgeted fixed overheads, then you have actual hours. That's about it. 5 ingredients first you find out. Once you find these figures out, plug it in the respective column or plug it in the respective formula, you'll get the answer. As simple as that. Logically remember everything, guys. There is absolutely no pain in mugging up anything. So now let's get started here. So it's going to be question number 10. The cost details of J and G Limited for the month of September 20X1 are as follows. So the data is given, budgeted and actuals. Fixed overheads, budgeted figure, fixed overheads is 15 lakhs, actual fixed overheads is how much? 15 lakh 60,000. Next one. The units produced, budgeted units is going to be 7,500, actual units is going to be 7,800. Standard time for one unit you are allowed to take 2 hours. Alright, it's not applicable in actuals. But actual hours worked was how much? 16,000 hours is the actual hours required. Calculate all the variances. Now guys, quickly, we need only 5 ingredients. What are they? Standard hours, standard rate, obviously per hour. Then we need actual fixed overheads. Then we need budgeted fixed overheads. And finally, we also need actual hours. If we have these 5 ingredients, the entire fixed overhead cost variance can be computed. First guys, standard hours. What do you mean by standard hours? For the actual production, what is the number of hours you should have taken? 7,800 units actually produced, and every unit you should have taken 2 hours. So 7,800 into 2, how much you get? 15,600 hours. Are you guys clear with this? Right? So 15,600 is going to be my standard hours. Clear with this? Next, what is going to be my standard rate? Standard rate means what? Right? So per hour, what is the fixed overhead budgeted rate? Simple. Budgeted rate is going to be budgeted fixed overheads divided by budgeted hours. So now sir, how much is the budgeted hours? Budgeted units is going to be 7,500. Every unit you are allowed to take 2 hours, which means 7,500 into 2. This would have been my budgeted hours, which is 15,000. Clear with this guys? So which is what is going to be a standard rate per hour? 15 lakh divided by 15,000 hours. Clear with this? So here I'll put it. So it's going to be 15 lakh rupees divided by 15,000 hours. How did you get 15,000 hours? 7,500 into 2. It's going to be 15,000 hours. So 15 lakh divided by 15,000 hours, it gives you how much? It gives you rupees 100 per hour. Are you guys clear with this? Next one. What is the actual fixed overheads? Actual fixed overheads we have 15 lakh 60,000. Next, budgeted fixed overheads. How much is it? Rupees 15 lakhs. Budgeted fixed overheads is how much? Rupees 15 lakhs. And what is the actual hours? It's going to be 16,000 hours. So now literally we have all the ingredients with us. So it is just a subject matter of plug and play. That's about it. Look at this. This is exactly what I have mentioned also. Standard hours we have computed. Right? The solution entirely is given here. Standard rate. Standard rate is nothing but budgeted fixed overheads 15 lakh divided by budgeted hours. What is the budgeted hours? Budgeted units into standard rate per hour. So we got 100 rupees per hour. Then actual fixed overheads is how much? 15 lakh 60,000. It's given. Budgeted fixed overheads 15 lakh given. Actual hours 16,000 hours given. With this, the entire thing we can now go and do it. Shall we get started? Yes. So this is question number 10. So I'm doing it here for you. Question number 10. So, fixed overhead cost variance. What is going to be the formula? Formula is absorbed fixed overheads minus actual fixed overheads. Right? Now, what's my absorbed fixed overheads? Absorbed fixed overheads is going to be standard hours into standard rate per hour. Correct? Minus actual fixed overheads. Now guys, tell me what's going to be my standard hours. Just now we computed it was 15,600 hours into what's my standard rate per hour. We computed that as well. It's going to be 100 minus what's my actual fixed overheads is going to be 15 lakh 60,000 rupees. Clear with this guys, right? Just now we computed everything. Just now we computed everything. It was all mentioned here. We just now computed. So 15,600 into 100. This is my absorbed or fixed overheads minus actual fixed overheads comes out to 15 lakh 60,000. Right? So how much is this? 15,600 into 100. So absorbed fixed overheads is 15 lakh 60,000 minus actual is 15,60,000. So literally guys, my absorbed fixed overheads is equal to actual fixed overheads, or in other words, I don't have any under or over absorption. So literally my fixed overhead cost variance is 0. It is neither adverse nor favorable because the absorbed is equal to actuals. Now what do we do here? Now this gets split into two. What and what? Fixed overhead expenditure variance and fixed overhead volume variance. Now expenditure variance, what is the formula? Budgeted fixed overheads, what you should have incurred, minus actual fixed overheads. Come on guys, tell me, what's my budgeted fixed overheads? It was given in the question, right? 15 lakh rupees is what I budgeted. Whereas what's my actuals? My actual was 15,60,000. Or in other words, there is a 60,000 rupees of adverse variance. Alright, you were supposed to incur only 15 lakh, you've ended up incurring 15,60,000. Clear with this, guys? On the other hand, you have fixed overhead volume variance. What's the formula here? It's absorbed fixed overheads minus budgeted fixed overheads. So what's my absorbed fixed overheads? It was 15,60,000 minus what's my budgeted fixed overheads? That's going to be 15 lakh rupees. Sorry, it's going to be 15 lakh rupees. So how much is this? 60,000 favorable. So look at this, 60,000 adverse and 60,000 favorable. It gets knocked off and you end up having a 0 variance. Are you guys clear with this? Now, what happens here? This volume variance is further classified into two. What and what? Fixed overhead capacity variance and fixed overhead efficiency variance. Now fixed overhead capacity variance. So guys, come on, tell me what's going to be the formula here. So capacity variance is this one alone. I asked you to remember, actual hours into standard rate, right, minus whatever is here, budgeted fixed overheads. Right? Now here efficiency variance, balancing figure, absorbed fixed overheads minus AH into SR. Now come on guys, tell me what's my actual hours. We have computed in this question, the actual hours was 16,000. So 16,000 hours into what's going to be my standard rate is going to be 100, right, minus budgeted fixed overheads. We have budgeted fixed overheads of 15 lakh rupees. So AH into SR comes out to 16 lakh rupees minus 15 lakh comes out to 1 lakh rupees favorable. And on the other hand, we have fixed overheads efficiency variance. So it's absorbed minus AH into SR. So now tell me guys, what's going to be my absorbed? 15,60,000 minus AH into SR. Just now we computed AH into SR comes out to 16 lakh rupees. So minus 16 lakh rupees. So how much you get? Here you have 40,000 rupees adverse. Clear with this, guys? Yes. So now literally 1 lakh favorable, 40,000 adverse, net off you have 60,000 rupees favorable as volume variance. And as simple as that. Literally guys, to crack the sum relating to fixed overhead variances, you only needed 5 ingredients. Standard hours, right? You needed standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, and actual hours. This is all you needed to crack this entire sum, and that's about this area, right? Literally, I've seen many students struggle in this area. This is all it is, and beautifully we've covered one comprehensive question in this area. So please go and update your library of adjustments, right? So write down. So fixed overhead cost variance hyphen fixed overhead cost variance hyphen direct computation within bracket without calendar variance, which means we'll be doing one more sum which also covers calendar variance, and that's about this area. Fine guys, so direct computation within bracket without calendar variance, right? In our classroom discussion, right, in our batches like the paid courses where regular or exam oriented batches, we'll be doing many variety of problems, but here for revision purpose, for conceptual revision purpose, I'm also doing numerical problem, one representative problem that is quite comprehensive and covers all the major areas. So this is a beautiful way to revise the entire subject. Clear with us, guys? Now let's move on to the next concept where we have what happens in case of calendar variance? Sir, what do you mean by calendar variance? Wait, for that purpose, what we will do is, let's go to the next question. CA Intermediate book only, your solved question bank. Please take question number 11. We will read this question, and with the help of this question, I will tell you what is the issue. We will understand calendar variance, and that's about it. That's about it. With calendar variance, that's the maximum complexity you can have in this particular segment. So a company has a normal capacity of 120 machines, working 8 hours per day of 28 days in a month. This is what generally the company works. 120 machines. Each machine will work for 8 hours a day, and like that, there are 25 days a month. The fixed overheads are budgeted at 1,44,000 rupees per month. So this is the budgeted fixed overheads. The standard time required to manufacture 1 unit of a product is 4 hours. 1 unit is, you are allowed 4 hours. The month of April 2021, the company worked for 24 days of 840 machine hours per day and produced 5,305 units of output. The actual fixed overheads were 1,42,000. Compute all the variances. Now, in this question, there is one unique thing. What happened? In the budgeted data, the budgeted number of days in a month were how much? 25 working days. Whereas in the actual data, I have only 24 days in this particular month. Clear with this, guys? So, which means, look, in the budget, the number of days were different. In the actual, the number of days are different, which means the same period only. Both were 1 month, but I was budgeting to have 25 working days, but actually I had only 24 working days. So, because if the number of days in the budgeted period and the actual period are different, then you will have another variance called as calendar variance. Are you guys clear with this? Sir, in case of calendar variance, sir, what will happen? What will happen? I will tell you. Now, you need to compute something called as, revised budgeted fixed overheads. Sir, what is the meaning of this? Simple. In this case, what was the budgeted fixed overheads? 1,44,000 for this month. Correct? Now, I budgeted to incur a fixed overheads of 1,44,000 per month, assuming that there are 25 working days. But let us say I have only 24 working days. In this case, what will be my revised budgeted fixed overhead? So why are we revising it? Because the number of days budgeted and the number of days which are actually worked are different. Clear with this, guys? In this case, I will compute something called as revised budgeted fixed overheads. Clear with this, guys? So how much is this going to be? Simple. 1,44,000 rupees is my budgeted fixed overheads for how many days? 25 days, but I'm actually having only 24 days. So how much will be my revised budgeted fixed overheads? 144,000 divided by 25 into 24, you get 1,38,240. It's going to be my revised budgeted fixed overheads. Are you guys clear with this? Now, sir, with this, what do we do? Now, simple. Now, my volume variance, fixed overheads cost variance is bifurcated into two: expenditure, volume, right? Till here, no difference. Now, volume variance is classified into two currently, capacity and efficiency. Now, if the number of days in the budgeted period and number of days in the actual period are not the same, in this case, in between you will have one more variance called as calendar variance. Are you guys clear with this? Sir, one more variance, sir. How do we compute? Very simple. Now, what do we do? Capacity variance, what is the formula? Actual hours, AH into standard rate per hour minus budgeted fixed overheads, right? Now, instead of budgeted fixed overheads, what you need to do here, you should use revised budgeted fixed overheads, the figure that we just computed. Clear with this, guys? Now, sir, how will it tally, sir? On the top, we have only budgeted fixed overheads. If you use revised budgeted fixed overheads, how will it tally? Wait. Now, immediately introduce something called as calendar variance. What will be the calendar variance? It will nullify revised budgeted fixed overheads minus budgeted fixed overheads. Are you guys clear with this? Now, literally, if you see here, the capacity variance, now what will be the formula? AH into SR, that will not change, minus revised budgeted fixed overheads. Instead of budgeted fixed overheads, what will we do now? Revised budgeted fixed overheads. Sir, it will not tally with the top figure. Wait, immediately introduce one more guy called calendar variance. What will calendar variance happen? Now, calendar variance, you have revised, what is the formula? Revised budgeted fixed overheads minus budgeted fixed overheads. If you do this, this and this gets knocked off. I introduce something and revised budgeted fixed overheads positive, revised budgeted fixed overheads negative gets knocked off. Literally what you get is AH into SR minus budgeted fixed overheads. Ideally, this is what you would have got. Clear with this, guys? We are segregating it into two. So instead of budgeted fixed overheads, in capacity variance, you subtract what? Revised budgeted fixed overheads. Immediately in calendar variance, revised budgeted fixed overheads minus budgeted fixed overheads you do. Efficiency variance, the formula will not change. It is the same balancing figure. Clear with this, guys? Or in other words, the capacity variance alone is split into two. Right now you have capacity variance using revised budgeted fixed overheads, and once again to nullify this, revised budgeted fixed overheads minus budgeted fixed overheads is what we need to do. So literally, if you have calendar variance, now there is one more sixth figure that you need to compute, called as what? Your revised budgeted fixed overheads. So anyways, you need to compute standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, then actual hours, and over and above this, now we also need to compute revised budgeted fixed overheads. Are you guys clear with this? If you have this in your mind, then 6 figures first you compute, then just plug the figures in the respective formula and you're sorted here, good to go. Clear with this, guys? Right? So now this is what the sum says. So now shall we first list out all the ingredients of this particular question? Let's do that first, and once we are done with that, this entire question will also be sorted. So what are all the ingredients that we need? Guys, revised budget fixed overheads, that is the 6th item that we need anyways. So we need standard hours, then standard rate per hour, then actual fixed overheads, then what do we need? Budgeted fixed overheads. Is that all? Then we also need one more thing. What is that? Actual hours. These are the 5 ingredients plus the 6th ingredient, revised budgeted fixed overheads, which we have computed. What do you mean by revised budgeted fixed overheads? So budgeted fixed overheads divided by budgeted number of days multiplied by actual number of days. If 1,44,000 was budgeted for 25 days, how much will it be for 24 days? Clear with this, guys? Now, what is going to be my standard hours? Come on, tell me, guys. Standard hours. So how do you compute your standard hours? What is the actual production? So 5,305 units. Now for each unit, you were supposed to take how many hours? 4 hours each, which means it's going to be 5,305 units into 4. How much is that? 5,305 into 4, that's going to be 21,220 hours. Clear with this, guys? Next one, standard rate. How much is the standard rate per hour? Standard rate per hour, budgeted fixed overheads divided by budgeted number of hours. Correct, guys? So now how many budgeted number of hours are there in my in my budgeted period? One second. So this is question number 11. I will also take the question with me, right? Just a minute. Okay, right. So now so it's going to be 120 hours, right? The normal capacity was 120 hours into 8 hours per day of 25 days in a month. So it's 120 into 8 into 25. So 24,000 hours were budgeted. Guys, clear with this? So here the budgeted hours were how much? 120 machines. Each machine is going to work for 8 hours a day, and like that 25 days a month is what I budgeted. So 120 into 8 into 25, how much is that? 24,000 hours were budgeted. And what was the budgeted fixed overheads? 1,44,000. So 1,44,000 divided by 24,000. Literally, the standard rate per hour is going to be 6 per hour. How did we get budgeted fixed overheads? 1,44,000 divided by budgeted hours, which was 24,000 hours. Clear with this, guys? Next one. What is my actual fixed overheads? Simple. Actual fixed overheads is 1,42,000. Right? Now, what's my budgeted fixed overheads? The budgeted fixed overheads is 1,44,000. And what is my actual hours? It's given in the question. Oh no, the company worked for 24 days of 840 machine hours per day. So it means 840 into 24. How much you get? 20,160 machine hours per day. Clear with, not per day, for this entire period of 1 month. Clear with this, guys? So now we got all the ingredients with us. So standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, actual hours, and we also have the revised budgeted fixed overheads. Now it's just an issue of substituting the formula, substituting the figures at the required formula. Now look at this. So all these things I have given in the solved question back itself. First, total fixed overhead cost variance formula, absorbed fixed overheads minus actual fixed overheads. Absorbed is what? Standard hours into standard rate minus actual fixed overheads. Standard hours, how much was it? 21,200 into standard rate, 6 rupees, minus actual 1,42,000. If you do, you get the calculation as how much? 14,680 adverse. right? 14,680 adverse. The total fixed overhead cost variance, that's nothing but under or over absorption. Clear with this, guys? Now this is bifurcated into two: expenditure and volume. Expenditure variance, what is the formula? So your budgeted fixed overheads minus actual fixed overheads. What's your budgeted figure? 1,44,000. What's my actual figure? 1,42,000. All the ingredients are calculated above. Just to substitute. So 1,44,000 minus 1,42,000. 2,000 favorable is going to be your 2,000 favorable is going to be your expenditure variance. Now on the other side you have volume variance. What is the formula? Absorbed minus actuals. So what's your absorbed fixed overheads? Absorbed was 21,200 into 6, right? So 21,200 into 6 gives you how much? 1,27,000, right? So it was 1,27,000. 1 second. 21,200 into 6. It was 1,27,200. Correct? So it's 1,27,200. Just a minute. Yes. So ideally, your standard hours are 21 to 20, right? 21 to 20 hours. So now your absorbed fixed overhead is going to be 21 to 20 into 6. How much was that? 1,27,320, right? So that minus 1,42,000 will only give you 14,680. Correct. So now volume variance. What is the formula? Absorbed fixed overheads, which is 1,27,320 minus budgeted fixed overheads, which comes out to 1,44,000. So 127,320 minus 1,44,000 gives you how much? 16,680 adverse. Clear with this, guys? That's about it. So literally your expenditure plus volume variance. So this plus this should give you your overall fixed overhead cost variance. So can we check this? 2,000 favorable, 16,680 adverse. If you net it off, you get how much? 14,680 adverse. Correct? That is the figure that you get above. So obviously your calculation is correct. Now your fixed overhead volume variance is bifurcated into three. What and what? Your fixed overhead calendar variance. Your fixed overhead capacity variance, fixed overhead calendar variance, and fixed overhead efficiency variance. Three different variants are there. First one, capacity variance. What is the formula? AH into SR minus revised budgeted fixed overheads, right? So AH into SR. So what is your actual hours? Your actual hours are 20,160 hours into standard rate is 6 minus revised budgeted fixed overheads. We got it as 1,38,240. This is what we got here, 138,240, right? Here in a printed format, everything is given, nothing to worry about it. All right. So it's going to be, look at this, 20,160 into 6. So 20,160 into 6, it comes out to how much? 1,20,000. 1 second. 120,960, right? Minus your revised budgeted fixed overheads. So it's going to be 1,38,240. If you subtract this, you get how much? You get 17,280 adverse, right? Now the next one, calendar variance, revised budgeted fixed overheads, 1,38,240 minus budgeted fixed overheads. We have budgeted fixed overheads here, 1,44,000 minus 1,44,000. How much you get? 138,240 minus 144,000. How much is it? 5,760 adverse. And finally you have efficiency variance. What is it? Absorbed fixed overheads minus AH into SR. So absorbed fixed overheads, we already calculated the figure, 127,320. 1,27,320 minus AH into SR. So AH into SR, we got it as 120,960, right? So 127,320 minus 120,960, you get how much? So 6,360 favorable. Clear with this, guys? So now just try to net off these three figures. So 17,280 adverse plus 5,760 adverse, you get 23,040 adverse minus 6,360. Since it is favorable, net it off, you get how much? 16,680 adverse. You get the top figure of your volume variance. Clear with this, guys? So literally with this, we have finished this entire fixed overhead cost variance with your calendar variance. This is one final variant in this particular concept of fixed overhead cost variance. It's as simple as that. So please go to your library of adjustments and update it. So write down, it's going to be fixed overhead cost variance hyphen fixed overhead cost variance hyphen direct computation within bracket with calendar variance. Direct computation within bracket with calendar variance. Clear with this, guys? So literally with this we have finished all the 4 cost variances, right? We have completed your material cost variances, labor cost variances, variable overhead cost variances, and even fixed overhead cost variances with calendar variance, without calendar variance. Everything is completed. So with this the syllabus for CA intermediate students is over, right? CMA intermediate students will have one more extra thing. The sales variants are also applicable, but for CA intermediate syllabus you have only the 4 cost side variances. With this we have completed all the 4 cost side variances with full revision of all the formulas with all the logics, and also we have done about we have done about 7 numerical problems till now. Right, till now itself we have done 7 numerical problems in the marathon itself. Anyways, during the courses, your exam oriented or regular courses, we do many more sums, but in a marathon to revise I have handpicked some comprehensive questions to cover the entire chapter, and that's about this, right guys? So with this we have completed all the cost side variances. So now let's move on to the next one, which is sales side variances, which is applicable exclusively for CMA intermediate paper 12 management accounting students. So now let's get started with the revision of next chapter called as budget and budgetary control. Now, before I get started with this particular chapter, now once again guys, this chapter is a common chapter in your CA intermediate paper 4 cost and management accounting, as well as in your CMA intermediate in paper 8 cost accounting. Exactly the same chapter is there, as well as in CMA Inter paper 12 management accounting, the same chapter is there. In CMA intermediate paper 12, if you notice guys, right now there this chapter is called forecasting, budgeting and budgetary control. Name alone they have added forecasting, but for that, right, exactly everything is going to be the same only. Clear with this? So once again guys, this is a common chapter for your CA as well as CMA intermediate, right? In CMA intermediate, both the papers have this particular chapter. And now this marathon, in this marathon revision, right, I am having a common session for revising this particular budgetary control, right, for CA and CMA intermediate. However, in our regular and exam oriented batches, the recordings are all separately done for CA Inter, and even in CMA Inter paper 8 paper 12 separate recordings are done, and the books are all 3 different books for each of these 3 courses, right? We have our concept decoder and solve question bank separately for every single subject paper here. But since this is a revision marathon, I am having a common session across the courses for all the students, so that even those students who are actually appearing for CA and CMA, or maybe group 1 and group 2 of CMA, everyone, these guys can actually spend one session for a common topic. So that is the reason why I'm making this as a common recording. Clear with this guys? Now on that note, let's get started with this particular chapter called budget and budgetary control. So please have this in mind. So in all our paid courses, we have it as a separate recordings. It's not a combined recording of CA and CMA. Now coming back here, right? Now this chapter, budget and budgetary control, goes on to achieve 2 objectives: decision making and control. 2 objectives. Overall, our subject has 3 objectives, right? So stock valuation, profit computation, decision making and control. Now this particular chapter goes on to achieve the objective of decision making and control. Sir, how sir? First of all, before that, what do you mean by a budget? Budget is basically a plan of action. Now all of us do budgets in our everyday life. For example, let's say your exams are, your exams are going to happen, or your exams are going to be scheduled 2 months from now. Now what do? You prepare a budget. Okay, so 2 months I have, right? So 2 into 30, overall I have 60 days. So per day, let us say I'm going to study for 10 hours. So 60 into 10, 600 hours I have, divided by the number of subjects. Per subject, what is the time I have? Basically, it's a plan of action. Similarly, before the start of every single period or a financial year, or maybe a particular month, as the case may be, the frequency could be different. Every company comes up with their own budget, right? Now I told you this chapter budget goes on to achieve 2 objectives: decision making and control. Sir, how is that possible? Now, first we will see how budget goes on to achieve the objective of decision making. Now, let us say, guys, in the board meeting where the board of directors decide for the upcoming year, right? The board of directors have two choices, right? Now, they are planning to fix the selling price for their product, right? Let us say option number 1. They can fix the selling price at 10 rupees. If they fix the selling price at 10 rupees, they will be able to sell, let us say, 1 lakh units. Or option number 2, suppose instead of 10 rupees, if they reduce the selling price to 9 rupees, they will be able to sell, let us say, 1 lakh 10,000 units. Example, right? Obviously, if you reduce the selling price, the volume will increase. Now, what should be the ideal selling price the company should fix? 10 rupees or 9 rupees? Now, with this data, we can't decide, but what the company will do, if they fix the selling price at 10 rupees, they will arrive at the profit. If they fix the selling price as 9 rupees, they will arrive at the profit. Now, out of these two options, whichever will give the maximum profit for the company, they will go for that particular option. Or in other words, first to fix a budget, a company has to choose between multiple alternatives. This way, it helps them to enable the objective of decision making. Let us say option 2 is more feasible because that gives them the maximum profit. Now, having chosen this option, now what they do, they set this as the target, right? And they inform the team that, look, this year we have to produce and sell 1,10,000 units. The selling price needs to be 9 rupees. Accordingly, they plan their cost, schedule their production and all these things. Now, they set this as the target, which needs to be followed by their team members, right? And this target is compared with the actuals, and now they are able to exercise control over their organization. Now, at the end of the period, they compare the performance which they should have done, the employee should have done, they compare that with the actual performance done by their employees, and they analyze for the variance or deviations, and accordingly they take any corrective actions, or maybe in case these guys have outperformed, they will reward them. This process helps them enable the objective of control. Or in other words, budget helps in two objectives, decision making as well as in the objective of control. And always remember, this is something that is done right before the start of a particular period. Clear with this, guys? Now, that's about a brief introduction to this particular chapter. Now, guys, in this particular chapter, broadly, there are two segments for discussion. Segment number 1 deals with preparation of functional budgets, and segment number 2 deals with preparation of flexible budget, right? Now, this part, functional budget, is kind of similar to cost sheet area, and this flexible budget, it is kind of similar to your concepts that you studied in marginal costing, right? So these are the two segments which we are going to learn in this particular chapter, right, guys? Now, fairly a simple chapter, it's not big as well, and kind of it's very easy to score in this particular chapter. On that note, let's get started with the first segment of discussion called as functional budget. Now, what do you mean by a functional budget? Preparing a budget for every single function in the organization is called as a functional budget. Sir, what are the functions, sir? Sales, production, purchase, your material consumption, labor. So for every single function, right, if you are preparing a budget, it is called as functional budget. Now, I'm just opening the concept decoder note of CA Inter, right? This is more or less whatever we study here is same as what we see in your CMA Inter paper 8, right? As well as in CMA Inter paper 12. Wait, 1 second, I will open and show it to you. Right here, you have this chapter number 16. 1 second. Yes, this is, yes, chapter number 16. It's on page 169. I'll quickly open it up for you. Yes, look at this. More or less, everything is the same in terms of numerical problem, concepts covered. It's all exactly the same, guys, right? That is the reason why Here, since it is a common topic, right, I am making a common discussion, but all our courses are recorded exclusively, even in CMA Inter, paper 8 separate recording, paper 12 separate recording, because these are all different books that I've used. So obviously it is all one and the same. I mean, the recordings are completely different, but in a marathon, when we are revising, right, I thought maybe it's easier for students to combine everything, right, because it's a common topic across all the courses. So obviously we can actually, it's easy to put it in one place, so that even if you are studying multiple courses, it will be easy for you to correlate. That's the reason why clearly I'm mentioning which concept is covered, or which chapter is available in which particular paper, and in what name it is actually being present in everything, right? Just give me a minute. I have this here. One second. Yes, look at this. Forecasting, budgeting, and budgetary control, right? So this is in your paper 12 concept decoder book. This is your paper 8 concept decoder book, chapter number 16, right? This is basically your CA Inter concept decoder book. There it's chapter 15, budget and budgetary control. Everywhere it is exactly the same, guys, right? So in fact, I will be doing a couple of numerical problems, and with that we will be revising this entire chapter beautifully. That's about it, right? And everything is conceptual here. Now guys, now the first one here, what are the different functional budgets? So preparing budget for every single function is called as a functional budget. Different functional budgets: your sales budget, production budget, plant utilization budget, direct material usage budget, direct material purchase budget, direct labor budget, your factory overheads, production cost, your closing inventory, cost of goods sold budget, selling and distribution budget, administration budget, R&D budget, capital expenditure budget, cash budget. These are all different variants of budget. What is every single budget? Theoretically, it's been explained, but practically, quickly, we will just be covering all these areas, right? So these are all the different varieties of functional budget. But remember one thing, practically, to solve numerical problems and all, the first budget that you should have is your sales budget. You should always prepare the sales budget first. Once you prepare the sales budget, the next budget you should prepare is your production budget. It has to be in the same order. Reason I will tell you, right, with a numerical example. So first you need to prepare sales budget, then you need to prepare a production budget, and once these two budgets are, once production budget is available, then all other cost related budget can be prepared. Clear with this, guys? Sir, why is it that I need to maintain, or I need to prepare budgets in the same order? Now guys, always remember, sales is the starting point. Always remember, sales is a starting point. Now if you notice, right, in a factory, in an FG area, right, let us say I have an opening stock of FG, right? Then I have, let us say, for example, I have 1000 units of opening stock of FG, right? Guys, clear with this? Then let us say the closing stock of FG that I need to maintain is 2000 units. I'm just giving you guys an example, right? And let us say I am planning to sell, example, 10,000 units of FG, right? Now, in this upcoming year, first, the company is planning to sell 10,000 units, right? Now, sir, let us produce 10,000 units. Wait, they also want you to maintain a closing stock of 2000 units of FG, which means, sir, I have to sell 10,000 units of FG. Over and above that, I need to maintain at the end of the year a stock of how much? 2000 units of FG, which means totally, sir, I need to have how many units of FG with me? 12,000 units of FG with me. Sir, which means, should I produce 12,000 units of FG? Wait, now you need to have 12,000 units of FG, but already you have with you 1000 units of FG, which means at present, in this current period, you are only required to produce how many units? The production is going to be how much? The balancing figure. So 12,000, right, minus 1000, it is enough if you produce 11,000 units right now. Are you guys clear with this? Or in other words, for you to first arrive at the production budget, you first need how many units you're going to sell, right? Sales plus closing stock gives you the total requirement, right? From that minus the opening stock which you already have, now you will be getting the figure which you need to produce in this particular period. Clear with this, guys? Or in other words, I can say sales plus closing stock minus opening stock gives me the production. In this case, I need to produce, I need to sell 10,000 units. On top of it, I need to have 2000 units as a closing stock, but wait, I already have with me 1000 units of opening stock, which means net off, I need to produce how many units? I need to produce only 11,000 units in this particular period. Are you guys clear with this? Right? So now, for me, first I need the sales budget. Using the sales budget only, I can arrive at the production budget. Clear with this, guys? And now once I have the production budget, now all other budgets I can prepare. For example, let us say, guys, 1 unit of FG requires 2 kgs of raw material. Now, with this, I can say totally how many kgs of raw material should I need? What is the total raw material consumption budget? Can I say raw material consumption is going to be, sir, for every unit of FG, I need 2 kgs of raw material, but in this year, I'm going to produce 11,000 units of FG, which means totally I need how many kgs of raw material? 11,000 into 2, I need a total of 22,000 kgs of raw material. Alright, so this is my raw material consumption budget. Clear with this, guys? Now, on top of it, the company wants to maintain a closing stock of raw material. Let us say the company wants to maintain a closing stock of 3000 kgs of raw material, which means now I should have with me what? 22 kgs for the purpose of production I need to consume, plus 3000 kgs I need to maintain, which means overall, so 25,000 kgs you need to purchase, right? But wait, minus I already have with me, let us say I already have with me 5,000 kgs of opening stock, which means totally I need 25,000, out of which already 5,000 is available in my opening stock, which means net of now I only need to purchase how much? I need to purchase 20,000 kgs of stock or raw material. Are you guys clear with this? This is called as raw material purchases budget. Are you guys clear with this? Let us say 1 kg of raw material is purchased rate of 10 rupees. So now this 20,000 kgs into 10 gives you 2 lakh rupees in value. Are you guys clear with this? So now the first point was sales budget. From the sales budget, we arrived at the production budget. Using the production budget, we could arrive at the raw material consumption budget. Using the raw material consumption budget, we could arrive at the raw material purchases budget. Clear with this, guys? Suppose, for example, right, 1 unit of FG requires 3 labor hours, which means what is the total labor requirement budget for you? 11,000 units into 3. I will say, sir, totally I need 33,000 labor hours in this particular period. Clear with this, guys? So using the production budget, now you can arrive at your labor requirement budget, and all other budgets will stem out of your production budget only. Are you guys able to understand? So always remember, the first budget you need to prepare is what? Sales budget. From the sales budget, production budget can be arrived. From the production budget, your raw material consumption budget, raw material purchases budget, your labor requirement budget, all other budgets you can prepare using the production budget. Are you guys clear with this? And that is all about, right, this particular concept of your functional budget. Now, directly on this note, let's go and solve one numerical problem. That's about the first segment. So let's go and solve one numerical problem. Once again, guys, this is a common question for both CA and CMA students. So please take the first question, right, from your CA intermediate, solved question bank. Now do not think that, sir, CA question, sir, it is not applicable for me. Absolutely not. This question is equally applicable for CMA intermediate paper 8 cost accounting students as well as paper 12 management accounting students. I am just taking one sum so that it's a proper revision for you to complete this entire concept of functional budget. As simple as that. Don't think that it's not a part of your syllabus. It's applicable for everybody. Clear with this, guys? On this note, let's get started here. Now, what are they given? Prepare a quantitative production, material usage means material consumption, and purchases budget from the following data of a particular month. Product A, product B. Budgeted sales quantity for each of the products is given. Material consumption per unit is given. Right? So product A requires 2 kgs of material B and 1/8 kgs of material Q. Right? Similarly, product B requires 4 kgs of P and 1 kg of Q. Basically, guys, there are 2 different products and each of the product requires 2 different types of raw material. Right? Now, what have they given here? The stocks of the products and materials are as under. Product A and B, guys, please be careful here. A and B are FG and material P and Q are raw material. Now, A and B, FG, they have given the opening stock and the closing stock. Right? The figures are given. Raw material P and raw material Q, opening stocks are given, closing stock are not given. Read the question below. The company wishes to operate a JIT material inventory system. JIT means just in time, right? Which means they don't maintain much of stock, right? Whenever it is required, only then, when they get a customer order, only then they will purchase and they will keep the raw material, right? Now what is JIT is not required in this particular question. They themselves have given. As an initial procedure, it wishes to maintain a minimum stock of material equivalent to 2 days worth of consumption. Right? Sir, whatever I am going to consume in 2 days, that will be the amount of closing stock for P and Q. Clear with this, guys? Now, there are 28 working days in a month. Based on this, you can calculate what your closing stock. Basically, what we will do is monthly consumption divided by 28 into 2. If you do, you will arrive at your raw material P and raw material Q's closing stock values. Clear with this, guys? So now, what do we do about, how do we go about with this particular question? The first thing that we need to do here, guys, the first thing we need to do here is what? Using the sales, first we need to arrive at our production budget, correct? Once we arrive at the production budget, now what we can do is, based on the production budget, we can arrive at the raw material consumption budget, and then we can arrive at the raw material purchase budget and other things. Clear with this, guys? So on this note, let's get started here. First, guys, let's talk about these 2 output products, FG products, product A and product B. Now, what is the sales value here? Given 15,000, 17,500. Now, sales plus closing stock. How much is the closing stock? 1750, 3375. So 1750, 3375 minus opening stock. How much is the opening stock? 750 and 875. Reduce this, 750 and 875. Net of, so what is going to be, how many units of A should be produced? 15,000 plus 1750 minus 750. Literally you need to produce 16,000 units of A. And how many units of B? 17,500 plus 3375 minus 875 gives you 20,000 units of B. So first we arrived at the production budget. We calculate how many units of A and how many units of B needs to be produced. Are you clear with this? Now, based on this, we can prepare the material consumption budget in kgs. Now, what are the 2 different types of raw material? Material P and material Q. First, material P and material Q. Now, what happens here? Now, first, product A. How many units of product A I'm going to manufacture? 16,000 units of product A I'm going to manufacture. And please have this in mind. To produce every unit of A, I need 2 kgs of material P and 1/8 kgs of material Q. Clear with this, guys? So now 16,000 units of A require totally how many kgs of P? So 16,000 into 2, I need how much? 32,000 kgs of product P, raw material P. Are you guys clear with this? So for producing 16,000 units of A, right, every unit of A requires 2 kgs of raw material P. So 16,000 into 2, I need 32,000 kgs of P, plus every unit of A requires 3 1 by 8 kgs of what? Raw material Q. So simple, 3 1 by 8 is basically how much? So 1 by 8 is 0.125. So 3.125, right, kgs of Q is what I need. So every unit of A requires 3.125 kgs of, right, raw material Q. So here I will say it is 16,000 units into 3.125. How did you arrive at 3.125? 3 1/8. So 1 by 8 you do. How much you get? 0.125. So 3 plus 1 by 8. That is 3 plus 0.125, 3.125 kgs. So to produce 1 unit of A, I need 3.125 kgs of Q. So to produce 16,000 units of A, how many kgs of Q do I need? 3.125. So 16,000 into 3.125. Overall, I need 50,000 kgs of Q. Are you guys clear with this? Next one. How about B? How many units of B are we going to produce? So we are going to produce a total of 20,000 units of B. And every unit of B requires 4 kgs of P and 1 kgs of Q. Very simple. 20,000 into 4, 80,000 kgs of P, and 20,000 into 1, so that's going to be 20,000 kgs of Q. Clear with this, guys? So overall, how many kgs of P is required for consumption? 32,000 plus 80,000. It gives me a total of 1,12,000. And how many kgs of Q? 50,000 plus 20,000. It gives me a total of 70,000 kgs of Q. Are you guys clear with this? Or in other words, overall, the raw material consumption budget is going to be 1,12,000 kgs of P I'm going to consume in this particular month, and 70,000 kgs of Q I'm going to consume in the particular month. Clear with this, guys? So the upcoming month requires this particular consumption of P and Q. Clear with this, guys? Now, from this, we need to calculate the material purchases budget. How do you arrive at the material purchases budget? Simple, raw material consumption plus closing stock minus opening stock net off gives you your material purchases budget. As simple as that, right? Now, what do we do here? Simple, guys. First, raw material consumption. We know P 1,12,000 I need to consume. Perfect. And Q 70,000 I need to consume. Clear with this, guys? Perfect. Plus closing stock minus opening stock. Now in the question, I have the opening stock figures 12,000 kgs and 8,000 kgs. Very simple. This figure I can populate 12,000, 8,000 respectively. Consumption also we have. Now how will you compute the closing stock of raw material? Simple. In the question they have given, the company is planning to maintain minimum stock which is equivalent to 2 days worth of consumption. Right? Now let us take product P. Now product P, in a month I am planning to consume how many kgs? 1,12,000 kgs. So 1,12,000 kgs is for a period of 1 month, having how many days? 28 days. So if this is the consumption required for 28 days, how many kgs do I consume for 2 days? 1,12,000 divided by 28 into 2. Basically, I am going to consume 8,000 kgs for 2 days. So 2 days equivalent consumption is what I'm going to stock as my closing stock. Hence, 8,000 kgs is going to be my closing stock for raw material P. Are you guys clear with this? Right? This is a good adjustment in this question. Now, the other one for product Q. Again, 2 days equivalent stock. So 70,000 is the consumption required for 1 month having 28 days. How much will be the equivalent consumption for 2 days? 70,000 by 28 into 2. That gives you how much? 5,000 kgs. Are you guys clear with this? So 5,000 kgs is going to be my closing stock of raw material Q. So P has a closing stock of 8,000 and Q has a closing stock of 5,000. So now what do we do here? So what is going to be my total purchases, raw material purchases budget? Raw material consumption 1,12,000, right? So plus closing stock 8,000 minus opening stock of 12,000. So 1,12,000 plus 8,000 minus 12,000 gives you 1,08,000 is going to be the total number of kgs which I need to purchase in this particular period. And how about product Q? It's going to be 70,000 plus 5,000 kgs, right, of closing stock, right, minus 8,000. So 70,000 plus 5,000 minus 8,000 gives you 67,000 kgs I have to purchase raw material Q. Are you guys clear with this? this is going to be the raw material purchases budget in kgs. Now if I want to convert it into value, simple, every unit, every kg of P has a purchase price of 3 rupees and every kg of Q has a purchase price of 2 rupees. Multiply this respectively with 3 and 2. So 1,08,000 into 3 gives you 3,24,000 and 67,000 into 2 gives you how much? 1,34,000. Clear with this, guys? So this is going to be the raw material purchase budget in value, and this is going to be raw material purchases budget in kgs. Clear with this, guys? So this is the purchase budget in kgs, and this is going to be the purchase budget in value. Are you guys able to understand? As simple as that. So first what you need to do, sales data is that sales plus closing stock of FG minus opening stock of FG gives you production. So production, right, into the number of kgs required per unit, you arrive at the consumption budget. Now consumption, raw material consumption plus closing stock, this is ideally plus closing stock minus opening stock, gives you your raw material purchases in kgs. Multiply that with the rate, you will arrive at the raw material kgs to be purchased, the purchases budget in value. As simple as that, guys. Very, very simple and straightforward, provided you have this particular line of thinking. That's all it is. That's all it is. Clear with this, guys? This is all we need to do in this particular area of functional budget. Clear with this, guys? So with this, we have completed this particular question. So let's go and update our library of adjustments. So write down functional budget hyphen functional budget hyphen production budget semicolon production budget semicolon raw material consumption budget semicolon raw material purchases budget, right, semicolon calculation of closing stock of raw material. That was a good adjustment in this question. So that is also something we did here. Clear with this, guys? Right? So exactly on the same line is how we compute the remaining functional budgets, like your your labor hour requirement budget, your labor budget, right? Then your production overhead budget, selling overhead budget. So all other functional budgets are prepared at the same line. The base is first, sales is a starting point. Sales plus closing stock of FG minus opening stock of FG gives you production. This production budget is the base for all other functional budgets. Clear with this, guys? And that's about this overall area of your production budget. So since this is a marathon, right, I just wanted to do one representative numerical problem for functional budget, right? In our batches we do it in detail, but since this being a marathon, right, I wanted to do one representative question from functional budget and leave it there. Now let's move on to the second segment called as flexible budget. Let's move on to the second segment called as flexible budget. Now let's move on to the next segment of discussion called as flexible budget. Now guys, what is this concept of flexible budget? Now let me take an example. Now let us say they have given the following data, right? Now for 80,000 units of volume, let us say this is an example. Let us say this is a given data. The per unit cost of direct material is 8 rupees. Direct wages, let us say per unit is 4 rupees. Right? This is a random example I'm giving you. Then let us say the variable production overheads is going to be 4 rupees per unit. Okay, let me just take it as 6 rupees per unit. Anything is fine. Fixed production overheads, let us say, is 2 rupees per unit. Similarly, your variable administration overhead is, let us say, 5 rupees. Fixed administration overheads is, let us say, 3 rupees. Then your variable selling overheads is 2 rupees. And let us say your fixed selling overheads is 7 rupees. Just an example, right? Now, this is the data given, right, for an output level of 80,000 units. Now, using this budgeted data, they are asking you to prepare a budget for 90,000 units level. Suppose I'm going to produce 90,000 units. What is going to be the cost, right, of all these components, direct material, direct wages, variable production overheads, fixed productions or fixed production overheads and all for 90,000 units capacity level. Now, how will you do this? Simple, guys. So first, what we will do is, now out of these components, we will first identify what are all the variable components: direct material, direct wages, variable production overheads, variable administration overheads, variable selling overheads. These are all variable costs, right? Now, we know that variable costs will remain constant on a per unit level, whereas fixed cost remains constant in total. So now what we do is, in the given budget, right, first what we do, right, we arrive at all the total amount also. So here 80,000 into 8 is equal to 6,40,000, 4 is equal to 3,20,000, 6 is equal to 4,80,000, right, 2 is equal to 1,60,000, right, 5 is equal to 4 lakhs, right, 3 is equal to 2,40,000, then 2 is equal to 1,60,000, right, and 7 is equal to 5,60,000. So now what we did, now component wise we have the per unit figure and the total figure with us. Now what will we do? Now this is a budget which is available with us, right? This is called as a static budget or a fixed budget. What is the meaning of that? A budget prepared for one given volume level is called as a static budget, right? Now using the static budget, if you are preparing a budget for a completely different output level, that is called as a flexible budget. Now in this case, now we need to prepare a budget for 90,000 units level, right? Once again we need to arrive at the per unit and the total column. Now first, how will we do that? Simple, guys. We know variable costs will remain constant on a per unit level, whereas the fixed costs will remain constant in a total level. So what we will do, first identify the variable costs. Now direct material is a variable cost, right? So irrespective of the output level, it will remain constant on a per unit level, right? Direct wages 4 rupees, variable production overheads 6 rupees, right? Whereas fixed production overheads, it is a fixed cost, it remains constant in total. So fill the total column, 1,60,000, right? Similarly, variable administration overheads, fill the per unit column. Fixed administration overheads, fill the total column. Similarly, variable selling overheads, fill the per unit column. Fixed selling overheads, fill the total column. Clear with this, guys? So these are all. Once again, I will just take it out here. I'll just copy paste the figures. Okay, yes. Right. So I'm just taking this and slightly I'm moving it off here so that it's easier for us to capture. Right. So now what we do, guys, now from this static budget, right, or a fixed budget, first we picked the variable components, and the variable component column alone we filled the per unit column. With respect to the fixed components, we took the total column and we filled here. Clear with this, guys? Now what we need to do, why we did this? Because of the cost behavior pattern, right? Variable cost remains constant on a per unit level, fixed cost remains constant in total. Now we can just complete the remaining parts. Now the variable components, we have the per unit data, multiply it with the output, you will arrive at the total column. Now with respect to the fixed cost, you have the total column divided with the output, you arrive at the per unit column. As simple as that. Clear with this, guys, right? And that is all we need to do here. Let me just rearrange this. 1 second. Right, and here we have this. That's about it. Right. 1 second. That's all it is. Clear with this, guys? So now this is called as a static budget, right? A static budget means what? A budget which is available for a given volume level. Using the data given in the static budget, if I flex it and prepare a budget for a completely different volume level, it is called as a flexible budget. Here we use the concepts of variable cost and fixed cost, right? The cost behavior pattern is being used. Basically what we do is variable cost remains constant on a per unit level, fixed cost remains constant in total. Based on this we can prepare a budget for any given volume level. This basically is called as a flexible budget. Now an advanced level sum would be, right, it might not be as simple as this. We'll be doing one numerical problem where now for a different output level we need to prepare a budget, where in the next year maybe we need to prepare a completely different budget for a different volume level with some changes in cost and all, and maybe on certain items of cost might not be constant on a per unit level, it might not be constant in total also. In that case what we need to do, we need to segregate the total cost into variable component, fixed component, because if it is neither constant on a per unit level nor is it constant in total, it is basically called as your semi variable cost and all. So that needs to be necessarily segregated into variable and fixed component and needs to be dealt with accordingly. All these issues we will be taking one good numerical example, and with the help of that particular numerical question we will be covering this entire concept of flexible budget. That's about it, guys. So once again, please go to your solved question bank of your CA intermediate material. All right, so please go to question number 9. Once again I'm telling you, this question is equally applicable for CMA intermediate students, both paper 8 as well as paper 12 students, cost accounting and management accounting students of CMA intermediate. You can definitely follow this sum because it is also equally applicable for you guys. And again I want to reiterate that in all our courses the recordings are separate. I'm not mixing any recordings. For the purpose of marathon I am just combining it just so that the concepts are similar, so you have everything in one particular place. Clear with this, guys? So here let's go on to question number 9. Yes, let's go to this particular question, a good question, right? So one question, I'm taking a comprehensive question and I'm doing it in the marathon itself. We are also covering the numerical problem. So now let's get started here. ABC Limited is currently operating at 75% capacity, and in the past 2 years the levels of operations were 55 and 65% respectively. The present production is 75,000 units. Wait, so 75% capacity represents 75,000 units, which means 100% capacity will represent 1 lakh units, 75,000 by 75%. Now the company is planning for 85% capacity level, which means in the next year they are planning for a capacity level of 85,000 units, and the cost details are available as follows. Now what have they given here? For 55% capacity basically means 55,000 units volume level, the cost data are given. 65,000 units, the cost data is given. 75,000 units level, the cost data is given. Right, guys? Fine. Now, what have they given? Direct material, direct labor, factory overheads, selling overheads, admin overheads. Remember, all these figures are given in total, right? And they have totaled up all the line items as well. The profit is estimated at 20% on sales, right? So profit is going to be what? On top of this cost, you need to add a profit which is equal to 20% on sales, right? You need to arrive the sales value. Now, the following increase in the costs are expected in the next year. First, guys, 3 different volume level is given, right? In the next year, the company is planning for what percentage of capacity? 85%, which means they are planning for an output of how much? 85,000 units, right? So obviously what we need to do, analyze which are all the variable costs. Variable cost remains constant on a per unit level, whereas fixed cost remains constant in total, right? Now over and above this, look at this. The following increase in costs are also expected during the next year. First, direct material, they're expecting an 8% increase. Direct labor, 5% increase. Variable factory overheads, 5% increase. Variable selling overheads, 8% increase. Fixed factory overheads, 10% increase. Fixed selling overheads, 15% increase. And administration overheads, a flat 10% increase. Prepare a flexible budget for the next period, that is 20x2 x3 at 85% capacity level, right? Also ascertain the profit and the amount of contribution. This is what they have asked in this particular question. So now, since they have asked for profit and contribution, so you need to prepare this in a marginal costing income statement format. Sales minus all the variable costs gives you contribution, right, minus fixed cost gives you what? Your profit, right? But before that, once, how will you get the sales? For you to get the sales figure, first you need to arrive at the total cost, because total cost plus profit is only sales figure, right? So basically what we will do, first we will arrive at all the variable costs, to that add all the fixed costs separately, right? Arrive at the total cost. From that add whatever is the markup profit required, we arrive at the sales value, and then finally we list down sales minus variable cost equal to contribution, right? And the sales minus total cost gives you profit. That way also we can do it. Clear with this, guys? But before that, first let us get started with this question. Maybe if you want, pause the video now and try to attempt this by yourself. A masterpiece, good question, right? To cover a representative coverage of this flexible budget, a good sum to revise the day before your exam, right, guys? Of course, in our regular and exam oriented batches, every single sum I will be doing, right? However, in a marathon, I didn't want to actually omit the sums and all. At least one representative sum from concept I want to do, so that it will be a very good effective way of revising this entire chapter. Fine, guys. Maybe if you want, you can pause the video now and try to attempt this particular question by yourself. Now let's get started. First one, sir, I want to, first what I need to do, I need to segregate the cost into variable component or fixed component. First, how do we do? Guys, ideally speaking, any 2 levels is enough. In this question, they have given 3 levels of output. Sir, first, why do we need so many levels of output, sir? Now, which costs are variable, which costs are fixed? How do we know? Simple. Now, first, direct material. Let us take 55% capacity level and 75% capacity level. Take extremes, right? Now, calculate the direct material cost per unit. First, you tell me, is direct material fixed? Definitely not. Why? Had it been fixed, it would have been constant in total. Now, is it variable? Let us check. How will we check? Arrive at the per unit cost of direct material. So if it is constant on a per unit level, it is going to be your variable cost. Now 11 lakh divided by 55,000. How much is it? So it's going to be 20 rupees per unit here. How about 75% capacity level? 15 lakhs divided by 75,000 gives you how much? 20 rupees only. Which means now this is constant on a per unit level. Hence this is a variable cost. And it varies the rate of how much? It is going to be 20 rupees per unit. Next, labor. 5,50,000 divided by 55,000. How much is it? 10 rupees per unit. Take the extreme level. 7,50,000 divided by 75,000. How much is it? 10 rupees per unit. Clearly, this is also a variable cost. Next one. Take your factory overheads. Is it fixed? 3,10,000. 3,30,000, 3,50,000. No, it is not constant in total. Clearly, it's not fixed. Let us check whether this is variable. Now, 3,10,000 divided by 55,000. How much is it? You get 5.63 something. Now, is it okay? So at 75% capacity level, 3,50,000 divided by 75,000. How much you get? You get 4.66 something. Now, if you see, it is not constant in total, and it is also not constant on a per unit level. So clearly this is a semi-variable cost. And if you have a semi-variable cost, what you need to do, segregate this into fixed and variable component. How will you do that? Literally, this is something that we have actually learned in both basic concepts, which I generally do in our regular and EVO batches. But anyways, even in this marathon, we have covered in volume analysis, right? That is difference in total cost divided by difference in units. You will be able to get your variable cost per unit, and with that you can segregate your total cost into variable and fixed components, which I'll be doing here, right? Next one, selling overheads. Now, is it fixed? 3,20,000, 3,60,000, 4 lakh. It is not constant in total. Let's check whether this is variable. 3,20,000 by 55,000. How much is it? It's going to be 5.818181. Here it's 4 lakh divided by 75,000. Is going to be 5.33 something. So it is not constant in total. It is not constant on a per unit level also. This is also a semi-variable cost, which means it needs to be segregated into variable and fixed component. Next, admin overheads. Is it fixed? Yes. 1,60,000, 1,60,000, 1,60,000. So clearly my admin cost is going to be a fixed cost. Clear with this, guys? So now the first thing I need to do is segregate right? My factory overheads and selling overheads, I need to segregate it into variable component and fixed component. Clear with this, guys? So how do we do that? That is the first part of discussion in this particular question. So now quickly let's get started here. So now first one, factory overheads. So please have the question with you. So this is question number 9. Question number 9. The first one, I'm having a working note for factory overheads, right? So factory overheads. Now clearly, guys, for 55,000 units level, how much is my factory overheads? Yes, it was 3,10,000, right? And for 75,000 units level, how much was it? It was 3,50,000 rupees. Right, guys? This was units. So now, can I say variable component is going to be difference in fixed cost? How much is the difference in the total cost? How much is the difference here? It's going to be 40,000 rupees. So 40,000 divided by difference in the units. How much is the difference in units? So 75 minus 55, basically it's going to be 20,000 units. Or in other words, logically, my overall cost increased by 40,000 rupees because my units increased by how much? 20,000 units. Guys, clear with this? So the increase in the total cost is purely on account of the variable cost incurred for the incremental units, or in other words, how much is the variable cost per unit? 40,000 divided by 20,000, you get how much? So rupees 2 per unit. Now with this, you can arrive at your fixed cost. Fixed cost is equal to, right, total cost minus variable cost. Now you take any one volume level, right? Let us take 55,000 units as the volume level. At 55,000 units, how much is the total cost? 3,10,000. That is the total fixed over in total factory overheads, right? Minus how much is the variable component? 55,000 into 2, right? So basically you get 3,10,000 minus 55,000 into 2 is going to be 1,10,000. So basically you get how much? Rupees 2 lakh. Clear with this, guys? Alright, so now my fixed component of your factory overheads is going to be 2 lakh rupees. Variable component is going to be 2 rupees per unit. Are you guys clear with this? Right? So this is something that you need to actually have in mind, as simple as that, right? And of course, in this particular question, this is subject to some price increase and all. What it is, we will just see it later. But as of now, clearly we know that the variable factory overheads is how much? So factory overheads, if you see, 1 second. So here, so factory overheads, if you see, variable component is 2 rupees per unit. It's 2 rupees per unit. The fixed component is going to be rupees 2 lakh in total. Clear with this, guys? Right? This is the story about your factory overheads. Next one. What is the other one that they have mentioned? The next one is regarding your selling overheads. This is also semi-variable. Now let's take the two extreme volume levels, 55,000, 75,000. How much is the figure? 3 lakh 20 and 4 lakh. Let's take these two figures. Alright, so this is a separate working note for what? It is a separate working note for selling overheads. Now guys, 55,000 units level, that is 55% capacity. So 55,000 units. The other one is how much? 75,000 units. I'm just taking the two extreme, the two extreme output level. Now, units. In this case, how much is my selling overheads? At 55,000 units level, it's going to be rupees 3,20,000. And at 75% level, it's going to be how much? Rupees 4 lakh. Right? So my variable cost is going to be the difference in the total cost, which is going to be how much? The difference in the total cost is going to be, right? How much is it, guys? The difference in the total cost is going to be here 80,000 divided by the difference in the total units. How much is it? So it's going to be 75,000 minus 55,000. How much is that, guys? It's going to be 20,000 units. So basically I'll say 80,000 rupees is the variable cost pertaining to 20,000 units. How much is going to be on a per unit level? It's going to be rupees 4 per unit. Now, how much is the fixed component here? So the fixed cost is equal to total cost minus variable cost. So take any one volume level, 75,000 units volume level. What is the total cost of selling overheads? 4 lakh minus how much will be the variable component? 75,000 into 4, right? So how much is 75,000 into 4? It's going to be 3 lakh. So 4 lakh minus 3 lakh, you get how much? You get 1 lakh rupees as the fixed component of selling overheads. So basically guys, selling overhead, variable component, fixed component. Variable component is going to be 4 rupees per unit and the fixed component is going to be rupees 1 lakh. Are you guys clear with this? Right? Are you guys clear with this? Right? And that is all about this particular part of this particular question. Right guys? So selling overheads we have and production overheads, factory overheads we have. Now the other parts are readily available. Direct material 20 rupees per unit, variable component, right? Only variable. And your direct labor, it is going to be 20 rupees per unit. These are all variable components, right? And how about your admin overheads? It's fully fixed, 1,60,000 rupees. Clear with this, guys? So now let us just list out the summary. Let us just list out the summary. Now quickly here, I'm just writing out summary. Now, what are all the line items of variable costs here? Line items of variable cost. First, you have direct material. How much is direct material? Just now we saw 20 rupees per unit, correct? Present cost, how much? 20 rupees per unit. Wait, this is subject to change. That I'm not coming to. I've not come to that, as of now. We will do that. Don't worry. Next up, how much is the direct labor? Fully variable, 10 rupees per unit. So direct labor, 10 rupees per unit. Right? Next one. Third, then what is the other variable component? Now I have factory overheads, variable component, 2 rupees. So variable factory overheads, rupees 2 per unit. Fourth one, variable selling overheads is going to be how much? 4 rupees per unit. Right? These are the ingredients of your variable costs. Next, what are the things you have in your fixed costs? In fixed costs, we have first one, factory overheads. So first one, factory overheads. How much is that, guys? It's going to be 2 lakh rupees. We saw here. So write it up here. It's going to be rupees 2 lakh. This remains constant in total. Number 2, your selling overheads. You have fixed component. How much is it? 1 lakh rupee. We calculated it, right? It's going to be rupees 1 lakh. And the third one is your administration overheads. It is fully fixed. We saw here how much was that? 1,60,000, right? So it's going to be rupees 1,60,000. These are all the ingredients of the cost as of now, right? Now let's go further and read the question. What have they said? In the upcoming years, sir, variable cost clearly on a per unit level I have. Fixed cost I have it in total. Wait. Now they are saying there is a following increase in the costs. Direct material costs are going to increase by 8%. Labor costs are going to increase by 5%. Variable factory overheads by 5%. Variable selling overheads by 8%. Fixed factory overheads by 10%. Fixed selling overheads by 15%. Administration overheads by 10%. Now we need to apply all these changes. But remember, the changes, right, should be applied. For the variable cost, the changes should be applied on a per unit level, and for the fixed cost, the changes should be applied in total. Now let's apply all the changes and we will arrive at the revised figures. Now guys, first one, direct material cost, it is going to increase by how much? 8%, which means in the upcoming year it's going to be 20 into 108% or 1.08. How much is this? 20 into 1.08. It is going to be how much? Rupees 21.60 per unit. So for the upcoming year, the direct material cost is not going to be 20 rupees, it's going to be 20 rupees into 108%, because 8% increase is going to be there. Next, direct labor is going to increase by how much? 5%. So into 1.05. So 10 into 1.05 gives you how much? Rupees 10.50 per unit. Next, fixed variable factory overheads. How much is it going to increase? It's going to increase by another 5%. So into 105%, how much is this? 2 into 1.05 gives you how much? 2.10 rupees per unit. Clear with this, guys? And how much is the variable selling overheads? It is going to increase by how much? 8%. So into 108%. So or into 1.08, how much is that? It's going to be rupees 4.32 per unit. Clear with this? That's about it. Next one. How about your fixed cost? My fixed factory overheads is going to increase by 10%. Please have the question with you. So into 110%, how much is that going to be? It's going to be rupees 2,20,000 as a whole. So please be careful. For variable cost, I'm applying the change on a per unit level. For fixed cost, I'm applying the change in total. How about your fixed selling overheads is going to increase by 15%. So into 115%, how much is that going to be? 1,15,000. Right? Right, 1,15,000. Then administration overheads is going to increase by 10%. So into 110%, how much is that? 1,16,000 to 1.1 gives you rupees 1,76,000. Are you guys clear with this? So now for the upcoming year, we need to prepare a particular flexible budget for 85% capacity level, 85,000 units level. Very simple. So 85,000 units level, all the variable costs we have on a per unit level, right? Respective variable cost multiply with 85,000 rupees, 85,000 units, you will arrive at the total column, right? And the fixed costs are readily available in total. These figures you can directly apply. That is what they have also mentioned here. Budget for 85% capacity level. Now, first direct material, how much is it? 21.6. This is what we also found out, right? Next, direct labor, how much is it? 10.50. This is what we found out. Next, direct variable factory overheads, 2.10. Look at this, 2.10. Variable selling overheads was 4.32. Look at this, 4.32. Right? Now the respective figures you have, multiply this with 85,000, you will arrive at the total column, right? The total variable cost, and you will get the per unit and the total figure. Next, fixed costs, how much you get? Fixed factory overheads was 2,20,000. Look at this, 2,20,000. Fixed selling overheads was 1,15,000. Yes, you get 1,15,000. And fixed AOH was 1,76,000. You get 1,76,000. So the sum total of all the fixed costs comes out to the sum of these three. How much was that? 2,20,000 plus 1,15,000 plus 1,76,000. You got a total fixed cost of 5,11,000. Clear with this, guys? So the total variable cost, here is a figure. The total of fixed cost 5,11,000. So what do you get? 32,74,200 plus 5,11,000. How much you get as a whole? The total cost for the company is going to be 37,85,200 rupees. Now they are saying the company expects. How do you fix your profit? I mean, how do you fix your selling price? Your total cost, add a profit. How much is the profit? 20% on sales. What is the meaning of this? What is the meaning of this? Now, cost, profit, selling price. Now they are saying profit is 20% on sales. So which it is on sales. Hence, if you keep your selling price as 100, profit will be 20. How much will be the cost? 100 minus 20, cost will be 80. Guys, clear with this? So now I have this. So now if my cost, right, is equal to 80, how much will be my profit? Right? So if 80, so 37,85,200 is 80. How much is equal to 20? Reverse calculate. So 37,85,200 divided by 80 into 20. If you do, you will get a profit of how much? 9,46,300. So 37,85,200 plus 9,46,300. You will get the total sales as how much? 47,31,500 rupees. Clear with this, guys? With this, you arrive at the sales figure. You arrive at the profit. This profit was also asked in the question. We arrived at it. How do you calculate the profit? 37,85,200 divided by 80 into 20. That's how you arrive at the profit. Guys, clear with this? Now, they had also asked for contribution. Simple. Sales minus variable cost gives you contribution. That is 47,31,500 minus 32,74,200. You get how much? 14,57,300. That also you can arrive at it. Clear with this, guys? And with this, this entire sum is over. And all these things we have actually done. Clear with this, guys? A very good and a comprehensive question wherein we saw the concept of flexible budget with changes in your cost. And this sum we had to analyze and find out which costs are all variable, which costs are all fixed, and which costs were all semi-variable. And for those semi-variable costs, we had to segregate it into variable component, fixed component, and on these costs we had to apply some changes and arrive at the revised cost for the upcoming year, and on that cost add the profit, arrive at the sales, and having arrived at the sales, now arrive at the contribution, which is sales minus variable cost. A very good numerical problem to actually sum up the entire concept of fixed and flexible budget. Clear with this, guys? So please go and update your library of adjustments. Please go and update your library of adjustments. Write down flexible budget hyphen identification of costs into VC and FC, variable cost and fixed cost, semicolon, segregation of semi-variable costs. Write down segregation of semi-variable costs, semicolon, segregation of semi-variable cost, semicolon, increase in costs. Write down increase in costs. This was also given. Increase in costs, semicolon, calculation of expected sales. Calculation of expected sales. It was completely a reverse working question, a beautiful question, and in my opinion, this question is a must to visit the day before your exam. Whether you are a CA intermediate student or a CMA intermediate student, be it paper 8 cost accounting or paper 12 management accounting, this is a masterpiece problem which I would suggest is applicable for everybody, right? Though I am taking this from CA Institute, from our CA question bank, right, which I have prepared, right? I'm telling you this concept and this particular question itself is equally applicable even for CMA intermediate students, right? There in CMA intermediate courses, I would have done certain questions directly from the CMA Institute study material, but for the purpose of revision, I'm telling you, definitely this kind of question can be expected across all the courses. Clear with this, guys? And with this, literally, this entire chapter of budget and budgetary control is over. Clear with this, guys, right? And that's about this particular chapter. Now, in your management accounting, right, literally the same chapter is only there in your CMA intermediate. I'm telling you, paper 12, you have the same chapter, but it is called forecasting, budgeting, and budgetary control. What do you mean by a forecast? Basically, it is only theoretical in nature. Forecast basically represents, right, a short, a short budget, a shorter version of budget. Sir, what do you mean by this? Now, let me just quickly walk you through just 2 minutes time, and with that, we will be done. Now, please take page number 119. This is there only for CMA Intermediate Paper 12 students, right? So, management accounting students, right? Quickly, that's all. 5 minutes and we are done, right? Now, look at this. Difference between forecast and a budget. First, I will tell you, budget is basically a detailed plan of action which we prepare. Let us say for this upcoming year, right, whatever we prepare in detail. Production budget, your sales budget, and everything, we prepare it in detail. Now, having prepared the budget, let us say the first month got over. So now, based on the actual trends which happened in the first month, right, now if I am predicting what is going to happen in the next month, let us say in the month of May, First month was April. Whatever has happened, though for the entire year the budget has been prepared based on the current trends. Sir, the first month has started. Based on that, I am predicting the probable events. I am predicting the probable events for the upcoming month, right? For a shorter period of time. This is called a forecast. Sir, why do we do that? Simple. Though I have a budget in place, I generally have a forecast just to make sure that whether I'm going in track with the budget or not. At least the next month, will I be going in track with the budget or not? Clear with this, guys? This is just a prediction or an estimate that I make. Now, based on this budget, we don't do any variance analysis calculation and all, right? Maybe this estimate or this particular forecast can be useful for preparing future budgets also. Are you guys clear with this? Now, based on this in mind, you just read it. Now, that's why they say weather forecast, right? In weather, right, when they are predicting the climate and all, they do a weather forecast. They don't do a weather budget. Forecast is basically for a shorter period, 1 week, 1 month, right? That's all. They don't predict the weather for the entire period, for the entire year. Clear with this, guys? Budget is generally for a slightly longer period of time, or forecast is basically for a shorter span of time. Now you can read this. Now, forecast is an assessment of probable future events. Budget is a planned result which a business wants to achieve. Forecast is an estimation based on past and the present data. Clear with this, guys? After the first month, based on the trends, I am analyzing what is going to be happening in the next month. Budget is a financial plan expressed in number. Forecast, it focuses on what a business will achieve, whereas budget focuses on what a business wants to achieve, right? This is what you are supposed to do. Whereas forecast, sir, first month this happens, sir. I know second month more or less this will only happen. It's a prediction, right? Based on a forecast, we don't set any target. We only give a prediction. Whereas budget, it sets a target, right? Forecast, it is updated at regular intervals. Monthly I do, or quarterly or annual. Budgets usually are done on an annual basis. Now you guys are able to understand, right? Using a forecast, variance analysis is not required. Whereas using a budget, we do variance analysis, favorable, adverse variances, all these things we do in standard costing, right? Now, forecast, it precedes budgeting. That is, it acts as an input for variables like sales, prices, wages. Based on the forecast, maybe I can provide an input for the future budgets. Whereas, right, when it comes to budget, it uses the forecast data to create a budget. Past forecast data are used to create future budgets, right? Now, scope, forecast projects operations, customer reach, revenue, profitability, and all these things. Budget, it generally guides for profit planning and cost control. All these things they have given. Basically, guys, forecast is a prediction done for a shorter span of time, but budget is generally an entire detailed plan of action saying this is the sales I want to achieve, this is the cost you are allowed to incur, overall this is the budgeted profit and all. Clear with this, guys? Only theoretical thing is there in your CMA Intermediate paper 12, but for that there is no difference at all. Clear with this, guys? Numerical problems, everything is the same both in CA Inter as well as in CMA Inter paper 8 and in paper 12. All these things are the same. Clear with this, guys? And with this, we have completely covered this chapter called as budget and budgetary control. Clear with this, guys? Right? So now on this note, let's move on to the next chapter.